coming. My name is Jim Hopper. I'm the Executive Director of the Bainbridge Community Foundation in Bainbridge Island, Washington. We are very fortunate to be the community in which Paul Merriman has chosen to call home. And we're even more thrilled to have him here today for one of his fantastic presentations. As is our custom here at Bainbridge Community Foundation, we start all of our presentations with a land acknowledgement. Chief Seattle said, "Every part of this soil is sacred in the estimation of my people. Every hillside, every valley, every plain, and every grove has been hallowed by some sad or happy event in days long vanished." We begin acknowledging that the land in which we gather here on Bainbridge is within the Aboriginal territory of the Suquamish people, the people of the clear salt water. Expert fishermen, canoe builders, and basket weavers, the Suquamish live in harmony with the lands and waterways along Washington's Central Salish Sea as they have for thousands of years. Here, the Suquamish live and protect the waters of their ancestors for future generations, as promised by the Point Elliott Treaty of 1855. So I'd like to start by introducing Paul Merriman, who I'm sure many of you know. Paul is, of course, a nationally recognized expert on investing in mutual funds, asset allocation. He has written 8 books and countless podcasts. I'm sure many of you follow him either through Market Watch or through his podcast Sound Investing, or through one of his newsletters. We are fortunate to have had Paul as a board member here at the Community Foundation, where he really was an incredible mentor and friend to everyone in the Community Foundation. So you're here today to hear Paul talk about smart financial steps in your 20s and 30s. And I want to just remind you that if you go to the Bainbridge Community Foundation website at bainbridgecf.org and click over on the left-hand menu for news and events, you can find all of the remainder of Paul's presentations. The next presentation that we have is called Saving, Investing, and Planning, Getting Ready for Your Third Act. That's where Tom Cock will be joining Paul on April 6th. And then Christine Benz will be joining Paul for a presentation called Making the Smartest Financial Moves in Retirement. And then finally, Paul will be on vacation, but I will be here to speak with Mary Beth Franklin about how to maximize Social Security for everyone on April 20th. So again, you can find all of those on our website, and you register just as you did with this one. So with that, I'm going to turn it over to Paul with our extraordinary gratitude. This is, gosh, Paul, I'm not even sure how many years the financial education series has been going on, but I think it's 8. I think it's 8. Yeah. And we are just tremendously grateful. The resources that Paul has been able to share with you and others in our community and the broader community have been really invaluable. So we're very grateful for you, Paul. Thanks.
Thank you, Jim. That's very kind. And certainly we are grateful for the fine and wonderful work that the Community Foundation does. This community, I just think is amazing. I spoke recently to the senior center, and I look up to see where it might be noting what I was doing. I could not believe all the things going on at our senior community center. This is just a remarkable community, and I do feel blessed to live here. I am always excited about helping investors learn more about investing. I am always extra excited if I can get at helping an investor at a younger age. The earlier, the better, in terms of taking advantage of the leverage of time. And as I thought about what could I talk about in the 45 minutes to an hour before the Q&A session, I really wanted to focus on those things that I believe are going to be life changers to these young people. And the one area, and the area that my life really focuses on in terms of financial education, is on the area of investing. And there is no question in my mind that with careful, prudent steps, not having ever to do anything unusual, staying within the guardrails, staying the course, and all those good things that we know makes a more successful investor. I think that the path is relatively easy, and that is what our financial education is focused on, helping the do-it-yourself investor. I think that's important because people who are relying on somebody else to do everything for them, they don't need to know all of this information. But I do think if you're a do-it-yourself investor, you're sitting there at the table and across from you is your client, and that client is you. And so you have to find out about that client, and you hope that client gives you good, solid answers to your questions so that you can give them the advice. I mean, this is tricky business, trying to be your own advisor. But I do believe that if you get the data, if you get the evidence that shows how investing works, I think that there's a good chance that you can be a great do-it-yourself advisor and client. I do think for young people, it is really important to give perspective to the process of investing. And by the way, at 79, I think being in the 30s is young, but I find even 30-year-olds don't necessarily get it as to how investing works in their best interest. And I have tried to think of it and describe it to young people as starting a business. I've started businesses. You put a little bit of money in, you work your tail off, and if you stay at it over time, a business can grow. And it is no different with being an investor. And so as you establish the business, you are the boss. You are the president. You are the general manager. And you have partners in your business. And what you need to understand as an investor who has this business, that it is the early days of that business that is going to make the difference as to success or failure. Because what you do in building the foundation of that business will create the long-term success. Now, later, your partners are going to kick in and they're going to make you tons of money. And you're going to get up in the morning and you're going to have a portfolio of mutual funds and companies within the mutual funds. And you have millions of people going to work for you in your business. And it truly, that is the way that it does work. You don't have much power over each one of those people, but you are a proportional shareholder in whatever you have in that corporation. Now, the question is, how do you become a really good investor? And I think the key is to start by following the math, following the numbers. When we follow the math, there's a word I can use that I cannot use if we're talking about investing per se. If we follow the math, I can use the word guaranteed, because I'm not talking about owning any particular investment. I'm only talking about the math of investing. And let me give you an example of that. Let's say that you are just starting out. And by the way, lots of people are just starting out in their 30s and their 40s. So this doesn't mean that you have to be in your teens or in your 20s to be just starting out. But as we start out, let's say that we find an investment that is built to make an 8% compound rate of return for the next 40 years. And I'll talk about such an investment in just a few minutes. And let's say that during that 40-year period, you got the 8%, and then you retired, and for 30 years, you took money out of that investment pool. You took out 4% a year, and you made 6% because you didn't want to take as much risk in retirement as you did when you were accumulating money. And at an 8% compound rate of return, what we know is if you put away $6,000 a year, that your $240,000 that you put in over 40 years would grow at age 65 to $1.7 million. Then you start taking the money to live on. And in fact, if you live for 30 more years, taking out 4%, you will, making 6% in the portfolio, have taken distributions of $2.6 million. And during the period of time or at the end of your life, you will then leave something to your heirs, charities, or children, $2.8 million. Now, from my viewpoint, the profit on all of your investing for your retirement and how you did is reflected in how much you lived on and how much you left. And for that effort, given this math, you would have had about $5.5 million in money spent and money left. Now, here is what I want young investors to understand. If we could just find another 1/2 of 1%, and instead of making 8, make 8.5 during the 40 years of accumulation, instead of making 6, make 6.5. And I will share a number of ways that I think you can make an extra 0.5%. But if you did that, I think it's important to understand that the math tells us that instead of making 5.5 million, we will end up making about 7 million because we will have taken withdrawals of 3.2 and our heirs and charities will be left $3.7 million. That is from a very small additional return. And the fascinating part is that extra 0.5% is really easy to come by. What if we double that? What if instead of a 0.5%, we make it 1% more? Well, that's simple. I used to be an investment advisor. I used to charge people 1% to manage their money. If they hadn't hired me, then they could have kept that 1% and they would have made an additional 1%. Now, would they have done the right thing? Well, of course, this is the challenge today. What is the right thing to do? And can you be a successful do-it-yourself investor? But here's what that 1% brings you. It doesn't just double the 0.5%. Remember, that was 1.5 million. Doesn't take you just to $3 million extra. It takes you to $3.5 million extra because you had more money compounding on top of additional money. That extra money, the impact of compound interest, it still is, I think, amazing to a lot of people. But now, by having made an extra 1%, and it's really on your, it's up to you to do this because you're going to need to know what you have to do to make that extra 0.5%. I've got some ideas. So here we are. We're at the third opportunity for you to do something that impacts this output, this outcome. And so if you do one more thing, this is not about the market, this is about you building your business. If every year you increase the investment by 3%, so instead of investing the second year $6,000, you invested $6,180, $15 more a month. That one step on your part as the business owner will take you, if again we have the 9% and we have the 7%, that will take you now up to a total of $12.4 million, an increase now of another $3.5 million. I mean, this is just basic math and the impact of saving a little more each year. So you might think you're done, but you're not done because there's one more really good thing you can do, and that is you can start earlier. If you can, and by the way, I can't guarantee that every parent's going to be in a position to be able to help you start earlier, but many of us have taken the step to help our children and our grandchildren get those IRAs started as early as possible. My new granddaughter, my first granddaughter, was born in November. And the first thing we did, other than go and hug her and be happy to have her in the family, but we made a contribution to an account that is there to help fund her IRA when she finally gets there. Now, not everybody can do that, but a lot of times we're in a position that we know someday we're going to leave money to these people. Why not leave it in a way that it gets this huge, gigantic leverage of time and compounding tax-free, which of course is what we're working to be able to do for these early accounts. So we're talking now about the difference between starting early at age 25 and waiting 5 years and starting at age 30. And so the only difference in what these two investors are going to have at age 65 and then at age 95 is what happened in that 5 years that you put away $6,000 earlier than the other, and you increased it 3%. So by the time you got to 30, you were already investing more than the person who's starting at age 30. You got the rhythm, you got the discipline. And because of that extra 5 years, you are going to have an extra $4.7 million just because of that extra 5 years. They'll have 7.8 million, you'll have 12.4. So these decisions about investing, it isn't about picking the best stock, the best mutual fund. It is about arranging your business, taking control, building the discipline to build the foundation to make it flower. And flower, it will. But now we have to follow the history. We start out by following the math, and then we jump into the investing part. Then we look at the history. Then we see what steps we can take as an investor in order to have more money later in life. And by the way, I am absolutely dedicated to the idea that when you are planning your financial future, enough is not enough. I had a wonderful conversation with John Bogle in 2017. I had 90 minutes with him to pepper him with questions about his life and what he believed about investing. John Bogle was focused on getting people to have enough, to save, to have enough. I actually believe, having been around this industry since the mid-60s and having seen so many people that had a plan and they knew what they thought was going to be enough, only to find out that enough was not enough. And so one of the reasons I'm working hard to show people simple steps that they can take to build a bigger portfolio. It is not about having a fancier car or taking a longer trip. It is about making sure that as you do this, you go through this process of saving and investing and accumulating and doing all that you're trying to do to retire and have sufficient money to get along on, that you also prepare for the unexpected, which, by the way, most of the things we think are unexpected, the actuaries think are actually expected, but that's another story. First thing you run into as an investor is the fork in the road that says stocks versus bonds. Now, I was looking for 0.5%. If you want to find a place to find 0.5%, in fact, if you want to find the difference in multiple halves of 1%, the first step is to choose stocks over bonds. And yet 23% of young people, millennials, are not willing to invest in the stock market because it's too risky. It's gambling, it's speculating. It's not prudent, they think. But I want to show you the long-term return for government bonds, whether it be short-term government bonds intermediate or long-term. $100 over the last 95 years has grown to $2,000 to $12,000. That's what we should expect out of bonds. A return that is somewhere between 3 and 5%. At least that's what it's been since 1928. Now, there have been times much higher and much lower, but that's been the compound rate of return. And here's what I know, that if that's one choice, what is the other? Well, the other choice is, if you put $100 into the S&P 500, a portfolio of large companies only, some are growth, some are value, some are hot dogs and growing pretty fast, and they're exciting and they're a place you want to be, and others are out of favor and not so exciting, but they're still big companies, so they're in this index. And that index has compounded over the last 95 years at 9.8, and that means that it grew the $100 to $750,000. Or if you took the growth out of the portfolio and you held only all the leverage of the large cap value companies, it would have been an 11% or almost $2 million. Or if you had a portfolio of smaller companies instead of $100 billion companies, more like $5 billion companies, or even less sometimes, that portfolio, that index, that group of stocks compounded at 11.8. And then finally, the gold ring of investing. And I'm sorry that I talk so much about the small cap value asset class, because it isn't normal for people to have much in their portfolios. And I'm just on the hunt to try to convince people that they probably should have some in their portfolio. I will try my best to make the case here today, and believe that that will help you having to have more than enough when you need it. And over here, we have the combination of these different equity asset classes. And by the way, I want to make it very clear, nobody's handpicking the best of any of these. They're owning all of the stocks. These studies are as you would in an index fund. So if I'm left with the decision and I'm looking for an extra 0.5%, it seems to me the choice of getting 10% versus getting 5%, there are 0.5% differences there. And truly, when you invest $6,000 a year and you increase it by 3% a year, and then you use that market, that investment over a lifetime, it is in fact about a $14 million difference between going the route of the stocks versus the bonds. About a $14 million difference. So, what's wrong with stocks? What's wrong with them is this thing called losing. They lose. They lose badly. In fact, there's one year, calendar year, that the S&P 500 was down over 43%, large cap valued 61, small cap blend 48, small cap value 55. Those years feel terrible. And it just turns out the market loses money about 1 out of 4 years. So there's a lot of pain in the process of trying to get the gain that you're hoping to get. And sometimes people just, they can't stand the idea of losing money. But I can't say guarantee, but I'd love to be able to say guarantee. But I'll tell you what I know about the last 95 years. If you break it up into the 55, 40-year periods, there was never a losing 40-year period. The average compound rate of return of the S&P 500 of all 55 of these periods, that average return was 11%. Large cap value 13.4, small cap blend 13.7, and small cap value 16.2. The worst was 8.9, and that's not a loss. That's the worst gain compounded rate, and about the same for large cap value, and 10.6 for small cap blend, and 11.6 for small cap value. the worst 40-year period. So if we're trying to figure out where do we invest our money that we are going to get the highest return, I think if we are afraid of stocks and choose fixed income bonds, that we are likely going to make almost nothing before inflation, because all of these numbers I just shared with you are not inflation adjusted and have not been taxed. In other words, those returns from the bonds between taxes and inflation are going to leave you with almost no return. Daryl Balls is our director of analytics. He's a volunteer. Chris Pedersen, I'll mention him today, also a volunteer at our foundation. They are both amazing volunteers. Chris Pedersen wrote the book Two Funds for Life and created our best-in-class ETF recommendations. Daryl Balls has put together, we have 200 tables he just finished updating. He actually hasn't finished this one yet, but he's working on them. And I'm going to be sharing a few of his tables. His tables are built as best we can to focus on numbers, but still make them entertaining enough that you'll learn something. Because what is this? This is the returns I've just been talking about 1 year at a time with the equity asset classes. So if you see a green return, that's the S&P 500. If you see the electric blue, that's the small cap value. If you see the kind of brownish, that's small cap blend, and the touch of yellow is large cap value, and the purple, I didn't talk about that, it's the average every year of the four of those equity asset classes. Now, what does that teach us? Well, the first thing that I remember is that the S&P 500 had the worst return. So I would expect the S&P 500 to be kind of at the bottom most of the time. Well, it is about half of the time, almost half of the time, at the bottom. But in about a third of the years, it's at the top. In other words, just because it might not be very good, relatively lower returns for the long run, does not mean that it's going to be there all the time. A lot of the times it's doing fantastic. And small cap value, the gold ring, as I said, of asset classes, it spends a lot of time at the bottom. About a third of the time, it's at the bottom. But if I had to pick an investment on this page that suggests to me that I have the least volatility, that I can count on that investment more or less year after year, no, never going to be number one, never going to be number 4 or 5, but mostly just right in the middle. That is nothing more than the combination of the other 4 asset classes every year since 1928 through 2019. And I think that tells a couple of amazing stories about volatility, because even though the S&P 500 is theoretically more risky than the 4-fund strategy, I'm getting the feeling that it is actually the 4-fund strategy is less risky, that I can, in essence, count on a better return. In fact, I also know that if I look at the returns over a long period of time, putting these different equity asset classes together, here's the small cap value, there's the 13.4% compound annualized growth rate, the CAGR. Then if I put a portfolio together that was half in large value and half in small, it would have been 12.5. If I used a 2-fund strategy, by the way, this is what we're doing for our granddaughter. That money is going to be half S&P 500 and half in small cap value. That was a 12.2% compound rate of return. The 4-fund strategy that I just said was so marvelous in terms of volatility had a 12%, and here's the S&P 500 down here at 10.2. Now, the thing I was really anxious for you to do is to get into the stock market rather than having everything in bonds. And I'm guessing most of the people here with me tonight are in stocks. How much will be very different, I guess, but have stocks in their portfolio. But the fact that I could find an opportunity to go from 10 to maybe 12 and not take any more risk. Now, there are many, many ways to judge risk. And I will show you another way to judge risk with the S&P 500 and these different combinations of equity asset classes. You want to be more aggressive? I know how to be more aggressive. Go all value. You want to be more conservative? Well, I know how to do that, but I don't want you, if you're 20 to 40 years old, to be in equities for the long term. Every 10% you have in fixed income in your portfolio, in the long-term 40-year strategy that you're putting money away, every 10% of fixed income reduces your compound rate of return by about 0.5%. And so I don't want you to give up 0.5% for the next 20 years anyway, if you're in your early 20s. But I really want to encourage young people to be all equities until they get to age 40. Now I want to show you one more study. I think Tom Cock, now Tom's going to be speaking to a different group of people. He's going to be speaking to people from 40 to 65. They have some different kinds of investment challenges. You know, we're pedal to the metal in a sense here. I'm not encouraging people to be all individual equity, buying individual company stock. I'm not trying to do that. I'm talking about diversified portfolios. But we have done a lot of work over the years. In fact, this table goes back to the mid-90s that I started working on this project. And what it did was it simply made the case for diversification of different equity asset classes. I'm going to do this quickly. I showed, starting way back then, starting with $100,000 in 1970. What did it grow to through the mid-90s? Well, now we're looking to what it grew to through 2022. And it would have grown to about $19 million, not adding any money, not taking any money out, not paying any taxes, but paying a minor fee to be in it. Almost like a regular index fund or an ETF. And then what we did to make the case, we one by one started adding individual equity asset classes. We added large cap value, 10%. The return went up to 20.8 million. We added 10% small cap blend. The return went up to 22 million. We added 10% small cap value. The return went up to 27 million. We added 10% in REITs, real estate investment trust. It went up to 27,600. Now that's not a big deal compared to the others, but it helped keep the volatility down. The REITs have about the same long-term return as the S&P 500, but they don't go up and down together all the time. And then in one fell swoop, we added 10% of 4 international equity asset classes. A large value, large blend, small value. Then it got up to 35 million, and finally we had 10% in emerging markets, and it gets up to $41 million using just the asset class returns. Nobody trying to do any better than own an index. And the point is not that you have to own 10 of them. The point is is that it isn't just about diversifying amongst different stocks. You got 500 companies in the S&P 500. And by the way, those 500 companies are not the same today as they were in 1970. Every decade, they replace and change about 200 of them. It's an actively managed index. And you can't buy that return. But we can buy the equity asset classes. And all the academic research shows that it is equally important to have diversification among asset classes. Now, you may not want to get beyond the 10. There are two funds that you have a very good opportunity to make a 10% compound rate of return. They've been turned inside out, going all the way back to 1928. They are the S&P 500 and they are the total market index. And so those two, by the way, have almost exactly the same return. The S&P 500 has out-earned the total market index by 0.1% a year. Now, there are cases here where the difference between one and the next was only 0.1%, like from portfolio 2 to portfolio 3, or from portfolio 4 to portfolio 5. So even 0.1% can be important over long periods of time. And if I'm talking to some 20s and 30 somethings here tonight, I hope there are some here, then 53 years is part of your life. In fact, you're probably, which is what this table is about, you're probably going to be around for more than 53 years. All right. All I'm saying is that you can have more than one major equity asset class in your portfolio. And I believe if you do that intelligently, and I'm going to show you ever so briefly how to do it intelligently. Now, when I say how to do it intelligently, I have not stamped the word guarantee on anything, okay? Because I can't guarantee anything about the future. I can say that the academics will tell us the more diversification that you have, the lower the risk. So if you are combining different asset classes, and if those asset classes don't go up and down together all the time, again, you have an advantage. So now I want to look at a handful of portfolios that we've developed. And we tell you exactly the funds at Vanguard, at Fidelity, at T. Rowe Price, and we show the best-in-class ETFs, or ETFs. You can use it if you want to use the Vanguard ETFs, you can use those, or if you want to use what we consider to be better than the Vanguard, but you can buy them at Vanguard, you can use those. But we have built these portfolios and we show people the long-term results. We show them the risk, we show them the return. All I want to do here is to show you in table A2, here we are with $19 million in the S&P 500. Here's 41 in the ultimate buy and hold. If you just own 4 funds, 2 US, 2 international, one of them a large cap blend, one of them a large cap value, one of them a small cap blend, one of them a small cap value, and we tell you exactly the funds we think you ought to be in, you would have made a little bit more and only have to deal with 4 funds instead of 10. Or if you didn't want to go and take the risk of internationals, if you see that the homegrown are more comfortable for you, okay, do the same thing with a 4-fund strategy. It's still a balance of large, small, and value and growth. And the total value at the end of the 53 years, almost the same, 41,500,000. If you want to really take more risk, then you could take the worldwide all value, throw out the growth, throw out the great companies, and be left with the more conservative As a matter of fact, if you go to Vanguard and look at the large cap value companies, you'll recognize them. In fact, the number one company in that large cap value group is Berkshire Hathaway. And you've got oil companies in there, and you've got Procter and Gamble. You've got a lot of great companies. And finally, over here, I'll take you right to the last one at 46.6 million. That is half in the S&P 500 and half in small cap value. And why did I pick that? Even though it has a lower rate of return, 12.3, lower than I could have gotten we could have gotten theoretically for our granddaughter at 13. Why would I take this lower return? Because half of it is in this benchmark index that people just love. People think is Warren Buffett, as a matter of fact, even says the only investment you ever need to make is the S&P 500. And when he dies, he has asked the trustees to put 90% of the money he has for his wife into the S&P 500 and the other 10% into T-bills. So I want, when our granddaughter is 18 and she finds out about this account and money is going into a Roth IRA, because hopefully she's working a little bit and we can put some money into the Roth IRA as she starts working, I want her to be able to see the return of those two asset classes. I want her to see the difference year after year. I'm going to show you in a few minutes how different those returns can be, and to see also that there were long periods that the S&P 500 did well and other periods small cap value did well. It will be such a wonderful lesson, real time. So the big risk, the big problem is dealing with loss. We don't want to take the loss of the market. This is a wonderful graphic that shows since 1926 the good times, the bull markets, and the bear markets. The red, those are the bear markets. And with each bear market, it tells you how long it lasted from when it qualified as a bear market and until it was replaced by another bull market. And I'll tell you, when you are going down, I don't care if it's 4 months or for 2 years, it just feels terrible because it feels like you're going to go down forever. But you can see it hasn't been forever. And by the way, the bull markets aren't forever either. But boy, I mean, look at here, this one that ended in 1964 after 181 months, one that ended in 1989 that ended at 155 months, one that ended in 2000 after 155 months. And then we got hit with a couple of years where we had really, in 3 years, we had 2 bear markets. And then the market took off again. And then, I mean, this is the history of investing. And remember, the company that we're building, if we build it and it has the S&P 500 and it has the large cap value and the small cap value and the small cap blend, you have got so much diversification. It does not protect you against the complete collapse. We had a complete collapse in the 30s of the stock market. But what a lot of us may not know is the stock market for the whole 10 years ending 1938, from 29 to 38, the compound rate of return, which was not a return, but it was a loss. Well, the return was a loss, was a lower loss than was sustained in the 2000 through 2009 bear market. That 10 years was a negative 1%. As a matter of fact, if you look at the return inflation adjusted from 1929 to to 1938, it was actually profitable because it was a period of deflation. So what I would love for you to do is to build a portfolio. And that conversation I just had about the what we call the ultimate buy and hold strategy, those 10 different funds, I just completed. You can go online and you can see about a 1 hour video just on that one topic. But if you are not going to build your own portfolio, what I would love you to consider is to use a target date fund. It is truly the #1 retirement investment in America today. And I'm talking about if you're in your 20s and 30s, you're putting money into 401k, you have almost always going to have a target date fund available to you. And the target date fund does something that no other investment does. And that is, it allows you to make one decision, whether you're 21 or 31 or 41 or even 51. You can say when you want to retire, and they will know. They will know how old you are, and they will know how aggressive you should be. Now, you can outfox them. You could be a 51-year-old investor and tell them you want to retire in 2065, in which case you'd have a portfolio that's only 10% in bonds. You can outfox them if you want to. But I'm not recommending you outfox them, although I will make a recommendation that I truly think is going to be life-changing regarding the use of a target date fund. But the target date fund has people, the same kind of people who run pension funds. I mean, this is serious conservative money. They do not get aggressive. I wish they did. I'm going to show you how. But it's very conservative. But here is the wonderful thing about these portfolios. Number one, they automatically adjust the amount of equity and fixed income over your life. So even if you retired at age 65, you could still keep them on your payroll working for you because they know how old you are and they will continue to add more fixed income as you get older. Now, I'm 79. If I had a target date fund at Vanguard, they would have me 30% in equities, 70% in fixed income. No way for me. My wife and I have oversaved, and so we feel we can take the risk of 50-50 instead of 70-30 or 30-70. But to have no responsibility for what to do with that money, but have it managed professionally for the rest of your life. If you don't know what you're doing, this is what you should be doing. You have a friend that doesn't know what they're doing. You should tell them that's what they should do. Now understand, target date funds have problems too. Everything has problems. It can't be what everybody needs. And one of the problems that, I've got to make sure I mention this 2.3% down here. This is $1 million thing to know. The people at Wharton Business Schools, a project, worked together with Vanguard. They looked at 1.2 million Vanguard accounts that were in 401ks, that were in target date funds or not. So they could see how the people who were not were invested compared to the ones in target date funds. Now, with the target date funds, everybody's got the same thing. So it doesn't mean that all the people who were not in target date funds are going to have the same thing based on whatever age they are. But here's what they found out. That the people who didn't use target date funds, who made all the decisions themselves, They had way too little money in equities for the age. They had tons of cash in their account sitting there doing nothing. And they were market timing. And the end result was they were, based on what they were doing, designing portfolios to make 2.3% less per year than you get in a target date fund. So if you know anybody that doesn't know what to do and you want them to do the right thing, I really would recommend the target date fund. It is true. It drives me nuts. They've got 10% in bonds for a 20-year-old. And the reason that they do that is they just want to train people to understand that a target date fund is there to take care of the bonds and the stocks. So instead of waiting until 40, when is the next time that the target date fund adds any bonds, instead of waiting until then, they hang on to this 10% piece for 20 years maybe. So too much in bonds, too little in value, and too little in small cap. They are driven by funds like the S&P 500. Actually, the Vanguard funds are a combination of the total market US and the total market international. Large cap growth driven. And it's not that that's bad. It just isn't likely to give the return of a more broadly diversified portfolio. And Chris Pedersen came up with a solution. And I'll be offering a free book you can get online that he wrote. And what he suggests, several approaches. One is, let's say you're saving 10% in a target date fund. All he recommends you do to make a difference is to add, let's say you're putting in $1, put 90 cents into the target date fund and 10 cents into the small cap value, or 80% into the target date fund and 20% into the small cap value, or even 30%. And I'm going to show you why in just a few minutes. And all you do then is you just carry on your 90-10. You don't have to rebalance. You don't have to do anything. You will, if you start doing this and you do this for 10 or 15 or 20 years, you're going to get to know your employees, your partners very well. And you'll know the times that you're disappointed and the times that you're very enthusiastic for them. But that 10% could legitimately add an extra 0.5 to 1% over a lifetime. And of course, it even gets better if you go to 20%. He has in that book another portfolio that I just think is marvelous. Basically, you take your age, you multiply your age by 1.5, and that's you're basically the portion that the 1.5 is. That would be if you're 20, that would be 8 years old. That'd be 30. You have that amount in the target date fund. The rest is in small cap value. And as you get older, that 1.5 times your older age will have you owning more and more target date funds. For those of you who are interested, that book covers it. And by the way, the second half of We're Talking Millions is focused on that same subject. That is also available free. I put this in at the last minute. This is one of the most interesting tables that Daryl has ever done. I can't see the exact top, but you can, I hope. And by the way, I'm not going to ask you to be able to see all these numbers. I'm going to show you the bottom line in a few minutes. But here's what this table represents from 30,000 feet. On the far left, 1 year at a time, the return of the S&P 500. On the far right, the return of the S&P 500 1 year at a time without any fees. In the column right next to the S&P 500 on the right is small cap value 1 year at a time since 1970. There is nothing magic here. This is a whole bunch of years. Some years are great for one and not for the other. I can see 1977, S&P 500 was down 7.2, small cap value was up 22.2. I can see 2000 through 2002, and the S&P was down 3 years in a row. Small cap value only had a loss 1 year. By the way, the reason that happened partially is the previous 5 years, the S&P 500 was amazing and small cap value wasn't. So it's not like a small cap value just wiped out the S&P 500. These are different asset classes. They don't go up and down all the time at the same time or by the same amount. In fact, every year, the average difference in return is about 14%. So if one makes 10, the other one has probably made 24 or maybe lost 4%. But what I want you to see that's so valuable here, and that is the bottom of this chart. I want you to see that if you were in the S&P 500 itself only, with an annualized return of 10.4 and a standard deviation, a volatility rating, higher numbers mean a little more risky. For example, over here we have a 17.8. That would be a little more risky, but not much. But let me talk about under the S&P 500. The worst 6 months was a loss of 41.8%. The worst 12 months, a loss of 43.3. This is going back to 1970. The worst drawdown from a peak to a valley before it came back up to the peak was a 51% loss. Warren Buffett and Peter Lynch have both been quoted as saying, if you're not willing to lose half of your money, you shouldn't be in the stock market. But they're talking about for a short period of time, not forever. I know how to lose half of your money forever. Invest in Enron, invest in Washington Mutual. It's easy to do. Virtually half of the public companies since 1926 have either gone bankrupt or either were sold, merged away, and on average didn't make more than 3%. I mean, there are a lot of companies that don't make it, but we're not looking at trying to own just the good ones, because you can't own just the good ones. We want to own them all, knowing some of them will be dogs. This includes the dogs, by the way. Enron was in the S&P 500. Look what happens when you add 10% small cap value to the 100% S&P 500. Standard deviation is still the same. Remember, they don't go up and down together, so that helps keep the standard deviation down. It added 0.4%. And yes, you had to accept a little more risk, a little more loss. Instead of the worst year being 43.3, it's 43.9. And I know you're not thinking, ooh, I don't think I could take that. I can take the 43.3, but I don't think I can take the 43.9. Of course you will, if you'll take the 43.3. And if you believe you shouldn't be market timing and jumping out of the market when it's down. Okay. And by the way, the worst drawdown was 0.6% more. If you added 20%, it takes your worst 12 months to 44.5, a little bit more than 1% down, one time. And the worst drawdown was a little bit larger. And finally, if you went out 30%, It takes your standard deviation to 17.4. That is virtually the same. You would not feel the difference because it was that 0.3%. The worst 12 months, yes, is a little more. The worst drawdown, instead of 51 now, is 53.5. But you have just picked up more than 1%. That is a big deal. That is a huge deal. And not only will I hope you do, I hope your kids will. That's the whole idea, to share this. Now, for our granddaughter, I like the 50-50. I think that's it means there's going to be a drawdown of about 55.8, more probably, who knows? And the worst 12 months was 3% more. But she will have picked up almost 2% more compound rate of return. And of course, I'm not going to be there when she's 18, but I will try to, through a podcast to her, a recording and a letter, convince her just this particular investment. Keep it all equities your whole life. The implications of that, and get it into your Roth IRA as soon as possible. The implications of that are, not only will she be able to spend a lot of money, but she also should be able to leave money to things she cares about. And Jim, it might not be Bainbridge Community Foundation. I don't see her living on Bainbridge, so, but it will be some community.
Don't sell her short there, Paul.
Okay. Oh, you want to make an extra 0.5%, lower the expenses of your mutual funds. The average equity mutual funds around 0.8. You can get into an index fund or other ETF funds for 0.1. You can save 90 basis points, 0.91% by using a lower expense fund. Be in a fund that has lower taxes. A lot of people don't know, in actively managed funds, Morningstar tracks the tax efficiency of actively managed funds. There's about a 1% higher cost in return to actively managed funds because of taxes. And you can go track that. You can look at your actively managed funds and see how much what is the tax implication of that actively managed fund. And of course, index funds, that gives you low expenses, it gives you low taxes because there's low turnover, and it gives you massive diversification. And buy and hold. I know I've been following market timing since 1966. I know market timing inside and out, and I have talked to thousands of people who have tried market timing. Market timing is the most difficult thing to deal with, because once people use what I call the ICSIA market timing strategy, I can't stand it anymore. They got out of the market in either late 2007, early 2008, and many of them are still trying to figure out how to get back in. One bad market call, getting out when you think the world's coming to an end. About the time you think the market's coming to an end, more than likely, it's very close to the bottom. One of the biggest challenges to be a good investor, to run a really good business of investing, is to realize that this is not about events. This process is not about events. If you are a buy and hold investor, you are not supposed to be responding to events. You are in it for the long-term journey. That's what long-term investing is about. And with that in mind, every time you see what the press, what TV, what they're pushing events, inflation, political uproar. Go watch Jim Cramer on TV, and he talks about the earnings. An earnings report is an event. It has nothing to do with the next 40 years. Or, by the way, if you're in your 20s or 30s, we're talking about doing this for maybe 60 years or more. It's the long journey, and it takes discipline to buy and hold. And every 10% you add in equities, if you're a fixed income person, every 10% you add is going to add about 0.5%. And of course, I'm hoping, as you can tell, you'll add some small and some value. I'm going to check my time. How bad have I been? Well, I guess I'm okay. IRAs and 401k. Now, see, anything else I talk about is not going to have the impact that I just talked about regarding these decisions you're going to make about your business, your investing business. But there are some things you can fine tune and make a little better. For example, if you work for a company that has a 401k and it has not matching anything, and it has lousy investment options, and if you don't know if they're lousy investment options, it's okay if you ask me, paul@paulmerriman.com. I mean, it takes just a second to see if they're lousy options. Now, whether I'll tell you exactly which options you should use depends how much time I have, but I will tell you that if you follow our work on the internet, you will know what options you should be using. So that's part of this process we're trying to go through here, is introduce you to these asset classes. But if you don't have good 401k choices, you're better off going to an IRA. In fact, you may not have a Roth 401k inside your 401k plan. And definitely, if they're not matching, you'd want to go use the Roth IRA on your own, because you'll have access to all the different equity asset classes, all the ETFs, all the indexes at low cost and broad diversity. I mean, you can do all the right things. And you can use a target date fund, by the way, with a small cap value inside of an IRA if you want. But of course, after you do that $6,500, you're going to have to go hold your nose and start putting more money in the 401k. Now, I take a little different approach. And there are a few sources I'm going to give you. On our website, we have a page called Truth Tellers. They are sources of information I trust. I do not get paid anything from any of these people. I do not get paid anything from the foundation. When I retired, I promised my wife I would never work for money again, and I've kept that promise. But I will tell you that, oh, you know something? I normally warn people this could happen during the presentation. I forgot to warn you. At 79, from time to time, my mind does this thing where it, what is it called? Forgets. And so I lost the path there for a second. Oh, yes. The Roth. Why the Roth? When you put money into a Roth, you are not getting a refund. And you are getting lifetime tax-free growth and lifetime tax-free income. That is golden. And when you are young, you're not in a very high tax bracket anyway. And when you do a regular IRA, then what you typically do is you get that refund because you did it and you spend it on something that's fun. Now, I'm not trying to ruin your fun. I'm just saying that when you put money into a Roth IRA, you are in essence investing more money. and you're getting it in there to be protected from taxes. And I can tell you that when I came into this industry in 1966, the highest marginal tax rate was 70%. The year before, it was 90%. And who knows what taxes will be in the future. Now, back to the 401k. You got a match going on in your company? You got to find the money somewhere. You've got to find the money to take advantage of that 401k match. See, it's not just the match, it's that you're also probably really young. I would have no hesitancy. I mean, my kids, my younger kids knew that I had done this for my older kids, so they knew that I was committed to doing this for them. But there are a lot of parents that they just might not think that this is a better way to leave you money. Don't forget those first 5 years. And so not only by doing that match are you getting your money in there, but you're doubling, you may be getting twice as much but from the match. There are companies that literally match dollar for dollar. Some it's up to 10%, some 5%, some 3%. But I don't want you to miss that match. I know people. There's a thing called the FIRE movement. It's financial independence, retire early. I can't say there are millions of people in the movement, but I can tell you there are hundreds of thousands. And these are people who are trying to retire early. And they're saving money big time, percentage-wise. I know some that save 70%. I know people that are working a couple of jobs, not because they need it to get by on, but because they need that extra money to fund these things early on to take advantage of that first 5 years. So, then of course there's the triple tax treat, the triple tax-free health savings account. Now, I'm going to have you go somewhere else. I'm not going to spend the time to talk about it, but it allows you the tax deductibility, the tax-free growth, and the tax-free distributions, with the money being used to pay for health expenses in your life. And by the way, once you start investing in the taxable accounts, I want you for sure to be investing in something like the S&P 500 in particular, or ETFs, where they're very tax efficient. ETFs are much more tax efficient than regular mutual funds. Here are the truth tellers. I tell you, you come up with almost any question about investing, and they will have at the balance an article that is not only written by professionals, but is peer reviewed. And if you don't get what you want there, go to the White Coat Investor. And if you want me to recommend a book that will address most of the questions you'll ever come up with, my expertise is really about investing. I'm not a tax guy. I'm not an insurance guy. I'm an investment person. But there are lots of other things that you'll want to get into. And that book, Your Complete Guide to a Successful and Secure Retirement, is just terrific. And it's available as a paperback. And if you want to read somebody's work, Larry Swedroe is one of our truth tellers. Here are the 2 books that are free. And you got a PDF. I think if you go to your PDF that you got, if I'm not mistaken, you can go right to the place on our site where you can get order the free PDF. And we make this, both of these books are free for a reason. What we want you to do, one, is read the book and say, hey, that's really good information. Then I want you to send it, because you'll have it in a PDF format, to send it to other people that you might think will benefit. At age 79, I got a lot of goals. In fact, I've got a bucket list. It may not be the kind of bucket list you have, but on my bucket list is I want to speak at the Bogleheads conference before I die. The good news is I just got invited to speak there. I have got some things I want to accomplish before I end the work that I'm doing. I want this little book, and it's a short read. I want it in the hands of 1 million youngish people in their 20s and their 30s. By the way, anybody can use it. And the 2 funds for life, there's also a part about 2 funds for life when you're retired in this book. And the fellow that wrote it is one of the smartest people I've worked around, one of the nicest people, and both Daryl Balls and Chris Pedersen, and one more name I've got to mention, Craig Apple. He created a calculator so that he could take our numbers, our 200 tables that we have, and put them on a computer where people can use them in a calculator format. So you can not only can you put your own numbers in there, how much you have to invest, how much you have in your portfolio, but you could also trick the computer, and you can say, you know, I like those numbers from the last 52 years, and I'd love it if I could get that return again, but I'm going to take a 1.25% off of all the returns that are in the calculator, in the database. Oh, I'm going to take 2% off. I'm going to take 0.5% off. You tell it what you want to take off, and it will do that for you. These are all volunteer helpers with our organization. And there's my email address. I'm easily reachable. And I think most of you, hopefully, who are here have not found it too difficult to get a hold of me. I hope this has been helpful. Now, Jim, do we have a few minutes for questions?
Indeed, we do, Paul. Paul, I'm going to start out with my own. So if you want to go ahead and close your
I will.
Presentation, and we can be right on the screen.
I am so sorry that I did that to you.
Well, that's okay. We're all good. All right, Paul. So I'm going to tell you the story of 2 brothers, grew up on a farm in Caldwell, Idaho, both of whom in their 20s were working. One was in for-profit companies. He was actually an Enron employee. The other was working in nonprofits. They would both go on to be CEOs of their respective organizations, respectively. But for one, for the for-profit, he in his 20s received a tremendous amount of corporate stock from his employer, and of course the going sort of pressure is, you know, you hang on to that and you believe in the company that you're a part of. The other that worked for nonprofits felt like, gosh, you know, I don't think I make enough money yet to start investing. I need to spend all of my money right now on my house, on my car, on whatever it is that is my basic living expense. So I asked that question. So I'd love, you know, I think a lot of people in their 20s find themselves in one of those 2 camps. And I'd love your thoughts on how do you keep your head in either of those situations. In one situation, you have a lot of money on paper. You look like you are doing really, really well. In the other situation, you don't feel like you're ever going to have enough money to start to invest. And frankly, when you hear wonderful presentations like yours, where people say, like, start early, that, you know, it's panic inducing, right?
Well, first of all, you could start with very little. I mean, literally, you could start with $100. You could go to Fidelity. You could. We have these recommended portfolios, and we recommend ETFs. And you could go to Fidelity and you could buy those ETFs. Let's say you wanted to buy all 4 of those ETFs, a little bit in those big, small value, all that. You could divide your $100 into 4 parts, and you would be able to buy portions of 4 funds so that you had a $100 portfolio, completely diversified, and there was no commission to buy. When you go to sell, there's no commission to sell, and the internal expenses inside of those ETFs are very, very low, less than 1/10 of 1%, I'm going to guess. Now, so you can start with a little. The other thing that you can do, and this obviously is not easy for everybody to do, but some people are so driven to saving that they will work a second job in order just to earn that money that it takes to meet whatever that you want to put aside. So that's also another possibility. But let me tell you something that's happened in our society. We now count on a 401k that we put the money in. Yes, some companies match, but the heavy lifting is left to us. And we are also left with the heavy lifting of having to decide what investments that we're going to make. And so the problem is that right out of the gate, we're behind the 8 ball, because even if we can save, we're not sure what to do. So what happened was companies gave people a legitimate offer. They would allow them to opt in automatically to the retirement account. And a very small number of people would sign up for the retirement account. And then they changed. Instead of requiring people to opt in, they automatically signed them up and they became part of the program, and they had to opt out. And 83% of the people stayed in.
Yeah.
And it is a mindset. I know in watching what these doctors are doing, who are part of this white coat investor group that I spoke with. I had 4 days there where I was talking to these people about how they feel about investing and how they treat their money. These people are being encouraged after they become a doctor to continue to live like a resident. And a lot of them are doing that exact thing. They're learning to live financially like they were a resident. So I know this is a mindset. And I know that there is the possibility of saving, but it means a dedication that for a lot of people doesn't even feel good. I'm just thinking about this guy who's the nonprofit guy. You know, when you're in the nonprofit industry, generally you're not about money.
Right.
When you're in the broker's business, in the money business, you are about money. That's all you're about. And so I could see where somebody would say, I'm not going to do that. I got a life. I love what I do. And I'm not going to do stuff I don't want to do. Well, I know a man who was a nonprofit guy. And what he did, he quit being a nonprofit guy for 5 years. And he went out and worked doing things he didn't want to do. And he saved like mad during that 5 years. And then after he worked for 5 years and saved like mad, he went back to what he was doing before, but he had put aside enough money that over the years that he would now be working for very little, that he could build his retirement. Now he still has to invest it properly.
Uh-huh.
But yes, there are answers. The problem is that it is really hard to have that discipline if you don't have that kind of a mindset.
Yeah. And how about the flip side? How about the one that's got lots of money, but it's all in his, and it's not diversified, it's all in his own employer stock? How does what
the
mindset
biggest
do you recommend that person have in order to, they at the time, as you can imagine, don't feel like they're ever gonna lose.
Well, and I thought I heard you mention Enron for a second there.
I did, yeah.
And Enron employees generally were told they should be putting all their money in their 401k into Enron stock. I wonder who that was benefiting.
Right.
So here's the problem. If you don't understand the emotional side of investing, you may never beat it. One of the reasons I'm trying to get this thing on automatic for people That's why I love the target date fund, is because the less you have to think about this, the better off you are. There's a wonderful book entitled Your Money and Your Brain by Jason Zweig. I've probably read it 7 times. And I only do that because it's all about the psychological side of money. And one of the things that we know about ourselves, or the psychologists know about us, is they know that we are overconfident. That's our nature. Now, not everybody is. People who are depressed generally aren't. In fact, people who are depressed, it's in the book, make better investors because they don't believe. There's a book called Learned Optimism by, I think, Gerald Seligman, I believe. He talks about successful salespeople. The reason they're so successful is because they're so optimistic, but they're looking at life through rose-colored glasses. That's why the last person I want trying to help me, because somebody's selling them and then they're turning around with those same rose-colored glasses and a commission at the end of the month selling a product. I'd rather have you learn how to use index funds and make it and automate it. But that overconfidence could lead somebody to believing that US is the only place you have to invest, or my company is the only place I have to invest. When I sold out my investment advisory firm 12 years ago, or in 2012, I knew I wouldn't make as much money, but it was time to pass the baton of risk to other people. That company is continuing. Merriman Wealth Management is, in fact, I think next week I go to our 40th year anniversary, and I can't wait. It's going to be great fun. I'll probably get a new mug, but what I do know is that these psychological aspects, that's the reason most people need an advisor. They can't beat the psychological problems. We had a couple came into our office one day, retired airline pilot. This is back in like 1999, and his wife was with him, and he had retired. He had all of his money in high-tech stocks in 1999, and all of his money, his complete retirement from the airline, he had rolled it over into high-tech stocks in 1999, and he left to use the bathroom, and his wife literally broke down crying. She had never told him she was scared to death because it was his job to take care of the money, and he was being overly optimistic, because not only are people optimistic, but we think linearly. And when we think linearly, we have recency bias. And when we have recency bias, what's been doing well, we think is going to continue to do well. And it doesn't work that way. As people found out after, from 95 to 99, the S&P 500 compounded at 28.5%. And for the next 10 years, it loses 1% a year. And so that being overly optimistic, having recency bias, all of these things can trip us up. And wishing stuff would work does not work. Is very common. Another emotional thing people do, Jim, is the market's been up and it goes down, and things go way up, and then the bear market comes along and they go down, and people just assume that when the market goes up the next time, the stuff that's way down is going to go up. And that's a bad assumption. And most of the things that people believe work are not right. The myths of investing, there are over 200 of them. And the things that work are not offensive. The things that work are defensive. Owning 1,000 stocks is defense against owning one. Low expenses, defense. low turnover, low taxes, defense, having fixed income in the portfolio to match your risk tolerance, defense, putting it on automatic, defense, having an investment advisor, defense. And people think of investing as being something aggressive, offensive. And that's the wrong attitude, because your emotions are going to tend to trick you. That's why people trying to market time, they don't have a shot being a market timer, because you got to know how to take a loss. You got to know how to take 5 losses in a row. Who's going to do that? So read your money and your brain.
Yes. Paul, we're out of time. There's going to be a couple folks that I'm recommending reach out to you by email with with individual questions. For everyone else, I just want to thank you all so much for joining us, and again thank Paul for his terrific advice and recommendations. And please do visit our website, bainbridgecf.org, and look in the news and events section over on the left-hand side for information about the future presentations.
And may I just say one thing? I saw Christine Benz's presentation in Phoenix a few weeks ago, and I said, please just do that presentation for our folks, and they will love it. I guarantee you will enjoy it. It is terrific.
Okay. Thank you so much.
Bye-bye now. And thanks to everybody. It is great fun being able to reach out and share information that makes your financial life better. And I'm going to, in just a second, I am going to introduce Christine Benz. And boy, is she going to do a lot to do that here this evening. But very quickly, I just want to tell people, next week on the 15th, we have another presentation. I will be doing the presentation, and it's basically for first-time investors, although I think anybody will learn from it. I want to make sure that young investors and other first-time investors take all the right steps to get the most out of their investments. And so I'll be talking about my new book, We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. And everybody will be able to get a free copy of the PDF of the book who come and join us. And then the week after that, another, like Christine knows so much, Larry Swedrow knows so much too. And these two people have such a rich background in the investment process, and you will love the information that Larry has to share with us. As a matter of fact, I happen to know some ways that Christine and Larry differ on things, so I'll be putting together what I hear from Christine tonight and Larry then, and we'll have some fun with that. Not going to embarrass anybody. And then a week after that, we're going to have one of the true all-stars in the educational process dealing with financial literacy. I don't know anybody else like Tim Ranzetta. Tim Ranzetta started an organization, Next Generation Personal Finance.org. If you want to go to the website, ngpf.org. And if you're going to come join us, or even if you're not, I hope you'll take the time to go on the internet and take a look at his video, The Most Important Class You Never Had. But he is changing the lives of young people like nobody else that I know, and he's going to come join us. So now let's get down to business, because we got some great information tonight. Christine Benz is somebody who I've known, but really I've followed, because she puts out some of the best information. And one of the reasons that she puts out such great information is because she has at her resource, Morningstar. We talked before we got started. They now have some 6,000 people. She was around 200 or so. So she has been at Morningstar since the early days, which gave her a chance to be involved in many different levels there as an analyst, as an editor. But for, I think, 12 years now, she has been the director of personal finance. She has a weekly podcast, The Long View. She is absolutely committed. In fact, I'm going to post a piece she wrote about her journey to becoming a part of the Morning Star mission. And I think if we have young people who like to hear about success stories of folks who work their way up through the corporation, particularly one of those hard charging, growing, high growth organizations, it really is. It's a touching story. And I am so pleased to be able to introduce you to one of Barron's 100 top women financial experts. And really, I think, oh, by the way, I should mention, there's something I know you're looking for because you ask for it all the time. You want model portfolios. You want to know how to invest depending on how much risk you're willing to take and what funds you might have access to, et cetera. Christine has over 20 model portfolios. Christine Benz, thank you so much for coming to help us this evening.
Well, Paul, thank you so much. It's my pleasure. It's really lovely to be here. I have to say that the Washington State area is one of my favorite places in the world. My husband and I have had many good vacations in that vicinity and would love to be there in person. But in the meantime, I'm happy to join you from my home office in the suburbs of Chicago. And I'm going to be talking tonight about retirement planning, which is an issue that I focus an awful lot on in my work at Morningstar. Before I get started, I just quickly wanted to discuss, discuss sounds more in depth than I'll go. I just wanted to say that Morningstar.com has a lot of great information, much of it free. We do have a paid service on the website that entitles subscribers to read all of the analyst reports about individual stocks and mutual funds and exchange traded funds. But I wanted to mention that many libraries are subscribers to a version of that. So if your public library is a subscriber, you can access that same general set of research for free from your home desktop. So check that out, ask your library, because it's a pretty neat service and you would not need to pay anything directly. You're paying indirectly through your library. So I wanted to mention that, but much of what's on Morningstar.com is free, including my model portfolios, including my articles, and my materials are really educational in nature. That's very much my focus at Morningstar. So I'm going to be talking about retirement blind spots tonight. I'm going to share my screen with you here, and we will get started on my presentation. And I'll just give you a quick overview of what I'll cover today. I'm going to start by talking about why I care so much about talking about retirement planning and specifically the retirement decumulation period. And then I'll get into the 6 blind spots. I'll talk about why these are risk factors for so many retirees, but I'll also talk about how you can address them at the portfolio level as well as at the financial planning level. And then I'll talk about, or we'll tackle some questions toward the end of my presentation. So the reasons why I'm so passionate about this area of demystifying retirement decumulation. Well, at the top of the list is what I call the financial complexity complex, that we have a lot of agents, a lot of people in the financial services industry who, unfortunately, I think have sort of a mission to complexify investment planning and retirement planning. They want to make it seem so complicated that it's they want you to come away with the conclusion that you couldn't possibly tackle this on your own. And I do happen to think that retirement planning is a complicated area where many people could use an advisor's opinion in the context of their plans. But I also think that being empowered, getting knowledgeable about the basics of how to create a successful retirement plan is really incumbent upon each of us. So kind of combating the financial complexity complex is top of the list. I mentioned that retirement planning is, retirement decumulation specifically, is more complicated than accumulating assets for retirement. Really, accumulating assets for retirement, as long as you get started reasonably early, as long as you don't make big mistakes by dabbling in individual stocks, if you use some sort of semi-sane plan, it's not that difficult. But retirement decumulation, figuring out if you have enough, figuring out how to make sure that your portfolio is not unduly affected by inflation, making sure that your portfolio is able to last over a 25 to 30-year time horizon, that gets more complicated. So there's more to discuss in the realm of retirement decumulation. Another reason I like to work on this area is that there are a lot of behavioral issues wrapped up in retirement planning. So a common issue that retirees often run into is that they want to try to subsist on income alone. They want to try to subsist on whatever yield their portfolio produces. Well, as you all know, we've seen a period of dramatically declining yields where that's really difficult today. But that's a common behavioral issue. And there are many other behavioral issues. And frankly, they're just interesting to me as someone who works in this area, trying to help people make smart decisions about their retirement plans. One other reason I like to work on retirement decumulation and educating about it is that people at this life stage, as they get close to retirement, are extremely receptive to getting information about how to do it. I have sometimes been involved in financial education with younger investors, even high school students, where you get sometimes people who are kind of disengaged from the process because they don't have any funds to invest. It's not really relevant to them at their particular life stage. Or retirees, pre-retirees really need to figure this stuff out. So I find that they're incredibly receptive to learning. And finally, on a personal note, I would say that I was a partner to my parents as they embarked on their retirement years. And my dad had been kind of an investment mentor to me as I was starting out in my career. And I was always sort of his investment buddy side by side with him. And my dad experienced cognitive decline later in his life. And I was so glad that I was there with him to be his investment partner and to really manage my parents' finances in their later years before they passed away. I often speak to groups of retirees where perhaps there's not that trusted financial partner. And so part of my mission is just to try to do education, try to make sure that the people I'm talking to are as empowered as they possibly can be. And if they do need to go out and find some sort of external help to help them through their financial plan in their retirement years, that I think they can be savvy about selecting their financial advisors. So those are just some of the reasons why I like to work in this specific area of retirement decumulation. So getting into the blind spots of the presentation, the first blind spot relates to what we call retirement date risk. And what that means is that the date on which we retire, and some of you may already be retired, but our specific retirement date isn't always 100% within our controls. It may be, but oftentimes there's some slippage. And what you can see on this slide is people who were surveyed prior to their retirement were asked when they expected to retire. And then they were later surveyed about when they actually did retire. And what you can see is that there's a disconnect. You can see that many more people expected to delay retirement than actually did delay retirement. So about 60% of people between the ages of 50 and 64 retired. Many fewer thought they would be retiring during that early window. So the takeaway here is that we oftentimes don't have control over our specific retirement date. And there are lots of reasons for why that happens. There may be reasons why people are forced out of their jobs earlier than they might have anticipated. This pandemic has been just such an environment where we've seen older adults being displaced from the workforce more than the general workforce, more than the general population. That stands in contrast to the last financial crisis, where we saw older adults being able to hang on to their jobs better than younger adults. The pandemic has forced more older adults out of work earlier than they might have expected. So unexpected job loss. We know ageism is a thing in our culture. In some cases, people might have jobs that entail some level of physical exertion that they're unable to do in their later years. There may simply be health issues, either the worker's own health issues, spouses' health issues, parental health issues. I was someone who was involved in helping care for my parents in their later years, not directly, but helping oversee caregivers. And I know personally that that can take a toll. And thankfully, I work for an employer that was incredibly generous in terms of letting me balance my family responsibilities with my work responsibilities, but we know that many other employers are not quite as generous. So a lot of these issues can conspire against people continuing to work as long as they might hope to. So I'm always a little troubled when I'm out talking to older adults who tell me that their plan is to continue working as late as like age 75 or something like that. We know that forces beyond our control can sometimes cause us to need to leave the workforce earlier than we might like. So why is this a problem from a financial standpoint? Well, it probably seems pretty obvious that if you are forced to retire earlier than you anticipated, you can't continue to make contributions to your retirement plans. You may have fewer years that your portfolio can continue to compound and enjoy returns prior to needing to draw upon it. And another thing that I would point out is that much of the research we have about what is a sustainable withdrawal rate for retirement relates to like a 25 or 30 year drawdown period. Anytime you're looking at longer periods than sort of the standard 25 to 30 year period, well, you need to be that much more conservative about withdrawal rates. So some of you may know people in the financial independence or retire early movement, the FIRE movement. I sometimes hear those folks talk about like a 4% withdrawal rule for their retirements. And that makes me really nervous because we really just don't have retirement withdrawal strategies stress tested over such a long period. And finally, if someone is forced to retire earlier than they expected, they may not be able to do other beneficial strategies like delaying Social Security, which in turn can force them to take more from their portfolios early on in their retirement. And that may, in fact, impair their portfolio's long-term sustainability. So how do we mitigate this risk, this retirement date risk, if we're still working? Well, an obvious one is to continue to nurture our human capital throughout our careers, even into our 50s, even into our 60s, making sure that we're staying current on technology. And I think certainly the past year has given us all a crash course in getting up to speed on technology, but just making sure that we're continuing to burnish our human capital, attending seminars, attending continuing education, whether it's required or not. I think it's also worthwhile for all of us as we move into our 50s and 60s to think about what our backup career might be if in case we were dislodged from our current career. So to think about your backup plan and then maybe your backup plan to the backup plan. It's just worth thinking through what you would do if you were unable to continue in your current occupation. And I think what people sometimes don't realize is that even if you aren't able to stick with a career that's as remunerative as the one that you had during your main earning years, even if you can continue to pay the bills with some other career and forestall portfolio withdrawals, kind of those hybrid strategies can be incredibly impactful as well. And there's been some great research done in this area of what are called encore careers, where perhaps you're pursuing something that isn't as high earning as your main career, but perhaps it's more gratifying. If that can keep you in the workforce, if that can keep you earning a paycheck that in turn can help you pay your bills, those hybrid strategies can be great strategies as well. Saving more while you're working, obviously, to help mitigate the impact of early retirement is kind of an obvious conclusion to come away with. And finally, giving a little bit of thought to insurance planning, specifically healthcare planning. So for all of us in our 50s and 60s, I think it's worth thinking through, if your healthcare is coming through your employer, what is your backup plan in case you were unable to be under that employer's healthcare plan? So perhaps it's it's COBRA, perhaps it's the ACA, but just thinking through and perhaps even taking the next step of pricing what that healthcare coverage might look like for you is a good step, just so that you're prepared for healthcare coverage prior to Medicare coverage. So the next blind spot that I wanted to cover is what's called sequencing risk. And I'll explain what we're looking at on this slide. This is two different retirement start dates. One would be the mother of all bad start dates for retirement. This would be in the early 70s, early 1970s period. If you embarked upon retirement then, retirement researchers really agree that that is the worst period into which you might have retired, because you had a bear market in equities, and some of you may have been investing during that period of the early 70s. You had a runaway inflation after that. You had a lot of risk factors for retirees. So what we're looking at is, if someone embarked on retirement during that terrible period and had a portfolio that was 50% stocks and 50% bonds, during that period, a $500,000 portfolio, if they were spending 5% of that portfolio, they would have burned through that portfolio in a 20-year period. And those of us who focus on retirement research see that as a failure, because you want your retirement portfolio to last longer than that. Unless you wait until age 75 or something to retire, you want to plan for more like a 25 or 30-year retirement, potentially even longer. So such a withdrawal strategy, that 5% withdrawal rate, that 50-50 portfolio, would have been out of funds in 20 years. If we reversed that sequence of returns, so if the great returns of the early 90s occurred at the beginning of the period, which is what we're looking at on the right-hand side of the screen, you can see that it's an entirely different situation. So same 50-50 portfolio, same 5% withdrawal rate, same initial $500,000. Well, not only did that person support his or her lifestyle in retirement, but also nicely grew the portfolio. And what this slide is meant to illustrate is that it's really luck of the draw. We don't quite know the specific environment that we'll retire into. And that is why we want to think about planning for the worst case scenario. So hoping for the best and planning for the worst. And my next slide illustrates how the right withdrawal rate really does depend on the specific time period into which you retire. So I've circled on the slide that really difficult period that we were looking at, that it really didn't matter what asset allocation, what stock bond mix you came into retirement with, you would have had a troubling retirement period. And that's where when Bill Bengen, the financial planner who came up with the 4% guideline for withdrawal rates, he really focused on that specific area. And his conclusion was, even if you happen to retire into the worst market environment that we've seen so far in market history, if you took 4% of your portfolio initially, and then inflation adjusted that dollar amount each year thereafter, so you're kind of looking for a stable, real stream of income in retirement, what Bill Bengen's research showed is that that strategy gave you a good shot at not outliving your assets. So that's why oftentimes you still hear the 4% guideline referenced in the context of withdrawal rate strategies, that perhaps that's a safe withdrawal rate strategy, even if the next 20 or 30 years aren't so great, or that maybe the next 10 years. So I've kind of mentioned why sequencing risk, why the sequence of returns that we experience in our retirement matters so much. That ideally you would be accumulating assets when they're cheap and selling them off throughout your retirement. So that's, if you're spending from your portfolio, you're essentially selling off pieces of your portfolio. That's the ideal sequence of return that you would experience prior to retirement. You'd buy stuff cheaply and then you'd sell it when it's more expensively. A negative sequence of return is when you kind of experience the opposite, where you are enjoying really great returns in your accumulation years, then you're having to sell them off potentially when things are headed down. So encountering a negative return sequence can affect one or two things. Either the retiree really has to reduce his or her standard of living when he or she encounters that poor market environment, or you do nothing, you just continue spending away blithely, as we showed on that slide of the person taking 5% out of their portfolio, and then you run out prematurely. So what do we do to mitigate this sequence of return risk, which, as I said, is something that's kind of out of our control? Well, I'm going to talk about that, but first I want to just discuss the current market environment a little bit. This is a metric that's called Shiller PE, which is developed by a Yale economist named Robert Shiller. And it is a cyclically adjusted price earnings ratio. It's meant to be a measure of whether the market is cheap or expensive based on the cyclical factors, based on various market environments. And so one thing, if we look at Shiller PE, we see that it's been flashing a little bit of a warning signal for a while now, where stocks have looked expensive based on this measure. A lot of people who look at this think that maybe it's a little bit overly cautionary, because we have had great returns for the past couple of years. And you can see that Shiller PE has been elevated relative to where it's been in history for the past several years, and yet the market has continued to go up. This is a view of asset class return forecasts from our team at Morningstar Investment Management. You can see that they too are predicting fairly meager returns from the US equity market over the next decade. And usually when you hear predictions, I would say run the other way, especially if they're short-term predictions. But all of us, when we're creating a financial plan, we need to have some sort of baseline assumptions about how much the market is going to help us out. So our Morningstar Investment Management team and a lot of other firms do this sort of work as well. They come up with these forward-looking forecasts of what they expect different asset classes to return. So you can see those strongly positive sort of aqua bars there are their expectations for international developed and emerging markets stocks. They're expecting better returns there, but pretty muted returns from the US equity market. And they arrive at these forecasts by looking at starting current dividend yields, looking at their expectation of earnings growth, what we expect to see from earnings growth in these various markets, and also looking at their expectation of valuation expansion or contraction over the next decade. So pretty muted returns from US stocks, pretty muted returns from bonds as well over the next decade. And the green bars, I should just say, that's the change from the previous quarter. So this is measuring the change between the end in the fourth quarter of 2020. So the fourth quarter of 2020, if those of you who are investing through that period, you know it was a great market environment, which is why they ratcheted down their return expectations during that period. We're not alone in terms of being somewhat pessimistic about what the US market is likely to return over the next decade. Research Affiliates, which is another firm that does these sorts of forecasts, and they have a neat interactive tool that you can play around with. They too are sort of in that very low return expectation camp. BlackRock is a little bit more positive. I would say Vanguard is somewhere in the middle. But nonetheless, these return expectations are generally below the 8 to 10% equity return that the market has delivered historically. And that's because we have had a pretty good run in the equity market already. If you've been investing in stocks through the past decade, you've enjoyed really nice growth. These numbers suggest that you probably want to rein in your expectations a little bit for the next decade at least. Beyond that, it may be off to the races again. But near term, I think you probably would want to think about having fairly muted return expectations for US stocks, certainly maybe a little better return expectations for non-US stocks, in part because valuations are relatively better. So how do we mitigate this sequence of return risk? If we're getting ready to retire and we want to make sure that we're not walking headlong into a really difficult market environment, well, there are a couple of ways to think about it. One would be to plan to reduce your portfolio withdrawals if you happen to encounter a really difficult market environment at the outset of your retirement. Make sure that you can potentially live on less if you need to, because all of the work that has been done on withdrawal strategies over the past couple of decades very much points to the power of, if you can take less, if the market serves up very lousy results in your early years of retirement, if you can withdraw less in those years, if you can live on less, that really improves your portfolio's sustainability. And the simple reason is the less you can spend when your portfolio is down, that leaves more of your portfolio in place to rebound and recover when the market eventually does. So there are lots of different variations on these strategies that incorporate market returns, incorporate portfolio returns. I've cited a couple. Vanguard has done some research in this realm. A financial planner, Jonathan Guyton, has done a fair amount of research in this realm. If you're interested, you can check out their white papers on this topic. And then another thing to think about, so you're thinking about how much you're withdrawing from your portfolio if it does encounter a weak market environment early on. So you're thinking about your withdrawal rate, but then you're also thinking about the setup of your portfolio. And this is something that I've focused a lot on in my work on Morningstar.com, illustrating what I think sane portfolios are for retirement. So we'll just take a quick look. I've latched onto this, what's often called the bucket approach to retirement decumulation, just because I think it's a really intuitive way to approach a structure for a retirement portfolio that I think nicely addresses the idea of encountering a weak market environment early on. So the basic idea is that you are, with bucket 1 and bucket 2, you're setting aside 10 years worth of portfolio withdrawals in safer assets. So in bucket 1, we've got maybe 1 to 2 years worth of portfolio withdrawals in just cash investments. We're settling for very low returns, potentially even slightly negative returns once inflation is factored in. We're settling for really low returns, but basically we're just battening down the hatches with that portion of our portfolio. We don't want to risk anything because we don't want to jeopardize our living, our lifestyle in those early years of retirement. And then with bucket 2, we're stepping out a little bit on the risk spectrum. So we're still focusing on safer investments, but we're including some short-term bonds, some intermediate-term bonds, a little bit of inflation protection. So I would include some Treasury inflation protected securities there. But essentially, I'm building a bulwark of 10 years worth of portfolio withdrawals in safer assets, so that if Armageddon occurs in the stock market at the outset of my retirement, I would have 10 years worth of portfolio withdrawals to spend through before I would ever need to touch my stock portfolio. So how did I arrive at 10 years worth of portfolio withdrawals? Well, one thing I often think about is, what is the probability of having a negative return from stocks? Well, if you have a 10-year time horizon, stocks are actually extraordinarily reliable. When we look at rolling periods throughout market history, if your holding period is at least 10 years, you've been positive like 90% of the time. But once you begin to shrink that time horizon, if you get into 5 years, or God forbid, even fewer than that, well, stocks are just way too unreliable. The probability of having a negative return over those shorter time horizons is just too great. And so that's why I have latched onto this idea of 10 years. But I think if your portfolio plan is tighter, you could think about having more like 7 years worth of portfolio withdrawals. But the basic idea is that you are building yourself a bulwark that you could spend through, which is not to say you would always spend through your portfolio in exactly this fashion, but you're setting yourself up to, in case your early retirement years feature a bad equity market, you've given yourself some safe assets at the front end. There are environments like right now, if you've been retired for a while, I would say leave your safer assets in place, don't spend through them, spend your appreciated equity assets. But if you are embarking on retirement and you happen to encounter a weak market, that's what this bucket structure is there for. And so this is just a sample portfolio that is segmented by these 3 buckets. This is an exchange traded fund portfolio, so it is focused on very low cost funds. And you wouldn't need to follow this specific framework. My guess is that if you have a well-diversified portfolio that includes some stocks, both US and international, and includes some bonds and maybe a little bit of cash, you're probably already pretty close to having some version of a bucket strategy. But this is really just here for illustration purposes. So we're assuming in this case, a couple with $1.5 million portfolio with a desire to spend $60,000 from that portfolio in year 1 of retirement. So they're using kind of a 4% guideline for their spending. So they're spending $60,000, just 4% of that 1.5 million. And then you can see I've just kind of structured the buckets along the lines of what we've already been looking at. This is a radically simpler version of this. I'm always looking for ways to simplify the number of moving parts in retiree portfolios. While the previous slide features some assets that I do like to include in retiree portfolios, like short-term bonds, like Treasury and inflation protected securities, nonetheless, this is a radically simplified version that I think could do, I would say, a good 90% of what the more complicated portfolio does with fewer moving parts and very low expenses. So on to the next risk factor or blind spot. This is simply the very low yield environment that we find ourselves in today. This is probably something that many of you feel very acutely. If you have tried to wring any sort of positive return out of your safe assets, you know this very well, that we have had to all settle for less and less and less on those interest bearing accounts in the name of safety over the past several decades. And really, truly, this has been going on since the 80s, where we've seen yields decline and decline and decline. And so that creates challenges for retirement planning. I mentioned at the outset that if you're like my father-in-law, where you very much were interested in subsisting on yield alone and you didn't want to touch your principal, well, this has been challenging. You've had to take more risk in the name of generating a livable income stream from your portfolio. So I mentioned that many retirees do like the idea of living off yield alone, but when we do find ourselves in the kind of very low yield environment like we have today, that forces retirees to either subsist on less income, which of course most of us do not want to do that, or to take more risk in our investment portfolio in the interest of generating the yield that we need. Bond yields have historically been a pretty good predictor of what bond returns might be over the next decade, and we're at a very low ebb today. The 10-year Treasury yield is 1.6%. If you want to earn a significantly higher return than that, you need to take more risk in your portfolio. And this is just a slide that illustrates that risk-reward trade-off that comes along with venturing into higher yielding securities, especially within fixed income. There's a very neat relationship between higher yields and risk taking. In fact, we have a lot of fancy tools on morningstar.com for drilling into what is the risk in a bond portfolio. So you can see lots of data on duration, which is a measure of interest rate sensitivity, and a lot of fine detail on credit quality. I would say that if you're looking for a sense of whether a bond product is risky or not, just look at its yield. It's a very good predictor of whether a bond product is going to entail risk or not. So what we can see today is that yields, if you wanted to try to wring a 4% yield from a portfolio, from a fixed income portfolio today, you're taking a lot of risk in that portfolio. And I've just provided on this slide, not saying that we are getting back to a 2008 environment anytime soon, but just for a little bit of context of what these investments returned during the last financial crisis. You can see that while their losses weren't as bad as the equity market, I think the S&P 500 lost 37% in 2008. You can see that they were directionally similar, that with riskier fixed income products, you do get more sympathy for what's going on in the economy, and also more sympathy for what's going on in the equity market. So how do we deal with the fact that yields are so low today and really are not conducive to subsisting on income during retirement, especially if we're just getting ready to retire? Well, how do we deal with this? And I would say that there are a couple of ways to think about it. One is to use some sort of a total return approach to decumulation. I would argue that it's all but a must for most retirees today, where you are either using sort of a pure total return strategy, where perhaps even you're reinvesting your income distributions back into the portfolio, and then periodically taking a look at that portfolio and seeing, what should I sell to meet my living expenses? If I were to talk to my colleagues in Morningstar Investment Management who do asset allocation and financial planning all day, every day, they would say that's how best to decumulate a portfolio, because it gives you a chance to optimize your portfolio on an ongoing basis, to take risk out of your portfolio while simultaneously supplying your living expenses. So if you can, at the end of each year, take a step back and look at the most appreciated portions of your portfolio, well, those are oftentimes the riskiest portions of your portfolio that you might want to be trimming back anyway. Some retirees might say, well, I'm not really comfortable with that pure total return strategy. I like the idea of some kind of income from my portfolio. In that case, I think you can reasonably use kind of a hybrid strategy where you're not going out of your way to generate income from your portfolio, but you're simply building a sensible total return portfolio, which today will get you maybe a 2%, maybe slightly sub 2% yield. And then you are using rebalancing to make up the difference. I think that hybrid strategy can make a lot of sense as well, where you got kind of a baseline of your living expenses coming in through income and dividend distributions that are organically occurring from your portfolio. And then you're using rebalancing to make up the difference. I think that strategy can work perfectly well as well. So this is just an example of how this would work in practice. So let's assume that I have a 60% S&P 500, so 60% stock, 40% bond portfolio in 2017. Well, the organic yield from that portfolio was about $20,000. If my income needs were $40,000, if my cash flow needs were $40,000, well, then I would be able to turn to my appreciated equity assets to supply the additional living expenses. So 2017 was an extraordinarily strong year for the market. I would have had my additional $18,500 in living expenses from rebalancing, and then I'd be able to reinvest back into the portfolio, or perhaps set up my cash flows for the next couple of years by pulling money from the appreciated equity assets. Some years are not as good as 2017, even though 2017 was good, 2019 was good, 2020 was good, 2018 was not so good. And that's one reason why I like that idea of having cash reserves set aside, or at least having some money in safer assets that you could pull from in those weak years. So bond yields were pretty low in 2018, and the equity market wasn't so great. So you would be able to potentially pull from cash assets to leave your fixed income assets, and certainly leave your equity assets alone in a year like that. I want to touch on another risk factor for retirement. This is something I've been thinking a lot about recently, which is inflation. And we have had a lot of drumbeating about the prospect of higher inflation. I would say there was also a similar set of concerns coming out of the last financial crisis, a lot of hand-wringing over the amount of government stimulus, that this was sure to lead to inflation. And lo and behold, we went on to have a decade's worth of very benign inflation from 2010 through 2020. Really, we had a period of extremely low inflation. We're hearing concerns about inflation again. I personally am experiencing food inflation. I don't know about all of you at the grocery store. Definitely seeing that one come on strong. And certainly people who are in the housing market, who are purchasing homes, we're all seeing a lot of home price inflation going on. So it's a concern, I think, and one that we need to be mindful of when we think of our retirement plans. We want to make sure that we are troubleshooting the prospect of higher inflation as part of our plans. So this slide illustrates what I think is a really interesting look at how the Consumer Price Index is calculated. And if you've ever looked at the Bureau of Labor Statistics website, you can see that they provide a ton of useful data, and they provide a decomposition of how they arrive at that Consumer Price Index. And the main Consumer Price Index you hear cited is the CPI-U, it's called, the Consumer Price Index for all urban consumers. And it's meant to measure how consumers at large are spending their money. So what are they spending their money on? And you can see that CPI-U includes allocations to various goods and services that are meant to reflect what the population at large is doing with their money. CPI-E is another measure of inflation that is meant to measure how older adults are spending their money. And I think CPI-E can be really useful when thinking about, well, how might my spending be different in retirement than it was perhaps during my working years, during my younger years? How might it vary a little bit? So you can see CPI-E, I've included here, just how it varies from CPI-U in terms of the expenditures. So one that might jump right out at you is the very high number assigned to housing. And you might say, well, I own my own home, so inflation probably is not going to be that big a deal for me. And it may, in fact, not be a particularly big deal for your home. You won't have rent, obviously, but you may continue to experience inflation in other home-related items. So your utilities would experience inflation. If you're paying people to do home maintenance for you, if you're paying people to cut your grass or do other work around your house, you may experience inflation there. So even if you are a homeowner, you chances are will experience some inflation, even though your mortgage is paid off. Another category I would call your attention to on this slide is the healthcare line. And you'll see that for medical expenses, older adults, not surprisingly, tend to spend more on medical care, on healthcare than the general population. As it turns out, over this particular period that I've captured here, which is just the 1 year period through February, you can see that healthcare inflation is actually pretty much under control. In fact, it's been in sort of a good pattern since the Affordable Care Act passed, where we've seen some tamping down of healthcare inflation, which is a really great trend for retirees. But over longer periods, we have seen a negative trend where, as many of you know, healthcare inflation has been running much higher than the general inflation rate. I think it may, in fact, get back to a higher level. Whether we're in a permanent lull for healthcare inflation, I think is an open question. I think retirees would be wise to plan for higher healthcare expenditures, which I'll touch on in a sec, as well as potentially higher inflation in retirement due to healthcare inflating. So how do we mitigate? Well, first, I'll touch on why this matters, why we need to concern ourselves with this. One reason is that while we're working, while we're getting paychecks, we're usually getting some sort of cost of living adjustment in our paychecks. When we are retired, we may still be getting a cost of living adjustment in our Social Security paycheck, where you get a modest nudge up to account for inflation. If we're lucky enough to have an inflation adjusted pension, all the better, but that's a dwindling group of us who will be retiring with an inflation adjusted pension. So the reason why we need to care about inflation for retirement is the portion of our portfolios that we're withdrawing to pay for stuff is not automatically adjusted for inflation. So those withdrawals that we were looking at on earlier slides, where we were talking about withdrawal rates and we were looking at portfolio structures, those amounts that we're pulling from our portfolios, those aren't inflation adjusted. And to the extent that we have safe assets in our portfolio, to the extent that we have cash, to the extent that we have nominal bonds, whether treasury bonds or corporate bonds that aren't inflation adjusted, well, that purchasing power from whatever interest we're able to earn on that environment, on those investments, is eaten away by inflation. So that's why when we come into retirement, we have more conservative assets in our portfolio, but that's why we need to be really concerned about inflation. So how do we mitigate this risk? Well, I think you think about addressing it from a couple of standpoints. One is at the portfolio level. So making sure that you have inflation hedges in your portfolio. So you are protecting your purchasing power to the extent that you have safer assets, that you're earmarking a portion of them for, I like the idea of including like 20% of the portfolio, of the bond portfolio, in what are called treasury inflation protected securities, which give your principal value a little bit of a nudge up to keep pace with inflation. So you think about inflation hedges like those. You might also think about having a healthy component of stocks, because even though stocks are by no means a hedge against inflation, when we look at the categories that have historically been able to out earn inflation, to have a higher rate of return than inflation, stocks have historically done that. So yes, they're volatile, but they have historically had a better return than the inflation rate. So we think about adding those categories first and foremost, and then we might think about adding a few other categories around the margins. One I would mention would be bank loan investments, sometimes called floating rate investments. This is a really interesting sort of junky bond category, so I'd want to relegate it to kind of the margins of my portfolio. But the nice thing about this category is that when yields go up, you get a little bit of an adjustment in your interest rate. So it's a category to consider, because when we look at categories that have historically had some ability to keep pace with inflation, the bank loan investments do that. High yield bonds, again, kind of a niche category that I would really limit my exposure to, but historically they have shown pretty well as a hedge against inflation. A lot of times people like to own real estate as a component of their retirement portfolios. I know Paul Merriman is a big believer in owning some real estate securities as a portion of a portfolio. One of the features of real estate investments, real estate investment trusts, is that historically the owners of REITs, the landlords that own these properties, are able to push through increases in rents that you as an owner of a REIT are able to benefit from. So that is one reason why REITs are often considered a decent hedge against inflation. So that's kind of at the portfolio level. At the plan level, I think you can think about mitigating inflation risk in a couple of different ways. Delaying Social Security is one, because you pick up an enhanced return on your benefit, and that delay also leads to a higher inflation adjusted benefit. And then also, if you're looking at other products as part of your plan, whether annuities or long-term care insurance, adding some sort of inflation protection may make sense there. It may be overly costly, it may not be worth it, but it may be worth investigating. This slide is, I won't delve into the specifics of what we're looking at here, but my colleague David Blanchett at Morningstar has spent a lot of time researching how retirement spending changes throughout our retirement years. And if we had a live audience, I would ask you to kind of walk me through what we're looking at here, because chances are you've had some experience with this by knowing retirees in your life, or by being a retiree yourself. You know that oftentimes the early years of retirement, the sort of say mid 60s to age 70 sort of period, those are the high spending fun years of retirement, where sometimes there's pent up demand. Certainly coming out of the pandemic, there will be pent up demand to do travel and dining out and all the things that we all look forward to in retirement. Those are the higher spending sort of discretionary years. Then spending trails off later on in retirement before trending back up in the very late years of retirement. And many of you know well why those expenses trend up later on in retirement. That's typically big healthcare outlays later in life, oftentimes unfunded long-term care expenses. So for people who don't have long-term care and insurance, they may need to fund some of those costs out of pocket. So David has written extensively about this topic, about how it's not just a flat line of spending throughout our retirement trajectories. It's oftentimes kind of this smile pattern that he has detected in his research. And so I want to delve into that healthcare cost risk. Fidelity annually puts out these estimates of what the typical 65-year-old couple will spend on out-of-pocket healthcare costs in retirement. The most recent tally came in just around $300,000. And so this includes Medicare premiums. It includes supplemental insurance policies, which many of you, I'm sure, know can be one of the largest budget items for many retiree households. It includes pharmaceutical costs that are not covered by Medicare. So when we tally all those up, Fidelity has come up with this $300,000 lifetime outlay. Importantly, Fidelity's estimate does not include long-term care costs. So those costs, as many of you know, can really stack up as well. I think it's always important to note, though, I think that $300,000 number is absolutely terrifying. But the fact is, for those of us who are employed and those healthcare premiums are just getting deducted from our paychecks, it's kind of invisible, but really we've been paying, in many cases, quite sizable amounts all along. We just really don't feel it because it comes out of our paycheck before we even see it. So they're not brand new expenses. The baseline premium expenses, they've really been with us in some fashion all along. So how do we mitigate this risk? Well, I think it's worth thinking about your own health care needs. Vanguard has done some further research with Mercer on this topic. And what Vanguard found is just a huge amount of variability in healthcare outlays based on geography. Certainly those of us who live in higher cost geographies can expect to pay more for care. Based on health, our overall health conditions tend to be quite predictive. Coming into retirement, if you've had very few healthcare outlays, you may be lucky and that may stay with you. So the state of our health coming into retirement tends to be pretty predictive about how much we'll spend. And I think it's also important, if you are an early retiree, to be factoring in and pricing in your pre-Medicare healthcare outlays, what those might look like, and how those might drag on your plan's expenses in the early years of retirement before you're Medicare eligible. I think it's also just worth looking at your insurance costs prior to retirement. Obviously, some of you, if you're already retired, you're already experiencing these costs. And then I just wanted to make a shout out for those of you who are still in the accumulation years, and maybe you're many or several years away from retirement. There are some tax advantaged ways to save specifically for retirement healthcare costs or pre-retirement healthcare costs. And I would just give a shout out to using health savings accounts in this context. Anyone who does any sort of tax planning is usually pretty enthusiastic about health savings accounts. The tax features are unparalleled in the tax code. So if you're someone who is covered by what's called a high deductible healthcare plan, a qualifying high deductible healthcare plan, you're eligible to contribute to what's called a health savings account. And there are contribution limits annually for HSAs, and for 2021, it's in the neighborhood of like $7,000 if you're covered by a family high deductible plan. But the benefits are that you're able to make pre-tax contributions, you're able to enjoy tax-free compounding as long as the money stays inside the HSA. And then as long as you pull the money out for qualifying healthcare expenses, your withdrawals are also tax-free. So it's triple tax advantaged, in contrast with, say, an IRA, where you're either making after-tax contributions through a Roth and then enjoying tax-free withdrawals on the way out, or if you're doing traditional IRA contributions, you are getting the tax break on the way in and then paying taxes on the way out. The HSA is tax advantaged at every step of the way. So it's a really nice vehicle to consider. And I sometimes get the question about whether you can oversave in an HSA. I would say not really, because worst case scenario, and you don't use any money in your HSA prior to retirement, and you have more in your HSA than you actually need for healthcare expenses. Well, worst case scenario, those non-healthcare related expenses in retirement, once you're past age 65, are treated just like traditional IRA withdrawals. So they're taxed at your ordinary income tax rate, but you won't have any penalties on those withdrawals. So I'm an evangelist for HSAs. If you have one, think about using it because the tax benefits are pretty hard to beat. I want to touch just quickly, and I know that we are coming up on time here, and I want to take some questions, but I want to touch quickly on long-term care risk. This is a topic near and dear to my heart. My parents had long-term care costs late in life. I mentioned that my dad had dementia, and it was a big outlay. And thankfully, my parents had been good savers. They had more than enough to get them through that period. But as the person who was writing the checks out of my parents' accounts for them, it was painful to see the outlays for long-term care. This type of care, contrary to popular confusion, is not covered by Medicare. Some level of care may be covered by Medicare if you have a qualifying hospital stay preceding needing rehab care, but mostly this care is not covered by our healthcare system, not covered by Medicare currently. So it's incumbent upon all of us as we're thinking about our retirement plans to make a plan for long-term care. And for a big segment of our population, government provided long-term care will be the answer. Medicaid is the biggest payer of long-term care in the US. So certainly for people who do not have large portfolios, that will be their long-term care plan. But for those of you who have more sizable portfolios, I think you either want to think about insuring against long-term care risk, or at least if you are planning to self-fund long-term care, at least making sure that you are being thoughtful about how much you might need for long-term care, and then also segregating that fund from your spendable assets. So sometimes I think about having like a fourth bucket. We talked about those three buckets, which would be sort of your spendable assets, but maybe a fourth bucket makes sense in this context where you have set aside money to cover any long-term care costs should you incur them, or any maybe extra longevity expenses if you turn out to be a person who lives to 110 or something like that. And then, best case scenario, and you leave money behind, then that's money that's there for your heirs. The costs for long-term care vary dramatically based on geography. If you are living in a large urban center, you will pay more for long-term care. This could be a whole separate topic unto itself. It's a crucial topic. We have had certainly devastating effects from this pandemic for people in institutionalized long-term care. I think a lot of folks are really rethinking where they want to receive long-term care. My mom and dad had care in their home, which was very much their preference. And I think it's a preference for many of us for obvious reasons. One thing I would say is that if that is your plan, just make sure that you have a younger loved one in your life who can keep that whole thing up and running for you, because it really does require a lot of commitment on the part of your children or grandchildren or other younger loved ones in your life to make that thing work for you. So just quickly cycling through the opportunities or the possibilities for covering long-term care, purchasing a policy, purchasing a pure long-term care policy may be an option. We've seen premiums really go through the roof, though, for some consumers who thought they were doing all the right things by purchasing long-term care policies. They've gotten hit with these premium increases. Some insurers have just gotten out of the business altogether, which has not been great for consumers. Increasingly, we've seen some of these hybrid long-term care policies come on strong. And hybrid policies are policies that blend together, typically a life insurance policy with a long-term care rider bolted onto it. So there's a nice level of optionality in that, so that if you end up needing long-term care, it reduces your death benefit that you would leave behind. If you do not need the long-term care, the full death benefit would pass to your heirs. There are also annuity long-term care hybrids where if you need long-term care, you would be able to use it and it would reduce the amount of your payout from the annuity accordingly. So there are a lot of different variations. These products are more complicated. I would say if you're interested in a product like this, get help from a trusted, disinterested observer who's not involved in selling these products. So sit down with a CFP who does not earn any sort of commission from these products. Get a disinterested observer to help you navigate because they can be super complicated. We mentioned the other options of self-funding or using government provided resources. I want to just touch real briefly on longevity risk. It's often funny to me that this is even a risk because this is in so many ways a good news story that we're all living longer and we're working fewer years, but it creates challenges from a portfolio standpoint. Just a quick few stats about longevity risk. If you're a higher income person, and chances are if you're someone who's attuned to investing, probably are a higher income person, you have, you're much more likely to live longer than the general population, unfortunately. Longevity is not equally distributed in our country and correlates very neatly with income, unfortunately. So if you are a higher income person, you need to be thinking about longevity risk. And certainly you also want to think about your own health conditions and your own family history of longevity when deciding how much care you want to put into protecting your portfolio against longevity risk. But longevity risk is a challenge for higher income folks, especially because more and more of us will be coming into retirement with just one source of income that is a lifetime source of income. So for me and many of my baby boomer and Gen X counterparts, we will be coming into retirement with just Social Security as our lifetime income source. We will not have pensions, and it's a dwindling share of the population that will be able to rely on pensions. So how do we mitigate this? Well, we are thoughtful and conservative about withdrawal rates. So if we think we'll live 25 or 30 years or even longer in retirement, that means that we need to be taking less from our portfolio. It also means that, if we are using the required minimum distribution tables to withdraw from our IRAs, as we need to do once we hit age 72, that potentially we're reinvesting a portion of our RMDs back into our portfolio. And then I think this also really argues for holding a healthy component of our portfolios in stocks, because we can't afford to have most of our portfolio in very safe, very low returning assets. We absolutely need the growth potential that comes along with stocks. I am going to skip this because I do want to tackle some of your questions. This is just some thoughts on how to mitigate longevity risk at the plan level. A few of these things you've certainly heard elsewhere, especially the exhortation to delay Social Security if you possibly can. I know a lot of people don't love that idea, but if you are concerned about longevity risk, it can be incredibly impactful because it enlarges your eventual benefit and it enlarges it for life. And it's also really important to think about if you're part of a couple, that you're super thoughtful about Social Security planning, especially on behalf of the younger spouse, because the larger benefit will be the one that will persist with the younger spouse throughout his or her lifetime. So I'm going to leave it there. I've got my email address here. I can't take anyone's personal question. I can't give any financial planning advice to any of you personally, but certainly feel free if you would like a copy of the slides, or if I can help answer any more general questions, I'm happy to do that. And I think I talked for so long, but I think we do have a few minutes to take some of your questions here as well. So I'm happy to tackle those.
Yeah,
Fantastic.
thank you so much, Christine. I really appreciate that. Sorry to cut you off there for a second, Paul.
No.
Just jumping into some of the questions that we've received. One, which I think is an important question. So, how do the bucket funds work for smaller retirement funds? So, say $300,000 to $500,000, or in that strategy, are there other suggestions that you would recommend? And then following on that, if you use the bucket strategy for withdrawals, won't you have to rebalance after multiple bad equity market years? Otherwise, after withdrawals from just bond funds, your asset allocations would be in all equity and thus risky.
Yeah, such a good set of questions. So I'll tackle the first question about size. So in some of my illustrations, I included some pretty large amounts. At the baseline bucket portfolio that I showed you was $1.5 million. But the nice thing about it is that it's completely scalable. So if your portfolio is $500,000, you would just scale down the position sizes accordingly. You'd keep the proportions the same, but the position sizes would scale accordingly. And I think it's also one reason I like the strategy is that it's also very much scalable based on what your portfolio withdrawals are. So say you're lucky enough to be a retired college professor and you're just pulling 2% from your portfolio per year or in the first year of retirement, and you plan to do that for another decade. Well, accordingly, your investments in safe assets would be really quite low, right? You would have some safer assets because you're spending something from the portfolio. So I like that it's scalable up and down based on what your spending rate is. Then I wanted to tackle the second part of your question about the rebalancing, which is super important. That when I show the slide of what the bucket portfolio looks like, it seems so intuitive. You just think, well, I just spend through the buckets, but you're absolutely right that it would potentially require some rebalancing. But the key thing to note is that it's the bad market environment occurring early in your retirement that's so problematic. For those of you who are later in retirement, where perhaps you have been retired for, I think people are requesting the presentation in my email is chiming, sorry about that. If you are someone who's later in retirement, you've really made it through the danger zone for sequencing risk. If a bad market environment occurs when you're 85, that's not such a big deal for you. You don't have as great a need to have safer assets in your portfolio. But some rebalancing on an ongoing basis does make sense. And I've written extensively about this topic on Morningstar.com. I've also written, and you could probably find it by typing in bucket maintenance in the search engine. And I've also written extensively about tax planning with this bucket strategy because it's, most of us are bringing in multiple pools of money into retirement. We might have Roth assets, we might have traditional tax deferred assets, we might have taxable assets. So unfortunately, it's not as simple as one big portfolio. So I've written about that topic as well.
Fantastic. Thank you so much. So a couple questions around the market currently. So one question, I'm 57, portfolio's done well. However, my deep down belief is that we'll have a sharp and sustained pullback at some time, no clue when. So how do I protect myself? With the massive issues such as debt and Fed will not be effective at some point. I'm currently 80-20 equities. Then another question, given the meager outlook over the next decade, understanding that we can't predict the future, where do you recommend we invest if within 5 years of retirement to optimize prior to retirement?
Yeah, it's a good question, and I can't give anyone any specific allocation. What I would say though is that I do like that idea of the bulwark, that you are building yourself kind of a safe portion of your portfolio that would serve as a protective device if the market is weak over the next couple of years or even longer. That idea of building enough in cash, high quality short and intermediate term bonds that you could fall back on if your equity portfolio were just kind of flatlining or even worse in such a period. My team that I work as part of recently completed a research report where we looked at correlations across various asset classes. And the goal was just to show what is the best diversifier. If someone has, assuming that most people have most of their money in equities, in US equities, what is the category that has historically done the best job of holding its ground or maybe even gaining a little bit of value in those periods? And you might not be surprised to hear that US Treasury bonds tended to do pretty well from that standpoint, that they tended to be really effective ballast for equities in downturns. Cash actually also looked pretty good. Gold looked reasonably okay, but treasuries have historically been a really effective kind of buffer asset in equity market downturns. So I hope that answers the question.
That's terrific. Well, we're close to the end of time. I want to give Christine and Paul great appreciation for being a part of this. Paul, do you have any final comments you'd like to make?
You know, I so appreciate you doing this, Christine, because I think you've opened up some ideas for people that they're going to follow up on, and it'll make a difference. I do have a curious question about what you believe in terms of saving rates. What should people be saving? And of course, we're most worried about people who are getting started, where they have the time to have it to do its work. But what are you telling young people?
I think 15%, Paul, is a good starting point. Certainly higher income earners, I usually like to tell them to try to shoot even higher if they possibly can. But I think 15% is a really good starting point. Unfortunately, that 10% number is very much out there. And I think people think, well, as long as I'm doing 10%, I'm doing okay. It's certainly better than nothing, but I would rather see people reach for 15% if they possibly can. Understanding that a lot of younger people are really multitasking, where they may be saving for a home down payment or to pay for a wedding or whatever it might be. But I do think 15% is a good starting point.
And one last question. You have 20 model portfolios. We have lots. Lots of our friends have lots. How do you give somebody unbiased advice as to how to pick the best model portfolio?
That's such a good question, Paul. My portfolios are pretty vanilla. So the bucket portfolios are sort of aligned with what I've talked about here. But I think the best portfolio is the one that you believe in, that you think you can stick with. We have so much research on investor behavior at Morningstar, where we see that investors systematically hurt themselves with these timing decisions where they are chasing things that have worked in the past. I'm afraid that's very much going on right now with some of the high octane, high momentum stocks that have been pacing the market. Mm-hmm. And we see that investors buy high and then they sell low, and it's rinse and repeat. We see it again and again. So I think it's, if you find a portfolio that resonates with you intellectually, that you think you can stick with, that's the winner. based on what you know of your own behavior and how you've fared in the past. I think that's probably a way to navigate.
And let's make sure we've left our viewers with knowledge of the ways you are helping. You have your weekly podcast, The Long View. You have your weekly column. Is that weekly, or do you do that more often?
It's a couple times a week. I usually write one new piece a week, and it's usually a couple times a week. I do a lot of videos for Morningstar.com. In normal times, I love being out and about speaking to live audiences of investors, because hearing their questions gives me a sense of what to work on. And I wanted to thank you, Paul, for being on the podcast too. We've had some wonderful guests, and you were gracious enough to take part in it recently.
Thank you very much. Keep up the good work. We really appreciate your sharing.
Thank you so much. Thanks for including me in this great educational event.
And Jim, thank you, by the way, and Jessica and all the people that worked very hard putting this together, and Kathleen Thorne over at Library U, a whole bunch of you. You made it. Nick, thank you so much. It is absolutely a pleasure to be back. And when I say be back, I've been teaching classes to CPAs since 1984. And it's been a little while since I've done this. And it is one of the things I've always enjoyed the most, because my hope is this information will go to your ears and then to the ears of others. So I gave a group a whole bunch of different topics that they could choose from, and this is the one they chose. I'm so happy they did, because in fact, this question of should you manage your investments yourself or hire a professional, most people, especially young people, have really no idea what that means over a lifetime. And my job, since I retired in 2012, just a sec here now, I've got to move this. There we go. I retired in 2012 and set up the Merriman Financial Education Foundation. And our job is to provide the tools and the information so that individuals can make these investment choices, so that you can take the responsibility. I've been around this business since the mid-60s, 1960s. And what I know is back then, investing was not very easy. It was expensive. It wasn't well defined. It wasn't very well diversified. And today, with index funds and ETFs and low expenses and all the things, target date funds, I'll spend a little bit talking about each one of these. But today, it is so blooming easy to be an investor. And the key is how you should take advantage of that efficiency that you have available to you today. And that is the mission of our work, is help people go through that. Now, there we go. It's easy. And I said that it's more efficient. Well, Warren Buffett said it beautifully. He said, when he was talking about to be a success in life, he said, you only have to do a very, very few things right, as long as you don't do too many things wrong. And I really agree with that statement when it comes to investing, because truly, to be a successful investor, there are about a dozen, maybe at the most 20 investment decisions. I'm not talking about financial planning. I'm not talking about estate planning. I'm not talking about taxes. I'm just talking about the simple process of putting together a properly diversified portfolio. It is so simple. And we've got a free PDF if people are interested. And the book is entitled We're Talking Millions, 12 Simple Ways to Supercharge Your Portfolio, Your Retirement. So I'm hoping that I'll hit the main ones for you to know about, and I'm sure most of them you will. We have a problem today with trust. We don't trust Congress. We don't trust the information on the internet. Some people don't trust the press. Corporations certainly are questioned about in terms of trust. And what about Wall Street? I mean, this is where most of the investing goes on. And yet, the reality is that most people don't really trust what comes out of Wall Street. And my hope is that we will trust the process if we follow the math, that investing based on following the math is really quite simple. Let me show you an example. And this is without the market. This is not about what the market's going to do for you. I'll talk about that in a few minutes. But I just want to talk about the math of the difference of very small amounts of return. And in this particular case, what we have is we have a table here that you'll notice scenario one, the investor makes 8% a year during the accumulation period for 40 years, having invested $6,000 a year, a total of $240,000, and then they retire. And for the next 30 years, they make 6% a year. And they take out 4% a year to live on. Now, this is important because here's how I measure the return of your investments. If you have invested $240,000 the first of each year, $6,000, and you had an 8% compound rate of return, that turned into about $1.7 million. If, on the other hand, you got an 8.5% return, a 0.5% more, you would have $1.9 million. Now, we can talk about where that 0.5% might come from, but I want you to see the importance. Right here, you've already got over a $200,000 advantage, but there's more. When we look at what you took out of that portfolio, taking out 6% during the distribution period, I'm sorry, taking out 4%, but making 6%, that total withdrawal distribution number would be about $2.6 million. On the other hand, if you did it making an extra 0.5%, making 6.5 instead of 6, it would be $3.2 million. But that's not the end either, because then we pass on and we leave whatever's left over to others, children, charities, whatever it might be. In the case of the first scenario, you would leave at age 95, basically 2.8 million. If you take scenario two, it would be 3.7 million. The outcome of that extra 0.5% over a lifetime is basically the difference between the 5.5 million and the 7 million that you had between the distributions and what you left to others, or an advantage of $1.5 million. So if we can just find a 0.5%, or in the case of hiring an advisor, oftentimes that advisor charges 1%. So what if we didn't pay that 1%? And so what if, for example, instead of an 8% return and an 8.5%, let's say the difference is between 8 and 9% instead of 8 and 8.5%. In a way, that is the implication of hiring somebody and paying them 1% a year to get that investment process done for you. Now, what does that do? What is the implication of that? Well, the implication is now that instead of making 5.5%, you're going to make, 5.5 million, you're going to make almost 9 million because of that 1% difference. And that is about a difference of around $3.5 million. And here's the reality that many of you are going to be able to save and you're going to get a match. So you put in 6 and they put in some, and maybe you're saving 9,000 a year instead of 6. And maybe you're putting away 10% of your salary, and it's not going to be a $6,000 a year investment. It's going to be a $10,000 a year investment. So these numbers are really understating the likely reality of certainly your life as a CPA. So this looks to me like the real cost of an advisor is about $3.5 million, given a relatively low amount of savings. But there's more. And when I say there's more, I'm saying that there is more in what you can do. You see, some people forget that the investor has a partnership. The partnership is between the investor and, let's call it, the stock market. And the stock market has to do its work, whatever it does. But it does its work whether you put $100 to work or $1,000 to work. It's still going to do that same work. So there are advantages at your end if you do a little more work in the saving part of the process. So if you were to save more, so if instead of putting away $6,000, you put away 6,000 plus 3% every year. So the second year you would put aside over 6,000, and every year a little more, 3%. By the way, that's sounding like a way to protect against the impact of inflation, doesn't it? So what does that mean? Same set of circumstances, same stock market or bond market, nothing changed there. Well, now you're up by being able to make 9% instead of the and 7%. You are up now by saving that extra 3%, or by the way, going from 240 up to 452. All right, you saved about another $200,000, and you have another $3.5 million in the kitty that you took in distributions and that you left to others. So there are things you can do. It isn't all up to Mr. Market, as Benjamin Graham named the market. It's also up to you. And it's also up to you as when you start. Because even the decision to start a few years sooner has a huge impact later in your life. So if you started at 25 or you started at age 30, okay, and so you had in one case 40 years of accumulation, in the other you had 35 years of accumulation. What does that extra 5 years of early income give to you over this entire period? Well, it turns out to be about an extra $4.7 million. So there's another thing that you can take responsibility for. It's not up to an advisor. It's not up to the stock market to make this additional money. It's really up to you. And so in the early years, in the partnership with you and your investments, you truly are the key player. You're the important partner. The market is relatively minor, the return there compared to you getting that money in there and working for you. And that's something, if you don't have an advisor, you're going to have to maintain this discipline on your own. That's part of the reason you get to make an extra $3.5 million, because you concluded that you can maintain that discipline on your own. And then if you're going to be your own advisor, one of the big decisions you have to make is, am I going to put my money in stocks or am I going to put it in bonds? Now, we are told that something like almost 25% of millennials say no way to stocks. We're not going to have any of those stocks in the portfolio. That's just gambling as far as we're concerned. We want bonds where things are secure. But we need definitely need to understand what the implication is to that. Because here's the return of bonds, government bonds, going back to 1928. The compound rate of return of intermediate bonds around 5%. Okay. And that would turn a $100 investment 94 years ago into $10,000. And you might not think a 94-year investment is actually a legitimate thing to think in terms of. But I will tell you, every time we get another grandchild in our family, money goes into an account that starts right now building. And we've just written about this recently. I write an article every couple of weeks for Market Watch, or you can get them at our website, paulmerriman.com. But I talked about making this investment on behalf of my new granddaughter, and that the money is being put aside for the express purpose of funding a Roth IRA. And depending on how well that account does, it could fund the Roth IRA for most of her life. I mean, there's some amazing things we can do for a newborn child. Anyway, right now I want to focus on this $100 growing to $10,000 over that period of time. On the other hand, if we look at equities, whether we talk about the S&P 500, an asset class we call large cap blend. We look at all the companies that are large, of a certain size, and we look at some are growth, some are value, some are the really hot dogs, the great companies that are forging in all the new exciting industries, and then you've got the old time earners and the companies that have been around paying dividends. They're all in one big portfolio called the S&P 500. That asset class has compounded at about 10% a year. That $100 has grown to be worth over $900,000, not $10,000, $900,000. So do you think I'm going to put want to put my grandchild's money for the long term into bonds, or do I want to put it into stocks? Well, I don't. There's a lot of stocks I don't want it to go in, but I can tell you, I want it to be diversified, and I like it to be in a lot. And by the way, this is the decision you're going to have to make, but you also could have it in what they call the large cap value asset class. That particular asset class, these are large companies out of favor, not the hot dogs. Compound rate of return historically 11.2. Why? Because they're more risky. At least they're perceived to be more risky at the time that they are out of favor. And then we have small companies that are growth and value, and small companies that are purely value. Those are legitimate asset classes. In a few minutes, I'm going to show you this wonderful quilt chart. And if you've never seen a quilt chart, I think you're gonna love it. I hope you do, because it is one of the best learning tools I've ever seen. But here's what I know. I know that the small cap value asset class has compounded at 13.4%. And that $100 is worth today, well, of course, that's the end of 2021. It was worth $13 million. I know, for what it's worth, of all the asset classes in 2022, small cap value has been the most productive asset class. More on that in a few minutes. Anyway, you can see why stocks represent, from everything we know about the past, one of the best places to put money for the long term, which is what we're talking about for your retirement. One stock versus many. Now, I know that most, particularly young people, believe that if you really want to make a lot of money, you got to take the time to find the great companies, the great growth companies of the future. And by the way, by the time you find the great growth companies of the future, a whole bunch of other people have found them as well. And it's not unusual for them to be selling for 40, 50, 100 times earnings versus the not exciting companies that are not viewed as the best companies for the future, typically sell around, let's say, 10 to 15 times earnings. So one stock can look like a winner, but all of the academic research tells us that many stocks actually has a higher probability of making you a better return than a few. And by the way, 99% of us are going to be able to own many stocks by buying mutual funds. And I know that you know what mutual funds are, how they operate. I'm going to focus on a few that are my favorite kind of mutual funds in the next few minutes, the ones I think you'll do the best with over the long term. But I truly believe, and so does Dr. Bessembinder. Dr. Bessembinder did a study entitled, "Do Stocks Outperform Treasury Bills?" out of the Arizona State University. And he did it along with some other folks. And here is what they found. And I just love the truth and the implications of that truth. They found that looking at all of the companies, the public companies, going back to 1928 through 2016, that while the compound rate of return was about 10%, that it was only 4% of the companies, 4%, that represented the majority of that return, that gave it that 10% return, because the other 96% of the companies averaged 3%, many of them going out of business. And even in my lifetime, many huge companies have gone out of business. It is not unusual. But then, of course, a lot of small companies go out of business as well. But the bottom line is the academics believe that you are likely to get the return of the market that you'd like to get in most cases by simply owning all of the companies in essence. This one is a no-brainer. Every academic, and by the way, as far as I'm concerned, the sources of information I trust and I would like you to trust. Remember, I said to follow the math. Well, where I find the math more interesting is not out of Wall Street, because they do seem to have just a couple of conflicts of interest along the way. And so often the things they put their stamp of approval on turn out to be really bad for people. Now, there's also what we call Main Street. Main Street would be your neighbor or a friend at the office or somebody that talks a good story and seems to understand the process of investing. Often they don't. And when they do tell you the stories about how well they did, which might, pique your interest a little bit, they don't tell you about the stuff that didn't work out. I mean, human nature would say that would be likely. So the best source of information I know is what we call University Street, the academic community. And the academic community says, above all other kinds of variables you could look at, that the one variable that is constant is lower expenses lead to higher returns. Lower expenses lead to higher returns. Now, be careful, because one could say, well, I can buy a bond fund for 0.1% a year, and I can buy a stock fund for 0.2% a year. Wouldn't I be better in the bond fund because the fee is lower? No, that's not the message they want you to get. The message the academics want you to get is that when you look at a bunch of mutual funds here, that's what we're talking about, that are in the same asset class. For example, there are S&P 500 mutual funds that have an expense ratio of zero. Zero. They have no management expense. They have no administrative expense. It's basically on the house. It is meant to be a come on to get money into that mutual fund family. That doesn't. It's Fidelity, by the way. On the other hand, there are mutual funds that replicate the S&P 500 but charge a half to 1%. And you're not getting anything extra for it. What you're getting almost guaranteed is a return that is going to be about a half to 1% lower. So expenses are really important within each asset class. Not all asset classes are exactly the same. Now, here's a huge fork in the road. I mean, you can cut through so many important choices if you will just make this choice right. And that is the choice buying actively managed funds or passively managed index funds. Now, I grew up in a time when virtually everything was actively managed. Why? Because when I started in the business in the mid 60s, there were no index funds. Everybody was managing money with the promise, we're going to try to beat the market. We're going to try to make you more money than those people our competition over there are making. Well, what happened is John Bogle came along in the mid 70s and started the first index fund that did not try to beat the market. It did not try to beat the market in any single way. It simply tried to be the market as efficiently as it could. So nobody had to figure out the best companies. You didn't have to hire anybody special to manage that fund theoretically. And you could charge very little. And when I talk about that one that charges zero, it's an index fund. And if you go to a Vanguard, you, depending on the size of your account, you can buy an index fund for 0.03% a year. So index funds are super cheap, and they are massively diversified. My wife and I own 10, basically what we would call index funds. Between those 10 index funds, we have over 12,000 different companies. Some big and small and REITs and emerging markets and US and international and all these different kinds, but they are all represented through index funds. And why do I believe that is the right thing? When you're going to be your own manager and you're going to take the responsibility of deciding what you own in your portfolio, remember, you're getting the big $3 to $5 million payoff for doing this right. What you would know is a study that is updated every 6 months by Standard & Poor's. It's called the SPIVA report. The SPIVA report looks back 1, 3, 5, 10, 15, and 20 years. And let's go out 20 years because we're thinking about it at least 20 years, more than likely. And what do they track? They track the performance of all of the mutual funds. And they look to see how many mutual funds in each individual asset class, the large companies, well, the large growth companies, the large blend mutual funds, the large value mutual fund. They look at them all. And the question is this: how many of them are able to do better than just buying the benchmark, just being the market rather than trying to beat the market? And it's about 1 out of 10 is able to do better than just being in an index fund. Now, it takes all of the fun out of the process. It takes all of the bragging rights. The only bragging rights you'd really have is that you're really smart and you know what the right thing to do based on following the math. By the way, all of those people who are trying to beat the market, they're legitimately trying to beat the market. They know you should have your money in an index fund and that the likelihood of them beating the market is very low. But let's face it, we still have lotteries. People still think people are going to win. How many times have you ever bought a lottery ticket? And after you buy the lottery ticket, you start thinking about how you're going to spend this money that is about a 300 million to 1 probability that you're going to win. But your mind still goes there. And people hope that the manager that recently outproduced the market will outproduce it again. Unfortunately, there is no evidence that that is the way it works. So I say, from everything I know, that if you are the boss in managing your portfolio, the smart thing to do, not just low expenses, not just massive diversification, but I think doing it through index funds is really a smart thing to do. Now, I want to go back. It's a little different table. I just want you to see this because that other table that I showed you, oh God, there was a lot of volatility. I mean, with the S&P 500, you could have had a year that you lost 43%. But when we look out 40 years, remember, you're the boss of your portfolio. You're the manager. You're not looking to make a home run in the next year. As a matter of fact, you become realistic about the losses that you might have to sustain because you, as the manager yourself, the do-it-yourself manager, you've taken the time, and I'm going to show you exactly what I think you need to learn, but you've taken the time to see what the bad times look like, how often they happen, how big they are, what happens after the decline. You know all that stuff because you've looked at the numbers, you've followed the math. But look at the compound rate of return of the S&P 500. There are 55 40-year periods. The best 40-year period was a compound rate of return of 12.5. The worst was 8.9. The average was 11. And over the last 52 years, the return for the S&P 500, 11. For the other asset classes, the returns are much higher. 13.5 for large cap value, 13.7, not much difference there for small cap blend, and 16.2 for small cap value. Will the S&P 500 make 11 in the future? I don't know. I know since 2000, the S&P 500 has compounded at about 7%. Does that mean that for the rest of eternity that it's going to be 7%, going to be 10 or 11? I don't know, but we do know that it should be better than bonds. We can hope for the best, prepare for the worst. I also notice here small cap value, that 16%. I'll tell you why I don't believe that's going to happen. Doesn't mean that it might not. But I think too many people know about it today. What I think about it, I think in terms of 12%, that it would get a likely 2% premium, maybe 3% premium over the S&P 500. For the last 52 years, it's about a 3% premium, not a 5% premium. So small cap did better than large. Okay, let's put some in the portfolio. I don't mean you have to put it all in, but I think you should have some. I don't care if you're retired. I think you have some. My wife and I have half of our money in equities. Half of the money's in small, half the money's in large. Okay? And that's because we've looked at the numbers of the 50-50. I'm going to show you in a few minutes. But I want you to go beyond just having small as an extra holding. I'd like you to also, I'd like you to add value. You don't get much value in the S&P 500. And if you happen to own the total market index, which has almost exactly the same return as the S&P 500 for the last 90 plus years, if you were to, in fact, put that money, the total market would have the same return as the S&P 500. So the amount of value that you get in that equity portfolio of a total market or the S&P 500 is not great. I want you to add some more. I'm going to show you exactly how much I think you could legitimately add without doing anything dumb. As a matter of fact, I'm going to show you how you're actually going to make more money with less risk. Now, if I'm going to do my job, and for 30 years in building the Merriman Wealth Management Company, basically what I was a teacher. And I tried my best to show people how to do it on their own. I'm pretty smart about this because I've been on a diet since the 5th grade. And I know that I've yet to conquer the challenges, the emotional challenges of dieting. And I believed that probably if you showed people exactly what they should do, that many people would not be willing to do it. But they would know more what to expect if they would just learn these things that we have tables for. In fact, at our site, paulmerriman.com, we have over 160 tables of numbers. These are the tables of numbers that advisors have. They know how to sort through them. They know all of this. There's no secret about this stuff. I've been putting these tables together for almost 30 years now. So here's what I know. I know that you have choices. In this particular case, I don't expect you to see the numbers and be able to read them. That's not what I'm concerned about right now. I just want you to know what we're trying to do for you. This is a page of numbers devoted to the S&P 500 as the equity class. And as the equity class, what we want you to see is the 100% equity, is the S&P 500. You can see 1 year at a time. On the other hand, you may not want to be all equities. What if you decided you wanted to have some money in bonds? All right, we have a column of bonds from 1970 through 2021. It's a conservative strategy with bonds, and we tell you exactly what bond funds that we think you should use, but the bottom line is it's all governments and it's short to intermediate term. No long-term bonds. They're much higher risk day to day, year to year than the intermediate to short term. Now, in between, all in bonds and all in stocks may be who you are. For my wife and myself, I mentioned, we are 50-50. We are 50% in stocks and 50% in bonds. So now I can look here at each year what it would have been like as an investor for 52 years. But more importantly, at the end of the day, because we always talk about the bottom line, here's the bottom line. The bottom line is this is the S&P 500 equity. The compound rate of return was 11. And if you had the bonds at 7, but you put 10% in equities and 90% bonds, it's 7.6%. You made an extra half of 1% by adding 10% in bonds. If you added another 10% in bonds, you make 8.1. You make another 0.5%. You see how easy it is to make an extra 0.5%? And I'm not talking about having to take a lot of extra risk. And we show you the risk. We show you the worst 12 months. We show you the worst drawdown. That's a loss from peak to bottom
before you come back up to that peak. You had to sit in that thing if you were in the S&P 500 and go down 51% along the way. But with 50-50, the loss was 25%. And every one of the strategies that we propose you consider, and we've got 9 of them. I'm not going to cover all 9 of them right now, but every one of them has a fine-tuning table. In fact, we have one that's for all small cap value. And again, you have the table that shows, okay, instead of going from 7 to 14, to 11, it goes from 7 to 14. And by the way, if you added 10% small cap value to 90% bonds, you'd pick up about 0.9%. Because it made the small cap value made more money, it means as you add the equity, you're going to make more. Well, there's more risk in small cap equity. Look at here, down 61% was the worst drawdown. And I don't know what your limits are, but if you're a do-it-yourself investor, it's up to you to know what those likely losses are. Because at 79, what happens to the rest of me and my life is a pretty much random event. But if you're in your 40s or your 30s or your 20s, you're going to live through losses like this at some point. I'm not going to guarantee it, but I'll bet you. I just won't be here to pay the bet, all right? Okay, but what if you put the two of them together? See, now we're talking about diversification. We're talking about diversification, and we're gonna split the S&P 500 and the equity between the S&P 500 and small cap value. So what does that mean? What does that mean in terms of how it looks when we start looking at the fine print down here at the bottom? Well, what that means is that the combination of those two compounded at 12.7%, not 14, not 11, okay? And that's what you would expect, somewhere in between. And that the 50-50 portfolio compounded at 10.3 and had about the same. Remember, it was about a 25% worse drawdown. Now it's 27.7. And what we're looking for is some sort of combination that gives you a peace of mind. That's the key. It's about trying to get a better rate of return, trying to take less risk, and trying to find something that you can trust for the long term. So here, and by the way, I am really hoping that if you find this of interest, that you'll watch it again. We're gonna archive it on our website, on our YouTube page, and Nick said that they are going to eventually archive this on, I believe, your YouTube page. But I'm hoping that you'll find this interesting enough to come back and revisit these numbers or dig into the numbers on our website. But you can compare each one of these so easily. All right, let's give you a little rest from the numbers. I've got more numbers, but I'm going to let you rest here for a few minutes. Big decision. Do you hold on to your money, waiting for that good opportunity to invest it? Or do you put money in every month and dollar cost average? Well, there are a few guarantees in this business. And one of those guarantees is that when you dollar cost average into a mutual fund that's diversified so that it is going to go up over the long term. See, with individual stocks, that might not be true. But you dollar cost average, and when you put in $100 a month, that $100 buys more shares when the market is down and fewer shares when the market is up. It guarantees you do something that is more difficult than a lot of people know unless they've got this on automatic. because when the market is in decline, it becomes harder to be happy to invest. Not this again. I'm going to lose more money. I could just hear the self-talk. But the idea is stay the course. Dollar cost, that's what a 401k is set up automatically to do that. Buy and hold versus market timing. Everybody I know in the business, every academic I know, will tell you that you are better off simply buying and holding. Don't try to second guess. I can't tell you how many people I've talked to since March of 2009 that sold out in that early part of 2009. They've had it. They thought the market was going to nothing. They were going to lose everything, or the market was going to go down a whole lot more, and they were going to be smart and get back in. And many of those people, believe it or not, are still sitting in the cash that they had because they got out of the market. It is important to have the right amount of fixed income in your portfolio to limit the losses you're going to expose yourself to with your portfolio. But to try to defend against the bad times by being a market timer, I will tell you, I know market timing. I've been studying market timing since 1966. It's a fascinating topic, but I can also tell you, I have met very few people who are able to maintain the discipline of market timing. Buy and hold, just keep your hands off it. I mean, it's easy to know what you're not supposed to do. With market timing, it starts to become intuitive. It sounds right to get out. As a matter of fact, not only are you feeling that way, but you've been listening to Jim Cramer, or you've been listening to somebody else talking about the market and how it's going to hell. Well, those people don't know anything more about the future than you do. But the more they talk and the louder they talk, the more money they make. But they don't make it in the market, okay? They make it off of you. This one's easy. Well, it's mostly easy. Going to have to make the decision how much you put in taxable, how much in tax-free. Now, there could be a lot of debates about the decisions you'd make around that. Would you accumulate a pool of money that you're going to live on and let your tax deferred or other money continue to compound and without having to access it early on? There's some planning that could go on. And by the way, I am not anti-planning. I am not anti-tax experts and anti-estate planning experts and anti-planning experts. What I'm trying to help people believe is that to be a tax expert, to be an estate planning expert, to be an expert in planning, there's a lot of study to do that. But to be an expert on investing, it's the easiest job I could possibly think of. Because if you spend a week, 40 hours dedicated to just learning how to do this, there's hardly anything more to learn. Now, whether you use the 401k Roth or the regular 401k or the Roth IRA or the HSA or taxable, some of those are planning decisions. They're not really investing decisions. I will say this. I'm a huge fan of the Roth, not because it always makes tax sense, but when I first came into this industry back in the mid-60s, the marginal tax rate the year before I came in was 90%. When I came in, it was 70%. And I don't have any reason to think it won't be there again. And oh, by the way, people still worked hard. I mean, it's interesting because you believe that if you ever taxed people at the 70% rate, everybody would go home. No, people don't go home. They keep doing what they're doing. Oh, they complain, of course. But we complain if it's 35%, don't we? Huh? Target date funds. I've got a whole piece that I think I did for the Washington Society of CPAs on target date funds, America's #1 retirement investment. I think target date funds are absolutely amazing, because the target date fund, if you're not going to hire somebody to manage money for you, if you're not going to do it yourself and make the decisions, the target date fund asks you one question: when do you expect to retire? Let's say it's 2065. Great. Put your money into the 2065 target date fund. They will have it almost all in equities today. By the time you're 50, you're 55 or 60, you'll have more fixed income in the portfolio. At my age, they would have me 70% in fixed income and 30% in equities. But target date funds are I think are an amazing product. They are really the answer for people who just don't want to deal with it. And Wharton did a study where they looked at the returns of people who own target date funds versus those that didn't, and they found an expected return difference of 2.3% a year. And they looked at 1.2 million retirement accounts. And that's because people on their own, generally, they aren't doing the right thing. So I would make one recommendation about target date funds. If you read our book, We're Talking Millions, the last half of the book is about target date funds. It does suggest, if you want to do better than a target date fund, and if you're putting away 10% a year into your target date fund, put 9% into the target date fund. Put the other 1% in the small cap value fund. Here's that quilt chart I was talking about. When I first saw this, what I asked Daryl Balls is our director of analytics. He donates about 200 hours a year or more, helping us provide the people who follow our work. By the way, I do not get any compensation for the work that I do. Neither does Daryl, neither does Chris Pedersen, who's our director of research. We are only trying to help you do better. And we are really hoping you'll tell other people how to do it as well. I asked Daryl, I said, I want to figure out a way to help people understand how different asset classes perform. And so this is the same stuff I was talking about before, 1 year at a time since 1928 for the S&P 500 for large cap value. By the way, the S&P 500 is green. Large cap value is kind of a brownish color, and then there's kind of a pinkish color that is a small cap blend. And then the electric blue is small cap value, and the purple is the 4-fund strategy. I love the tale this quilt chart tells me. I can look and I can see the green. I can see the green at the top and then at the bottom. I can see the green at the bottom for 5, 6, 7 years in a row. I don't see it at the top very often, 5, 6, 7 years in a row. And that's because it's supposed to be at the bottom. Remember, it is the least productive of those asset classes, but not 1 year at a time. It is often at the top. And blue, the small cap value, is supposed to be at the top, and it is at the top a lot, about half of the time. And I'm sorry, I didn't hang up that phone, and that phone is across the room. All right, so here is what I know about this table. What really gets my attention is when I look at that purple. That purple is the 4-fund strategy. That purple is in the middle of those years in almost, not every case, but in most cases. And so what I want you to notice is that not only did it have less volatility than the S&P 500, But when we look at the compound rate of return of the 4-fund strategy compared to the S&P 500, what we see is, and we can see it right down here. In fact, let me go to the next table here. Here we have the compound rate of return of the 4-fund strategy from 1928 to 2021, 12%. For the S&P 500, 10.2. In 51% of the years, the S&P 500 was the worst performer. In 38% of the years, it was the best performer. And the 2-fund strategy was never the best. The 2-fund strategy was never the worst. It was always somewhere here in the middle. Small cap value, 48% of the time was in first place, 33% of the time it was in last place in terms of its ordinal rank. And by the way, if you wanted to make more, you could just go to the 2-fund strategy. The 2-fund strategy made 12.2% over that entire period. The all value, 12.5%. You could even theoretically, you could have your IRA in the 4-fund strategy. You could have your spouse's IRA in the 2-fund strategy. You could have another one all in the S&P 500. Of course, you're going to have to figure how much you need to have in fixed income. I love those tables. And here's another set of tables, and I've got about 5 minutes. I really think this is where you're gonna see some information that will help you make the decision. These are the 9 different strategies that we discuss at length. We have distribution tables, we have fixed distribution, variable distributions, accumulation tables, we have the fine-tuning tables. We have all these ways you can turn these different strategies inside out. And so here it tells you how much in each of these asset classes, which includes some international asset classes as well as REITs. So here's the table that I just think is worthwhile you spending some time. You've got the PDF of it. Take a look at this. Daryl put this one together too. Again, I wanted to give people in one table with a lot of numbers the information that they really need. And here's what we've got. We've got all of these different strategies looked at. How did they do 1 decade at a time? So you can see that from 1970, the S&P 500 had a bad decade from 70 to 79. It only compounded at 5.8. As a matter of fact, it was even worse from 2000 to 2009. But if you had the 10-fund strategy, you compounded at 12.3 over the whole period. But in that period from 1970 to 79, the 10-fund strategy compounded at 13.3. In fact, the worst 10 years was from 2000 to 2009. So you can compare all of those strategies. Then you can compare how did they do in the good times? How many up years did they have? What was the sum of all of the up years? And you could look, for example, at the S&P 500, 42 profitable years, and the sum was 787% in the good times, not in the bad. But look at the 2-fund strategy. It had 41 positive years. It had one more losing year. The average return was higher, but the total, the sum of all the profitable years, 871%. Look at this. If we look at the down years, the 10 years the S&P 500 was down, if you summed them, it was 141% in total losses. If you put it in the 2-fund strategy, the total of the losses was 130%. In other words, it could be said that the 2-fund strategy, half small cap value, half of the S&P 500, is less risky over time than the S&P 500. and more profitable. And we could look at fund strategy, all US. It did all right as well. Oh, I passed one. Sorry. This is our website. Nothing for sale. No services. By the way, and you don't get anything in terms of services like personal advice. What you get is a lot of articles, 700 articles and podcasts and 100 videos, all built to try to educate people to be productive on their own. I sat next to somebody at a dinner recently that has made himself a multimillionaire in this industry, and I talked to him about the people who are do-it-yourself investors, and he said we don't even talk to them. We're never going to convert them into people willing to pay. By the way, this company charged people 1.5% to 2% a year, not one. And so, you know, we want to help the people who just can't even think they'd want to pay somebody $5 million in a lifetime in order to help them do something they can do on their own. Now I can go to that last slide and say thank you. And by the way, again, you can sign up for our newsletter and you can get a free copy of We're Talking Millions. In fact, we have a free audio book of We're Talking Millions for people who are interested. And I have not looked to see if we've had any questions.
We did have a few questions. If you
All
would like
right.
to address those now,
I am happy to stick around and answer them. You bet.
Wonderful. I will note to people, first of all, I put a link to your website, Paul, in the chat for people. So you just need to click that and you can go see that. There's also the sign up link on the screen right now, actually, in the slides. You can click there and go there. I believe it's also in the materials, so you have access to that. I've also put the evaluation link in the chat. So for those of us with tight schedules, if you really have to get going right now, please take a moment to let us know what you thought with the evaluation.
Thank you.
Now, I'll also note for CPE purposes, if you saw the buttons, we're done with the buttons at this point. We're past the time when they'll play. So if you saw and clicked those, you're good. We manually checked that, so it'll be a few days till you see your certificate, but should be coming out then. Now, with all that said, the first question I saw was... let me scroll up and get to it. So one question was, are you getting at a self-directed 401k? And I think this was earlier on in terms of like, what are your thoughts on a self-directed 401k?
Well, that's a great question because the self-directed 401k normally means that the company offers a handful of choices, oftentimes terrible choices, by the way, but they also give you a right to go to maybe Fidelity or Schwab or even Vanguard and self-direct and that you can pick the mutual funds or whatever investments that you want. Now, and I didn't mention this, but we actually provide people with our recommendations on our website. We have, if you're an ETF investor, we have what we call our best in class ETF recommendations. If you said, no, I only want Vanguard ETFs, all right, we have ETFs only that are Vanguard. But these best in class ETFs are available at Vanguard and Fidelity and Schwab. And the idea is that they are the best that we're able to find in each of the different asset classes. But yes, now what you have to be careful is some plans have real high expenses to self-direct. So if that is the case, you may only want to do it once a year, and you may only want to go into one fund at a time, or figure out how to minimize the expenses you're going to have to pay inside of that self-directed portfolio.
Great. Another question. This one's a bit longer, so bear with me.
Okay.
This member asks, I took a workshop on annuities and fixed payments for life through Thrivent. I might be mispronouncing that title, but Thrivent. He made an interesting point. I thought, where the during the distribution or retirement phase, dollar cost averaging is in reverse and works against the investor, as when the market is in decline, it takes more shares sold to maintain the same income stream. Therefore, he was advocating fixed income annuities in retirement. What are your thoughts on that, Paul?
Well, first of all, I am shocked that an annuity salesperson would recommend annuities. It's like my friends who are in the gold industry. They always have a reason to buy gold. Um, well, look, the way my wife and I do it, we have a balanced portfolio. And what you do is you're going to sell that's been performing the best to provide you the income for the following year. And so in that case, it doesn't mean that you have to do this kind of in reverse. In fact, to the extent that the market's down, you would probably normally be taking money out of fixed income. Now, as most of us know, actually all of us know, fixed income has not been a safe place to be this year, but we happen to recommend only short to intermediate fixed income anyhow. So the typical situation is that you're taking it out of the most productive asset class. Now, having said that, let me tell you what people who want to be very conservative can do. You can have a portfolio where you have 2 years. You're starting the year. We're almost there, January. You have 2 years worth of your money in very short-term instruments. And it's going to meet your cost of living. And you're going to be taking it monthly. Now, my wife and I, we take our money the first day of each year. So we don't care what the market does during the year because we're not taking money out during the year. Now, obviously, at the start of the next year, we care where it is. But the bottom line is that when you get down at the end of the first year, taking money out of that 2-year pool, you bring another year's worth of money over into that to that now again 2-year pool. So you always have that extra year of extra cash available if you get into a terrible bear market. Now, some people use the bucket strategy. I personally have, when I was an advisor, my clients, if they followed my advice, they would use a total return. We would have, most of my accounts were 50% equity or 60% equity if they were in retirement. Some were 40% equity, but we took the money out of the entire portfolio in order to try to maintain, again, taking out of the most profitable first to try to protect them from getting behind the 8 ball and taking money from a place where they don't want to take it at this point.
Great.
Having said, remember, what's important here is that what that annuity salesperson is suggesting means there's a point, a set of circumstances where you're guaranteed. And for a lot of people, that guarantee is a really, really big deal. And so it's not a bad thing to do. What is a bad thing to do is to pay and get less than you should. So let me recommend for any of you who want to understand annuities to begin with, go to stanthemanannuity.com. stanthemanannuity.com. And he has more educational information than anybody I know. Plus, you can go on his site, you can put in the very things that any annuity salesman is gonna want, and he will give you the quote from the best source of the annuity payout that he knows at that point. And he selects from hundreds. Many people who sell annuities have an annuity to sell, and you're not likely to get the best price if you've got only one. I mean, sometimes you'll be the best price, except sometimes the people they're selling for have the largest commissions. And so it's hard to have the best payout when you pay the highest commissions. And I'm not saying Thrivent is high or low. I don't actually remember. But there's a smart way to buy annuities, and there's a costly way, just like overpaying for the expense. By the way, as Bogle would say, the expenses you pay in a mutual fund go on forever. In an annuity, it's the same thing. If you pay too much in expenses, those higher expenses cost you forever.
Great point. Very important. Yeah, and thank you to the member who put stanthemanannuity.com in the chat, so we can copy and paste that if needed. All right, that's it for questions. Paul, do you have anything you'd like to leave us with before I take us away to the evaluation?
Absolutely. My job is to try to help people do better, their families do better. Our work covers all the way from the time a child is born until you passed on, and what did you do for others. I'm talking about as an investor, not talking about all that other stuff that you likely get into, like taxes. And so anytime that we can help you help others, we want to do it. So if somebody asks me for a favor, I may not be able to give you personal advice, but if it means somehow helping you get to a better source of information than you have, I will do all I can to help you do that. That is not illegal for me to do. So go to our website, check us out. Hopefully you will trust us as a good source of following the math for you. Thank you. Really appreciate you coming out today.
Hi, I'm Paul Hayes. I'd like to talk to you for a moment or two about somebody that I've known for over 50 years, both professionally and as a friend, and as a member of the board that he is the chairman and founder of, the Merriman Financial Education Foundation. He wrote this book years ago, Financial Fitness Forever. And he starts off the book with a nice inscription. I'll just read it. To Paul, you are the greatest. You make us laugh. You make us cry. You make us think. Paul Merriman. That's a nice thing to say about somebody. They make you think. And I return the favor by pointing out that one of the things he had me think about was the wisdom of writing a book, which I did, called Spending Your Way to Wealth, plural. You've never seen the word wealth written in plural before, probably. In fact, if you ask people what the plural of wealth is, they say, well, it's already plural. But no, it isn't. Let me give you an example. Paul Merriman has a wealth of knowledge. He has a wealth of generosity, a wealth of kindness, a wealth of decency, a wealth of understanding, a wealth of empathy. Those are the wealths that make up a human being into a real human being. And Paul Merriman is that. And I'd like to encourage you to take advantage of all of the podcasts and things that he has put on PBS and on the networks. He's a part-time teacher at Western Washington University, where he loves teaching young people. He does it on a pro bono basis because he wants to try to make a big difference in people's lives by getting them to understand some very basic, simple principles that can make the difference between real financial sufficiency and maybe not sufficiency. Paul can do a lot of good for anybody that'll take the time to listen to him, read his books. And I appreciate this chance to acquaint you more fully with him. And I know you'll enjoy getting to know him better. Thanks for tuning in.
Ladies and gentlemen, welcome to our investing podcast. Our guest today is the famous US financial educator, Paul Merriman, who has more than 50 years of experience in wealth management and investing. He has founded Merriman Fee-Only Advisory Firm in 1983, when I suppose most of you weren't born yet, advising clients on matters like investment planning, taxes, estate planning, insurance and risk management, based on academic research and objective data rather than emotions, forecasts, or speculation. Those of you who have already read my Beginner's Guide in Investing should remember that I've also recommended Paul Merriman's Sound Investing podcast for every stage in life as a great educational resource, especially for young investors. Paul has also recently published a new ebook named We're Talking Millions, 12 Ways to Supercharge Your Retirement, which you may find available to read for free in PDF format in the video description below. Paul, let's begin discussing your new ebook, which should be extremely helpful for young investors who want to plan their retirement.
Well, it is the best that I know about investing successfully over the long term. And by the way, Victor, I must confess, I have not read that book that you've written, so I'm going to read that, I promise, and see if we agree. But what I believe is there are only a very few things you need to do right to be a successful investor, truly, and a dozen is probably 90%, if not 99%, of what will make the difference. Now, remember, I am speaking through the eyes of using investing in the US. I do not know investing in Romania, so I want to apologize that I don't know all of the ins and outs there. But here, what I do know is that there are these very simple steps. They're so obvious that when you hear them, you say, yeah, I know that, and I know that. And by the time we get through the 12, you probably know at least 10 of the 12. And then my question, if I were sitting with you, talking with you about your investments, well, I'd want to see if you were doing those 10 things that you know you should, because a lot of people give lip service to certain things like, I believe in buy and hold. Yeah, you believe in buy and hold, but you act like a market timer. I mean, there are a lot of those kinds of things we have to belly up to the bar and be honest about. Are we doing what we believe? And these are the 12 things that I believe any investor should do. Now, in one particular case, it may be that you don't have the ability to use a target date fund. Amazing investment for, as far as I'm concerned, the greatest investment invention, if you want to call it that, in our industry. But other than that, I really believe that most of the items are going to be very similar. And I do make it free. And the reason I make it free to you, and Victor, thank you for putting that in the show notes, is my hope is this. You'll take that PDF and you'll send it to your nieces and your nephews and your aunts and your uncles. I would like to help everybody do better with their investments. And these are the steps, and I don't know how much you want to talk about them, Victor. I'm going to leave that to you, but these are the most important ones.
I have prepared some questions which cover the most important lessons you teach us from your book and most of the chapters there. I know that you are a huge supporter of the FIRE movement, which is increasingly popular among teenagers. Your motto is invest wisely and live fully. Most young people enjoy living their lives using the motto YOLO, you only live once. Why should a young person save more and not spend more if he wants to live better?
Well, let me first challenge those young people, because I absolutely agree with you, only live once. But having said that, when I go back and examine my life, that one trip I took was not what I would have expected. And a lot of the mistakes I made were really because I was following my heart instead of my head. As for example, getting married when I was 19. I mean, really think about that. Who would do that? I did, and I'm glad I did. I ended up having my first child when I was 21, and now I'm a grandparent, and I could be a great grandparent before I die. So there are some benefits of getting married young, but my whole life is a series of opportunities and mistakes. And I'm not shy about sharing both the things that worked and didn't work. But this whole idea of you only live once, right on. But remember, you're going to live at 21 and 31 and 41 and 51 and 61. And by the way, I never thought I'd make 71, but here I am. I'm 77. Then there's 81 and 91. And for a lot of people, 101. And you can just pretend like the only living once is today. That's fine. But I'm telling you that there are huge rewards for those who know balance. The balance of thinking about the long term, and it doesn't take much when you're young to do the right thing and to make sure that you enjoy the short term. But I want you to remember one thing about that term: you only live once. Let me tell you who wants you to remember that term. This is the most common quote, at least in the English language. This is a big deal. I can tell you that the auto manufacturers want you to know that quote. The people who are trying to get you to buy the right clothes, everybody who wants your money to transfer from your pocket to theirs wants you to remember, you only live once. Do it now. They even say, you only live once. Eat dessert first. Got it? I mean, everything is about making yourself feel better. And let me guarantee you, young people, I'll guarantee this, I'll be dead before you're going to know if the guarantee is any good. But most of us, when we're young, we are that way. But as we age and mature, we learn a different way to be, which means we don't just focus on ourselves. We focus on the world, how we might help the world. In some people's cases, it's what they do in their small town, and they help people. I work for a small town. I have about 30,000 subscribers. I grew up in a little town that was not that big, but almost that big. And so I work for a little town, and I feel proud to help this small group of people. You will likely feel proud of the group. Well, like Victor, that's what you're doing. As you told me about investing in Romania. 50% of the people in the U.S. invest. I think I read 6% in Romania invest in the market. So you're even
1%.
Working with, pardon?
Less than 1%.
No, that's it. Well, that may include the newborn children, but but that is a very big difference between where I'm working and where you're working.
Yeah, unfortunately, because you said this, in Romania, most young people consider that the stock market is very volatile and risky, and they prefer to buy dozens of real estate apartments on credit and rent them. They heard this strategy from a guru called Robert Kiyosaki. And I wanted to ask you, how dangerous do you think it is to use leverage to reach your financial goals?
Oh, I think it's wonderful. I don't particularly approve of Robert Kiyosaki. I have never personally liked his work. This is not the time to discuss that. But I do think that he encourages a lot of people to go way beyond what they're prepared to do. But I think when it comes to running a business, leverage can be very good. When I was 40, I was not considered a FIRE person. Nobody talked about the FIRE movement at that point, but I retired when I was 40. And I took $15,000 and I borrowed $300,000. This sound familiar? Like buying a piece of property, but it wasn't real estate. I was starting a business. And if I had taken that same $15,000 and purchased a building as a down payment, that would have been a business. That is not passive investing. So what did I do with my $15,000? I started an investment advisory firm. And that grew for 30 years. And like the real estate industry, it's not as liquid. You can't get in and out and trade like you can in the stock market, which I don't advise anyway. But after 30 years, the compound rate of return on that $15,000 investment was over 30%. Now, that's a really good rate of return, but it was highly leveraged. And so there was a high likelihood that things could have gone against me. If I had walked in the early days of that business, just like with real estate, if I'm leveraged to the hilt and the market turns and heads down, when you got a lot of leverage, you can go out of business. One of the most famous cases of all was long-term capital management. They had $1 billion. They borrowed $100 billion, and the market went against them, in essence, 1%. And guess what? They're out. They're gone. They're finished. And they were run by some of the smartest people in the industry. So leverage can be great, and it can be a monster that will make you start over. What I believe is that at the same time as I was using the leverage to build my business, like you would build apartment houses or anything else, I also kept putting money into my retirement fund because I wasn't sure those leverage things were going to work out. So that was what I did. I kept the balance. Just like today at 77, I'm half in stocks and half in bonds. Balanced.
That's great, Paul. One of your chapters from your book, we're talking millions. 12 ways to supercharge your retirement addresses the question every young investor has. When is the best time to invest? Can you tell us why is it so important to start earlier to invest than later?
Well, there's a whole bunch of reasons, Victor. One is just creating a habit. I really wish, and I'm serious here, because I have lost over 4,000 pounds on diets since I was in, my late teenager years. I have been on a diet for all of these years. I've lost so much weight. I'm still 30 pounds overweight. So what did I learn? I did not learn the right habits early. I learned the wrong habits. I learned that eating was a way to celebrate, and eating was a way to, if you've got troubles, eat when you have troubles, eat when you're doing well. Any excuse to eat. Bad habit. Same with investing. If you even start with a few dollars, I'm working on a podcast and an article right now about starting with $40 as a 20-year-old, just $40. What can that $40 become over your lifetime? And I take you step by step by step through the process. No false promises, but no way to know what the future will bring. The bottom line is, that can be $200,000 return. $200,000 for $40 done conservatively, not being aggressive, conservatively. So you start early. I used in one of my presentations the implications of $1 a day from the day a child is born until they're 65. At 10% a year, that's what the S&P 500 has given for over 90 years. It grows to about $1.8 million. Now that's in a Roth IRA. I don't know if you have the equivalent of a Roth IRA, but nothing like that. Well, I'm sorry, but tax-free forever. Tax-free is growing, tax-free when you take it out. Then if you waited for 10 years to start taking it out, it goes down about $1 million. $3,650. You miss those first 10 years, whack, there's $1 million gone right there. If you wait until you're 21, it goes down to something like $200 and some thousand. Another $500,000 is gone because you didn't start early. So The other thing, this is pretty obvious. In fact, this is probably one of the best pieces of news I'm going to share in this interview. If you start early and the first years are like 1965 through 1999, those were 5 years the S&P 500 compounded at over 28% a year. If you had been there, if you invested then rather than waiting until 2000, you had the benefit of that huge unknown. Who would have known? Nobody knew. On the other hand, something really bad could happen, and that would be great. I mean, this is the part that young people often don't realize. Like, remember 1929 through 1938, huge losses in the market. If you had put your money into small cap value, something we'll hopefully talk about for a few minutes today, but if you put it into small cap value, then you would have lost about 60% of your money at the end of 10 years. That's if you put it in on day one. But if you were dollar cost averaging in like young people are supposed to be doing, you ended the period with a 60% total gain. And that's because you were investing during the bad times. Young people are ahead if they can buy these great asset classes cheap, but they're always afraid. Oh my God, I don't want to lose money. Well, you've already said it, Victor. The market is volatile one day at a time, but we're not living. This is talk about this idea of getting what you can right now. This is not about that. It's about forever. I mean, Warren Buffett said his favorite holding period is forever.
Mr. Paul Mayman, from a risk standpoint, if you have mentioned in your book about dollar cost averaging and lump sum investing, and I wanted to ask you, if you were to choose between these options, dollar cost averaging versus lump sum investing versus buying the dip or market timing strategy, which would be your best choice if you have received an inheritance today? Because you said in your book that dollar cost averaging can turn a losing investment into a winning one.
It's really tough, Victor. One of the weaknesses of my work is that I'm trying to give answers that would probably apply to a small percentage of your viewers and your listeners. I don't mean it's not solid advice, but the answer on these kinds of questions, so often the answer should be, it depends. Because if somebody inherits $100,000 and they're not sure what to do with it, well, I'd want to be digging in. What have you put aside for your retirement? And when do you want to retire? And what's your risk tolerance? What's your experience with investing up to this point? Because I'm going to find out if you're the kind of person that historically has been sucked in to big bull markets only to find the ground fall out from beneath you, like in 2000 and in 2008. I mean, huge losses, and that changed people's commitment to investing for the rest of their life in many cases. Or in some cases, they get out and they stay out until FOMO sets in, fear of missing out. And so they get in at high again, and then it goes down again. And you say, are they crazy? No, they're not crazy. It's just that when it comes to sex and food and money, and a lot of important things like death as well, these are not intellectual decisions. These are emotional things we're tied up with. And so an advisor, and I used to be one, you have to dig and find out. Tell me about yourself, because for a lot of people, even though all the studies show that lump sum comes out ahead in the future, but let me tell you where those studies come out of. They definitely come out of Wall Street, because if I can convince you that you should put that money to work right now instead of dollar cost averaging in. I make the sale, I get the commission now, not over 10 years and or whatever. And then you just wait to find out whether that person's going to have the staying power. In many cases, what I did, because there's a case for lump sum, there's a case for a shorter term dollar cost averaging, and there's a case for a longer term dollar cost averaging. And there's a case for the point that if you start dollar cost averaging and the market goes down, maybe the dip is 20%, maybe the dip is 30%, but at the point that it drops that far with that body of money, you're in. That's your commitment. Now, what about having a third lump sum, a third over 12 months, dollar cost average, a third over 24 months? If that gives the investor the peace of mind and the commitment to fulfill the longer term thing we're trying to accomplish, that's the right way. But there is no perfect answer. The perfect answer is for me to know the future. Well, I often do a piece about what you know. There's what you know, there's what you know, you don't know. Well, what I know I don't know is the future. And anybody who ever pretends to know, oh, Bitcoin, it's going up another 100,000 or up $100,000. Sure it is. But I've heard other people say it's not worth anything. They're right. I mean, you can find somebody to justify almost anything. But there's what you know, what you know, you don't know, what you don't know, you don't know. And the problem is what you don't know, you don't know. You have no idea what that is because you don't know what it is. But it's a risk you're going to lose. I can tell you that. Then there's what you know, but you don't do anything about it. And then finally, there's what you know, but you're absolutely wrong. Because what you know is simply a myth. And there are so many myths of investing that don't take into consideration the individual investor. It misses what good investing is about because it's you as an individual investor that is more important than my asset allocation, than Victor's asset allocation, than anybody's asset allocation. You are the mystery, not the market.
To be honest, Paul, I thought about this blend strategy of having 1/3 in lump sum, 1/3 in dollar cost average, and 1/3 buying the dip when there is a huge dip. I also
great.
wanted to ask you, because you have recently said in a podcast with Ben Felix that you have been a market timer. Do you think that market timing, which has higher value at risk but lower expected returns, should still be suitable for those conservative investors who want to avoid painful drawdowns? Or do you think that from an emotional standpoint, the best idea would be to still, the best compromise to do dollar cost averaging?
Aha, now we're talking emotions, huh? Well, I can tell you without any question, the best emotional decision is do not use market timing. I honestly don't know any more difficult strategy than market timing. Buy and hold. If you do it right, you were supposed to identify what your risk tolerance is, how much you're willing to lose to stay the course. That's part of the process. You establish that, and you've already said, this is how much I'm willing to lose. And so if you put enough bonds in the portfolio, you can stabilize, that's the brake, if you will, the amount of gas you're putting on, and that's the stock position that you have. And that gas and brake combination is what is to keep you in there because we don't want you to lose more than you're willing to lose. And I have found most people, once they really get it, are able to stay the course. They have to trust the market for the long term, but I believe most people can. Market timing, it is a nightmare because any good market timing system is going to be trying to protect against major market losses. So when the market starts down, and you get out, you do the market timing, and you go into something that isn't making much money, maybe isn't making any money. You just don't want to lose any more to the downside. But then it's not a miracle that the market turns around maybe the day after you sell out and goes back up. And now the market timing system says proudly, it's time to buy. And then, oh, okay, that means I used to have X number of shares when I last sold. Now when I buy, I have X minus shares because the shares are costing more. What idiot wants to do that? They ask themselves. And the market timer says, be patient, be patient. And then they get in, and you know what it does next? It goes back down, and it causes this automatic sell signal. It is not made for individual investors because it requires too many regrets. Read any textbook on the psychology of investing, and the one thing that we don't like to have is a regret. Human beings hate to have regrets. They don't like to admit they took a loss. They don't like to not only admit, but they don't like it about themselves. And then their spouse says, how are we doing, honey? Oh, we're not doing well. I don't want to talk about it because I've got regrets. Look, buy and hold has all sorts of risk. And buy and hold says you could be down 60%. 60% on the equity portion of your portfolio. If you're not willing to accept that, you either don't do it or you put enough bonds with it to bring it down to 20% or 15% loss. You can control that, but the minute you control that side, it means the return is going to be less. And that's what we're always trying to get the best return for unit of risk and market timing. Oh, I forgot to tell you, in a really great year with buy and hold, market timers stink, okay? Because they're built to be defensive, not to be aggressive. And yes, half of my portfolio is market timing, half is buy and hold. And for people who like the thought of leverage, a portion of my part that is in market timing combines leverage with market timing. And it turns out that has had the highest return since 1995 of any of the strategies that I've been involved with. So yes, market timing can work, but emotionally, it's the pits, I promise.
To eliminate, let's say, the emotional biases, do you think that a momentum trend following strategy would be better than a buying and hold approach? It has proven to bring better risk-adjusted returns, but it's not risk-based. It's still based on emotions.
Well, it's measuring emotions in essence is what it's doing. And a lot of what my market timing, which is managed by somebody else, I don't do it. I don't have time. I'm a retired guy, and I'd rather do this than be looking at my portfolio and figuring out what to do next. Look, here's the challenge. Momentum systems are just fine. They are just as risky if you're doing pure momentum where you're moving from asset class to asset class and you're going to be in some sort of growth equity asset class more than likely. You're not looking to go to cash. Now maybe you are looking to go to cash along with a momentum with equity and sector types of portfolios. But you will have just as much risk as an all equity portfolio. Particularly in an all-equity momentum strategy. And you will have long periods. Here's the thing, we'll talk maybe again about small cap value.
Yeah.
One of the reasons small cap value doesn't work is because you historically would have to live through many 15-year periods where you didn't do any better than the S&P 500. Well, imagine when you get all excited about value and then you get into it and then all of a sudden you're in that period where it's not that you didn't make money, you didn't get the premium that you thought you were going to get. And that just drives investors nuts. I could have made the same money in the S&P 500. Why did I take all this risk? That's part of the process. Why, by the way, I want small cap to be part of your portfolio, not all.
Talking about all equities portfolio, do you think that a young investor should be all in equities or keep some cash and bonds also?
All equities, all the time, until they're probably 40 years old. And I want to make sure that I don't sound like I'm encouraging people to take more risk than they should. Here's the thing about equities. I said this earlier, the best thing that can happen to you when you're investing in equities as a young person, and I consider 25, 35, and even 45 very young. So what do I know? I know that I'm not investing in one company. I'm investing in thousands of companies. So I'm not worried about one company not doing well. I know the market is going to be down and dirty from time to time. It's just part of the process. All I can say is it always has, and there's no reason to think that it won't be down 50% again. I have no idea when. Could be in the NASDAQ could be in the process of doing that right now. How do we know? We don't know. So when the market is down, we want the opportunity to buy more of those great asset classes, not companies, asset classes. So that we're not stuck on depending on any one sector or any one individual company. I don't think that's a wise thing to do. If you have bonds in the portfolio, what it does for every 10% in bonds, the probability is over 10, 20, 30, 40 years, it's going to reduce your return 0.5% for every 10% in bonds. So you may think that you're being smart by having some defense in your portfolio. I have a balanced portfolio, you might say. I have 10% or 20% in bonds, and I have 80% in equities. And then I would say, now, wait a minute. Do you have that 20% in bonds because you want to defend against a bear market? And you'll proudly say, yes, that's a smart thing to do. Have some to keep you from losing all that money. And then I showed them how much they're going to lose with 80% in equities. The bonds are not doing that. Their job. I mean, you think they're going to help, but they help a little bit. But what they do is they also penalize the investor because they don't allow the investor with that 20% they have in bonds to pick up more of those cheap shares. So when I talk about getting 10% in the S&P 500 and 12% in small cap value, I am talking about being able to stay the course. Because the minute you start either market timing or adding bonds, you're putting on the brakes. And so I don't expect you'll get the 10 or 12. And of course, all you have to do is look at the long-term return of bonds. There's no evidence that bonds have ever made enough to help you retire early, ever. They do fine. Last 20 years, long-term government bonds in the U.S. have done better than the S&P 500. So yes, there are long periods that in fact happens, but not for the real long term, at least not in the past.
I know that Larry Swedrow once mentioned that long-term treasury bonds in US had a 40 years period when they outperformed large cap growth stocks. So it can happen.
I mean, it can happen. And some people, by the way, I've heard this so many times, if I'm investing, let me recommend you get out. A lot of people think that whatever they're doing, that people should be doing just the opposite. That's a bad attitude to go in with. But some people do feel defeated because every time they do what lots of people are telling them, it turns out badly. And so it's just human nature. One of my favorite books is Your Money and Your Brain by Jason Zweig. And it's about the psychology of money and investing. And you will understand not only why you might be a little bit crazy, but why all of us are not just a little bit crazy, but most of us are a whole bunch crazy because we believe things that just aren't so, but it feels inside like they are. And the reason I like mechanical, dollar cost average, index funds, all these things that kind of ask you, please don't think about this. Don't feel your investments. Just maintain these very disciplined, tough-minded investment strategies, and your odds of success go way up. And if you say, well, how do I know so much? The fact is, I'm talking about the past. And if I don't leave you with anything more memorable than this, I'll be surprised. There is no risk in the past. We always know what we should have done. And that gets us in trouble because we look back and we think, I should have known that. It was so obvious. Sorry, Victor, it's early in the day here and I'm just full of energy.
Oh, that's perfect. I have a lot of more questions for you prepared.
Okay, all right.
For
Let's do
instance,
it.
discussing about costs, we all know that John Bogle, who was the father of index investing, was saying that costs matter a lot in investing, and he was recommending index fund for this purpose of lowering your costs. A lot of people only look for the lowest fees ETFs, but there might be equity holdings with higher expected returns, which have also higher expense ratios. Should we approach costs on a relative or absolute basis?
Well, let me make sure I've got this question right. The question here is the focus on the asset class versus the expense. In other words, if somebody just focuses on expense, does that mean that if I know where there is a bond fund that charges 1/100th of 1%, I should move out of the S&P 500 where I'm paying 4/100ths of 1% and get into bonds? Most people would say, nah, that doesn't make any sense. I mean, after all, the return of the S&P 500, those are stocks. Those are supposed to make more money. Well, guess what? They have. But the same should be said when somebody says, I want my money at 4/100ths of 1%, as opposed to in a small cap value fund, maybe pay 15/100ths of 1% or 20/100ths of 1%. I don't want to do that because the expenses are higher, they'll say. Well, then I say, look, here's what I know about the past. Again, my expertise is in what I can know. And so I know that what I'm about to tell you is good. Otherwise, I wouldn't tell you. You understand how that works in life. Okay, what I know from 1928 to 2020, S&P 500, 10%. That's a great return. Large cap value. Now, S&P 500 is, in a way, mostly growth, but it's got some value in there as well, but mostly growth. But what if we get rid of those great growth companies and only own the large value companies? It's more risky because they aren't the best. So what do we expect when it's more risky? As long as we're not in a penny stock environment, if we're in legitimate asset classes, 1% more for large cap value than the large cap blend, the S&P 500. Well, in my book, what you'll read is that for every 0.5%, that return that you get over your lifetime between what you spend in retirement and what you leave to others, without having to, at least in the US, invest huge amounts of money, it's $1 million plus decision every 0.5%. And there's large cap value sitting there with an extra 1%. Hey, I I want some of that in my portfolio, as well as the S&P 500. But I don't want to stop there. What about small cap blend? Small cap companies that are partly growth and partly value. Small cap blend, also more expensive to manage than the S&P 500. That adds another 1%. I'm going back to 1928. And small cap value, even more risky, another 1%. So would I be horrified if somebody, in fact, for the first 20 years of their investment life, put it into small cap value? I would not be horrified. I would just be concerned. They'd be extremely disappointed for part of the time they hold it and would give up. But I would pay more. Now, remember, 10 versus 13. Let's just say that's the choice you have. I would be more than happy to pay an extra 0.25% a year to get the extra return. But if you don't believe it, you shouldn't do it, because you don't want to give up money. In fact, you should never make an investment for which there is not an expected premium. That is so important. People will want you to invest in things that there is no expected premium. Doesn't mean they won't make money, but you will have simply been paid for getting the risk. Anyway, that's a whole other topic unto itself, as you probably know, Victor. But that would be my answer to somebody who's worried about paying an extra 0.1% to pick up an extra 1 or 2 or maybe even 3% return.
Okay, following the same approach as above with costs, what would you choose between a simple strategy of investing in one global index fund versus a more complex strategy, which might bring a slightly higher expected return for the very long term, but in the same time might be more difficult to buy, hold, rebalance, and tax manage?
Well, you know, you suggested a small additional return. Remember, an extra 0.5% to me is not a small additional return. So I just want to make sure that we're using, that's called the 0.5% extra return. Is it willing to put together a portfolio? Now, I think you know we have a 4-fund strategy that is large cap blend for 1 quarter, large cap value for another quarter, small cap blend for another quarter, and small cap value for the 4th quarter. You can get that all US, or you can get it US and international. And I think you can you can't do it exactly that way through the choices that you sent me, but you could catch most of it, I do think, Victor. But is it worth the time and trouble to make that extra return? Well, when you start looking at it over a lifetime and understanding, let me just turn it over for a second. Somebody comes to my house and wants to sell me a load mutual fund. 5% right off the top. Oh, but only one time. You're going to get into this great mutual fund, and you're going to pay. Yes, you're going to pay something, but that's for me to bring it to you and recommend it to you. And I'll always be there if you want to call me and talk about it. Well, that's sales pitch that you're going to get. Is it that 5% harmful long term? It turns out, if that's an equity portfolio, that it's about 0.5% over your lifetime per year. 0.5% per year. We're talking $1 million. That's why the title is We're Talking Millions. It's not because we're trying to blow this up into something bigger than it is. It's real if you make the right decisions. And so my view is that if you can live with it emotionally, and you understand why these different asset classes are legitimate for the long term, then I think it is worth taking the time. Not so different. I don't know about in Romania, but I can tell you in the US, there's a website, bankrate.com. Bankrate.com allows me to go and find out where should I buy a CD right now and get the best 5-year CD, 1-year CD. And then they'll show you all sorts of and you could see literally a 0.5% difference between one CD and another CD, both of them guaranteed by the US government to back the bank if it goes out of business, which means I have to bend over and pick the money off the ground. But off the ground means, oh, I got to go to another bank. I got to fill some paperwork out, and I'll just go back to my old bank. And they know you're that way, by the way. They're counting on you coming back to them. So is it worth bending over and picking the money up off the ground? For some, it is. For others, it isn't.
Fantastic comparison that you make. And that's true in Romania. A lot of people choose the worst interest rates because they simply don't care. I mean, it's incredible. Even though that 1% can matter for someone who doesn't have a lot of returns because he doesn't invest. Mr. Paul Merriman, your ultimate buy and hold portfolio aims to capture global market cap weightings, adding factor tilts without any geographical bets. Do you think that it is wrong for a young investor who can bear more risk to overweight undervalued regions like, for instance, emerging markets value equities, which should be the highest expected return asset for equities, since, as Larry Swedrow mentioned, in an efficient market, all asset classes should have the same risk-adjusted return?
This is a very tricky question because what happens, and make sure that what Larry is saying, and I agree, and I basically said it before, that additional return you get for large cap value is because it is more risky. Small cap blend, more risky. Small cap value, even more risky. Emerging markets, even more risky. Small cap emerging markets, even more risky. And you can get emerging market value. In fact, I think you have access to a value emerging market fund. But here's the part that maybe justifies the idea of not putting all your money in the most aggressive. What you get when you combine asset classes that don't go up and down together. Look what's happening right now. Technology is falling apart. I mean, it could turn around by the time I get done with this interview and be going up again, but I don't know. On the other hand, I noticed this morning, value's just doing great today. So it may be absolutely right that the expected return of each one of these asset classes is simply driven by the risk. But when you put them together, it lowers the overall volatility, and it does take advantage of some of that additional return. Yes, you're giving up some advantage, but you're also, you're going to have to, if you've never shown your followers the Callan tables, it's the periodic table that Callan puts out. Fascinating. It will show, I think maybe 10 or 15 global asset classes, U.S. and international asset classes, 1 year at a time for over a 20-year period. It's a beautiful, colorful chart and a graph. And you'll see emerging markets, bing, at the top, move at the bottom, top, bottom, top, bottom, bottom. I mean, it's all over the place. And that's fine for some people who truly understand what that all means. On the other hand, I am sure there are people right now who are concerned of what's going to happen in those emerging markets with the challenges of the coronavirus. I mean, the pandemic may hurt those people at a whole other level. How are things in Romania right now, out of curiosity? I don't know. How you doing?
With pandemics?
Yes.
Not very good, not very well, but we have a lot of debt and it is increasing. The public deficit is increasing, so I don't know what the government will do.
And that is the same problem, I think, that a lot of countries are having. And we don't know the outcome of that. So that may mean that down is a lot further down than people expected they were going to have to go. And for those people who have the commitment to see it through, my problem as a teacher is I'm teaching to the middle. And I'm an aggressive middle compared to John Bogle or all these people who say just put all your money in the total market index. I do not give up and say that. But on the other hand, I don't want to go all the way to the right where people will say, Paul says it's okay. Yeah, it's okay if you want to lose most of what you got and can stay the course. And if you'll live a long time.
Mr. Paul Mayman, you have mentioned in one of your Sound Investing podcast episodes that just because an asset is uncorrelated, referring to gold, it doesn't mean that it has earned its place to be part of your portfolio if it doesn't offer any positive real returns. Have you changed your view on gold given the increasing money supply and zero or even negative interest rates environment?
No, I can tell you that. Now, when somebody believes something, what they typically do is try to find somebody famous to back them up. Okay, and if you got to, there's a thing. Just a second here. There's an old quote. Here it is. Here it is. I'm going to read this, but I love it because I could not memorize it. This is from Warren Buffett, one of my heroes, not because of his track record, because his track record hadn't been very good the last 15 years, but because he does tell the truth, at least as far as I know, and I like truth tellers. He says if you took all the gold in the world, it would roughly make a cube 67 feet on a side. Now, for that same cube of gold, and this was written, I don't know, 4 or 5 years ago, it would be worth at today's market prices about $7 trillion. That's probably about a third of the value of all stocks in the United States. For $7 trillion, you could have all the farmland in the United States. You could have about 7 Exxon Mobils. You could have $1 trillion of walking around money. And if you offered me the choice of looking at some 67-foot cube of gold and looking at it all day, and you know me touching it and fondling it occasionally, call me crazy, but I'll take the farmland and the Exxon Mobils. Now, that's as an investment. What you may be talking about, Victor, is what about gold as the brake? Remember, there's the gas and there's the brake. So I have favored, not just because of Warren Buffett, but because when you look at gold, it's very volatile.
Yeah.
And it can be volatile to the downside at the same time as the market is volatile to the downside. Call me crazy. But from my viewpoint, long-term government bonds, now I'm talking U.S. here, I can't speak for every country. Long-term government bonds make the same long-term rate of return as gold, approximately. But when the market decides to go south, like 2008, long-term government bonds were way up. And gold does not hold that up that well in the catastrophic. If I'm going to ask for the brake, I don't want to be sitting there heading towards an accident, pumping the brake, trying to get it to work, and then wham, it doesn't work. I want the brake that's going to work. And I trust the government bonds better than gold.
Which unfortunately is only US long-term treasuries, because other asset classes are not that good for uncorrelated returns. But even those bonds now will generate negative real returns, I believe. So going forward, we are at the end of the long-term bull market in bonds of 40 years, I think. I'm struggling to understand whether they are still a good diversifier or not.
Well, I'm glad you asked that, Victor, because to be fair, what we recommend, if you look at our portfolios, are short to intermediate only. They too, by the way, held up well in 2008, not as well as long-term government bonds. But yes, for the break, you're probably, because long-term bonds can be hit if the interest rates go up, but not like gold can be hit in a really bad bear market for gold. So yeah, short to intermediate. Now somebody will say, why should I put money in bonds? I mean, they don't make any money. Well, the reason they are in my portfolio is not because I'm expecting them to make money. It's because I'm expecting them to do better than money market. And historically, if I have some intermediate and then short term, I even have some tips in the portfolio on our website, then I'm not looking, I'm probably going to do better than a money market fund. I'm taking a little bit of risk, particularly when it's a catastrophic event. Money market funds aren't going to skyrocket like bonds could. And so, no, I am not a big fan of long-term government bonds for the purpose of being able to protect against short-term losses. But they're okay compared to gold.
And cash can still be a good hedging for market downturns, at least in countries like Romania, where you take some currency risk if you go into other countries' treasuries.
So, yes, of course. And that's an interesting question that I have for you. Tell me how people feel about investing in things that are dollar denominated, US dollar denominated. Would you be concerned about that currency risk?
I think if it's in equities, I wouldn't be, because the equity risk premium will cover all the currency risks in the long term. But with these low interest rates, if it's for treasuries, I would be very concerned. And I think even if you euro hedge your portfolio, you still pay something extra on that hedging. And also that you have some expense ratios for these funds. What I'm doing in Romania is to combine cash in euro, which is a better currency than our local currency. We are exposed to Eurozone, of course, with some local treasury bonds, which are also in euro and have a higher yield. Of course, they also have some credit risk, but as a risk-reward scenario, I think they are better than foreign developed bonds, which have negative yield to maturity. And we have some tax advantages to it, so could be some...
Yeah.
Of course, they're not, I don't think they are uncorrelated in market downturns, so wouldn't be a protection which would work in that case. But you still get your principal, let's say 5 years for an intermediate term bond issued by the Romanian government. So I think I'll get my money back. So somehow I feel safe about it. But once again, not an uncorrelated asset class. And as Larry says, some of that yield is not only your return, but also the premium for default. So you have to assess that risk, of course.
And the reason, if somebody looks at my portfolio, they would realize I don't really pretend to know about the future. I am an individual that has been afraid of the catastrophic all of my life. And so I am half US, half international equities. I am half large, half small equities. I am half value and half small blend, and half large value and large blend. And I'm half buy and hold and half in timing, and in the buy and hold, I'm half in bonds. So if I knew anything, I wouldn't have all of these halves. By the way, I want to make sure that it doesn't sound like I'm adding all these halves up. It's when you look at half large versus half small. I mean, every one of those is a legitimate comparison. I just got the money spread everywhere that I know that it's a legitimate asset class and is likely to create a premium over time. And hopefully, my children and charities that matter to my wife and myself will benefit from us doing this and never exposing our money to a Bernie Madoff, never putting ourselves in a position of believing somebody's individual sales pitch. They're too good. They're just too good. And so I'm in index funds. If I could be smart enough, I'd be in the best actively managed funds. But I have no way to know. And why should I believe any money manager when it turns out that the index funds over 15 years beat 90% of the actively managed funds that are run by smart people? I'm just hiding to protect myself from the crooks. I'm not sorry. I shouldn't call them crooks. I'm hiding from people who think they know more than they do, which includes me. I'm hiding from myself because if I started getting involved, it would be emotional. I would be right in there second guessing by the day what I should do next. I am protecting myself from me.
It seems that you have a well-balanced portfolio. And speaking about rebalancing, which is a powerful tool to reduce risk in investing, what rules would you use for it? Let's say purely discretionary, like once per year, or using a rebalancing table like Mr. Larry Swedrow recommends? And also, how would you avoid generating taxable events if you don't have an IRA account like US investors have?
Well, for young people, I'm not all hung up on rebalancing. In fact, I think if there's any rebalancing to be done, it should be done with new money being invested. And the difference, when I look, for example, at the 4 asset classes going back to 1928, the big, the small, the value, et cetera, the difference in return is not huge by not rebalancing.
Yeah.
But it does, and it does end up having more money in some of the more risky asset classes because they made more. When we get to be old, it's a different story. Us being 50-50 stocks and bonds, I don't want to be any more than that. I want to rebalance from time to time. And the people that manage my money have a very sophisticated strategy that they use, and I'm fine with it. But it's not something I'm going to try to get other people to do because it's a lot of work. Now, I like Larry Swedrow's. In fact, I don't know if I can find it right here. I wish I could. His latest book, I'd hold it up, about being a successful investor. It is terrific, and he has that rebalancing strategy in that book. I think it's just fine if somebody wants to try to do better. I am quite okay with once a year. Now, obviously, in a taxable account, that's a whole different story than in a tax-deferred or tax-free account, where I think there are got to be more thoughtful in a taxable account. By the way, a lot of people don't know this, but when you look at actively managed mutual funds versus index funds, there's about a 1% advantage in annual return just due to the different tax implications. You have to go kind of hunt around at Morningstar to be able to compare how an index fund does compared to the average actively managed fund. It's about 1% extra return for the S&P 500. Here again, I'm looking for 0.5% to change somebody's life, and they're putting 1% on the floor again, on the ground for me to pick up. I wouldn't ever recommend an actively managed funds if there were tax questions about the returns.
Mr. Paul Merriman, I was impressed by William Bengen's paper on determining withdrawal rates using historical data. How probable do you think it is for the foreseeable future to use a 3% safe withdrawal rate if you have, let's say, at least 50% allocated in equities, And what if you have only 30% if you are more conservative? And when do you know that you have enough to retire from working?
Well, let me take the last one first.
Yeah.
I find that question one of the truly most interesting questions, because here again, when I was in the investment advisory business, I retired in 2012. The time that goes into understanding the needs of an investor, it could take 3 to 6 hours before any money is put to work under the firm's management. And that is because everybody's situation is different. You can talk about textbooks, and when you talk about textbook distributions, you can see Bengen's 4% and 3%. And in fact, he would agree with us that as you broaden the equity exposure in your portfolio, it allows you to take out more. I've done a couple of articles, and I do them every year. One is on fixed distributions, and the other is on variable, flexible distributions. My wife and I take out money on a flexible basis. It should last forever, whatever forever is. But the reason being is that we are taking out 5% at the first of the year of whatever the value of the portfolio was at the end of the previous year. Now, it is absolutely amazing to see how well that strategy stands up compared to somebody who takes out 5% and adjusts it each year for inflation. I mean, it's night and day. But when you're taking the flexible instead of the fixed, you ignore inflation, which means it's for people who are retiring with more money. So if you want to be flexible, I'm thinking you need to have 1.5 times what you would likely have to retire with 3 or 4% using that kind of a distribution plus inflation. So there's a lot of moving parts. Now, I have some very exciting news from our end. Our job, we are a nonprofit organization. I get nothing. The two researchers that work with us, Chris Pedersen and Daryl Balls, they get paid nothing. They are volunteering their time to do some of the most amazing work for the people who follow our studies. We, with the help of an amazing young man, are building calculators so that people can go into all of the tables. We have over 150 tables that you can dig into, different strategies, different combinations of U.S. and international value and growth, etc., going back to 1970. And you'll be able to plug in whatever you got. I mean, these tables show starting with $1 million. Well, what if you have $821,000? Now you plug it in, you got the calculator, it goes through, rebuilds the tables to who you are. And you can start them from any time, 1970, 1985, whatever. So we also have it set up so that you can look at 200 years of performance for different time periods. So by the time you use these calculators, you will have tested what I think you need to know, what will probably work, and you need to know with any strategy how low is low and how low can you go. I have warned a lot of people. You think you can start with $1 million and let it go down to 700,000 and still stay in the strategy when you're retired? Well, think again, buddy, because it's not going to happen, because it's hard to find a spouse that likes that feeling.
And
so you look at, well, what if I had 50% in stocks and 50% in bonds? How would my spouse, male or female, feel about that? Differently, I can tell you. And you'll see it in the tables. So I don't have a perfect answer for you, Victor, but we're working on it to make it fun for people to test their situation.
And by the way, this is why buying the dip is so risky, because there are infinite scenarios from a higher point where you can get -5%, -5%, -5%. And there are financial educators in Romania who actually recommend people to buy at each -5% decrease of the market. And people can take too much risk if this is more than their risk profile, let's say. So I believe this is why your strategy works and works forever, because there are infinite scenarios for which you can get -5%, -5%. And by having this 5% withdrawal rate from a new amount, basically your portfolio will never reach zero. But of course, you can reduce in absolute terms lower amounts if the market continues to go down. So
yeah,
it's a risk of future
people,
consumption.
It is a challenge because every strategy has a weakness, and it's easy to find the weakness. I don't care whether it's buy and hold or timing or dollar cost averaging or lump sum. They all have a weakness, and that weakness has a probability of happening. Can't always tell you exactly what that probability is, but I can tell you for a lot of you, you wouldn't be happy or satisfied or relaxed with that probability. So that's why if I can get somebody to get into an index fund where they're likely to be in the top 10% over 15 years, and that isn't even very long, by the way, and the longer the period it is, the fewer the funds that are going to be in that top 10%. Their probability of success is better than most investors, even though they're never going to be in the hot fund. Never. And that's a lot to give up for some people. But if you can end up in the top 10%, I'm thinking that's reason for a celebration for most of us. I don't end up in the top 10% almost anywhere in my life anymore. I can't run as fast. I can't swim as fast. I can't think as fast. If I could just know that my money is in the top 10%, I'm thinking I'm doing well at my age.
Mr. Paul, I have two more questions related to, one is them related to dollar cost averaging and the other to retirement. So in your latest book, we're talking millions, 12 ways to supercharge your retirement. You say that dollar cost averaging will guarantee that your cost for the shares you own will be lower than the average of all the prices you pay. Can you explain us why this happens? And also, which are the odds for this strategy to underperform lump sum investing for 10 years?
Well, okay, now I'll answer one of them. By the time I'm done with the answer, I may have forgotten the first one, but I'm going to answer the second one first, okay?
Sure.
Okay, how does dollar cost averaging not work out versus lump sum? Well, as I said, there is a situation where that is very possible. For example, a person, let's say that they inherited $100,000 and they decide to dollar cost average in over 10 years.
Yeah.
$10,000 a year. Let's say for the first 9 years, they get 10%. And then in the 10th year, they get a -50. We know from 2000 to 2009, there were two bear markets of a loss of 50%. So it's just not like it would be a miracle if this happened. Now you compare that, now that would be a lump sum. By the way, if you did that with a lump sum, before I do dollar cost averaging, I think you end up with like $135,000. If you dollar cost average $10,000 a year,
yeah,
you would end up with about 72,500. And this is the problem with dollar cost averaging.
Because you took all the loss and only a part of the gains, right?
Yes, exactly. Thank you for that's. I should have said that. You're right. And so sometimes if somebody says, I want a dollar cost average in over 12 months or 24 months, I'll say that's fine, but understand this. It is possible that over the 12 months, you will be buying in ever rising markets.
Yeah.
You finish it. You congratulate yourself for having gotten in without panicking. You're all in. Then the market takes a nosedive. You cannot eliminate
The risk.
risk.
You postpone it
And-
into the future.
Yes. And that's right. And I do think that's the reason why I encourage people as they can to oversave, because I don't know what bad thing is going to happen to you.
Mhm.
And I would love for somebody to say in 50 years, there was this old guy that said it was imperative to oversave. So we decided to do that. And now we're okay, because if we hadn't oversaved, we wouldn't be there. And that's the business I'm in, trying to leave a crumb of knowledge that somehow will impact people over a lifetime. By the way, I want to share, because you have a lot of folks, I'll bet, who are fire people.
Yeah.
And I ran into a young fellow lately. I want to share what he's doing, because I hadn't run into somebody who was doing this. He is a man who is absolutely committed to helping others with his talent. And when you use his talent in the world of nonprofits, you don't make much. You don't make enough that you can do any more than meet your basic cost of living. He's not able to save the way that he needs to save. He made, I just thought, the greatest decision, and it's so obvious, and now that I hear it. He decided to leave what he really loved and do something. I don't know that he hates it, but he can't wait to get back to what he loves. He is going to do what he doesn't really like to do compared to what he loves
For money.
for about 5 years. He's a young person putting away enough money that money will be enough, if it's just left to grow 30, 40 years out, that it will supply him the income that he will need, that he would not have otherwise had. And if by chance it's not quite enough, because he loves what he's doing, he can keep on working. And in a sense, it's what I did as I thought about it, because I didn't have to retire. But what I really loved doing in all the years I was building my business, I loved teaching. And so I retired, and now I work just as many hours in the day. I was up about 4 o'clock this morning, kind of thinking about this conversation we're having today. And I'll be working on it until 6 o'clock tonight, other things that I'm trying to do to help others. If I had to go back to work because I took these 8, 9 years now without any income, I'd be happy to go back to work if I had to, because I got to do what I wanted to do. But in his case, he's saving all that money back now when he's young, but not for very long, because he really wants to get back to where he's adding value in the world. And I think that's a wonderful mindset. I don't mean that people who don't have that mindset are wonderful, but I love that commitment to helping others. You got it too, Victor. You do. You know, it's wonderful, and I envy your youth. I don't envy the fact. Well, I guess I envy the fact that if you do your job, there's a whole bunch of people there that you can help, because not enough of them have found their way. So
For sure. Most of them. In Romania, 99% of people don't know about money, which is incredible because you go to school for so many years and learn about all the nonsense in the world, but don't care about what is most important in your life, because
Yeah.
we like it or not, money affects our life. So why do you go to the job and get a salary if you don't know what to do with money? I mean, it doesn't make any sense. And as you
Well,
said,
by the way, we only have 5 states in the United States require a class on personal finance in high school. 5 states. And I'll tell you, if the banks wanted young people to understand money, they would have lobbied the schools a long time ago. The best thing that has ever happened to the banks is that very few people got the education. And it's not about being greedy, avarice. It's not about piling up money. It's about having enough. And too many people will not have enough because nobody simply taught them how to do it. There are so many people, and I'm sure this is true in Romania, Victor,
Yeah.
so many people who think the stock market is just a big gamble.
gambling. Yeah.
Oh, what do I know? Here's what I know about the past. The worst 40-year return for the S&P 500, the worst was an 8.9% compound rate of return. The best was 12.5%. Well, if you look at the worst year, yeah, you would have lost half of your money. But this is not about a year. When I started my business with $15,000 plus a loan, I didn't think about it as 1 year. That would have been idiotic because that would have been crazy. I didn't make any money the first year. I really didn't make any money for 5 years. And that's the nature of getting started. And I wish there's a table I would love. In fact, I'll send it to you.
Sure.
An article about putting money in a little bit at a time. And what I want people to see is that in this particular table, it assumes you're saving $1,000 a year over 51 years. It shows at the end of each year what you were worth in the S&P 500. At the end of the first year, you put in $1,000. The profit was $22. 22. And somebody told you this is the thing you should do to build $1 million account. And that's because you cannot, if you think about it, 1 year at a time, you're sunk, you're lost. But by the time you go out 10 years, guess where most of the profit came from? It came from the money you put in. And that's the way long-term investing works. The early years, you are the hero, not the stock market. But then all of a sudden, you've got enough in there that it is the stock market that's making you look good, because it's making so much that it's many times what you're putting in. And yeah, you might stop putting it in at some point because you think you're way ahead of the game. I hope you don't, because you never know. But it is you asked earlier about those early years. You are the champion, the hero of the early years, not the stock market.
And then the stock market becomes the champion.
Yes.
But what intrigues me, Paul, is that people discuss about stock market as being gambling, but they don't want to learn to invest in index funds, which are basically a tool for diversifying risk. As Larry Swedrow says, you don't run away from risk, you diversify it. And they prefer to gamble in individual stocks, Bitcoin, and these things which have huge idiosyncratic, uncompensated risks, and are basically a tool for gambling. So I don't understand if they are afraid of this, of the stock market. What are they doing in such unfiduciary way?
Well, I will tell you why they're doing it, and this is a shame, but this is why they're doing it. It's because people who care more about themselves than about the investor are selling them these things
Yeah.
and not stopping them and saying, look, you know, it's fine that you're doing, but maybe you do that later when you've built the foundation. But why don't you come back and talk to me in 10 years? Oh, no. I need your money now. And so what is it about the index fund? Well, here's the bad news about the index fund. Basically, it's the way really rich people invest. And I think a lot of young people they can't think of themselves as being rich.
Yeah.
They think that rich people get there fast. And a few do. I mean, I think about the people that did the Dogecoin. You know, I mean,
Dogecoin?
it's called the Dogecoin.
I think it's a cryptocurrency, right?
It was a joke, and now it's worth, somebody said $35 billion if you look at the value. And of course, people do win lotteries. It doesn't make any sense to buy a $1 ticket. I mean, if you're better off to put that into an index fund over 40 years than you are to buy a lottery ticket. But people see that as the only way they're ever going to be like those rich people. Those rich people, I'll never get there. Well, you can get there. I'm not a rich person, but I've got more than I need, certainly enough. And most people, well, by the way, you can always marry somebody rich. And that's another way to do it. That may be more likely than taking all the time to figure out Bitcoin. But the bottom line is slow and steady. This is why I'm not a great fan of Robert Kiyosaki. He's not kind to mutual funds. At least when I read him, he wasn't kind about investing in mutual funds. Made people kind of feel like a dope. Well, when you read the rest of the history of Robert Kiyosaki, he writes a great book and motivates people to do things. And I can't argue with that. I would love to have the number of books in people's hands that he does. But the bottom line is that those books are for selling.
Yeah.
They're not for reading. That's how I feel about it. And I know I'll get hate mail for that. But, I'm too old to try to pussyfoot around these topics. But you know something? What happens? And here's what I like about this conversation, Victor. There are 5 people out there because of this conversation whose lives will be changed. You don't know who they are. I don't know who they are. They will get the free PDF at your site and all. They'll read it. Maybe they put one of the 12 to work. Maybe they'll put 2. If they put 8 of them, wow, I think that would be great. But our conversation will change some lives. And that is why I am so happy to be here. I would never have a chance to talk to the 1% potentially of folks in Romania. And thank you for asking. I really am happy to be here. And I hope we talk again in the future if I can be of any help. Okay?
Sure, Paul. It was a great time having you with us today. And I appreciate very much that you have been in our podcast. You are a very wise man and very humble. And I enjoy that you want to teach others how to stay the course. Because as John Bogle once said, I've said stay the course 1,000 times and I meant it every time. And I'll end with this quote from a legendary investor from Oaktree Capital, Howard Marks: invest, you must. Now, final last words are yours, Paul Merriman.
Well, I will, since you brought up John Bogle, I will share that I had the great fortune of spending 90 minutes with him about 3 years ago, I guess almost 4 years ago. It changed my life because it made me realize that the things I was recommending to people were too complex. And they were the things that we have done for our clients for at that time, well, now 40 years. My old clients from my old firm is still there. They're still taking care. In fact, they're taking care of our money as well. But he was right. Asking people to do it the way that we did it professionally was too much. And with the help of Chris Pedersen and Daryl Balls, we have worked hard since 2016 and 2017 to make it simpler and to try to help people who really would like to be able to set it and forget it as much as they possibly can. So I hope that people will continue following your work. We have a website. I would love it if they went to paulmerriman.com and followed our work. And both Victor and myself, I know, would love it if you had the ability to send other people to our sites. Because when you're in the job of teaching and you love teaching, you want more. It's like an addiction. I want more, and I know in my heart, Victor wants more. Please feed our addiction, and all the best to all of you. I do wish you all the best luck and good investing. Thank you, Victor.
Thank you very much, Paul. I wish you to enjoy your retirement years and continue doing what you're doing. You're doing a wonderful job for all of us. I have discovered you by watching your sound investing podcast, which was great resource, even though we don't have access to all those instruments in Romania because we have UCITS versions here for ETFs. But you're doing a wonderful job for us all.
Thank you.
And I'm wishing you to have a great day, a great year. Stay healthy, and wish you all the best. Bye-bye, Paul. All the best.
Bye-bye.
Everybody to tonight's presentation. My name is Jim Hopper. I am the Executive Director of the Bainbridge Community Foundation. And we like to begin our events with a land acknowledgement. So this is true of Paul and I, who are located here on Bainbridge Island. We are on the ancestral land of the Suquamish people. As Chief Seattle said, every part of the soil is sacred in the estimation of my people. Every hillside, every valley, every plain, and every grove has been hallowed by some sad or happy event in days long vanished. So recognizing that we are on Suquamish, the Aboriginal land of the Suquamish people, the people of the clear salt water, expert fishermen, canoe builders, and basket weavers, the Suquamish live with harmony in the lands, with the lands and waterways along Washington's central Salish Sea, as they have for thousands of years. Here the Suquamish live and protect the land and waters of their ancestors for future generations, as promised by the Point Elliott Treaty of 1855. My name is Jim Hopper, as I said, the director of Bainbridge Community Foundation. This marks one of our most favorite times of the year when we get to share some financial education openly and easily and accessibly. And we have a wonderful guy by the name of Paul Merriman to thank for that. Just want to note too, if you go to our website and you click on the events tab over on the left-hand side, you'll be able to scroll down and see what we've got coming up. We've got two more of these presentations. Christine Benz is speaking next week about investing in retirement. And then Mary Beth Franklin will be speaking the following week about Social Security. So with that, just a couple notes. Today's presentation is closed caption. You'll see a little CC button in the Zoom menu down at the for most of you at the bottom of your screen. Feel free to click that for closed captioning. We also have a Q&A feature. So if you click on the Q&A button, that's where you can ask questions of either Tom or Paul or both of us. So with that, I'm going to introduce the distinguished Paul Merriman. Of course, Paul is a nationally recognized authority on mutual funds, index investing, and asset allocation. Many of you are familiar with his books, his podcasts, or his regular column in Wall Street Journal's Market Watch. In retirement, Paul's really dedicated his life to ensuring that people have access to financial tools. People have access that in the past was typically reserved only for those with great wealth. So he's really taken this on as his personal passion. We've been doing these financial education series with him since 2016, and we're just delighted to have him. So I'm going to welcome Paul, who's going to introduce Tom, our speaker for today.
That's great, Jim. Thank you so much. It really has been a joy, and I look forward to many more years of these financial literacy. By the way, I should mention, we had Tim Ranzetta last year before. He runs an organization called Next Generation Personal Finance. They have a mission of having every high school in America by 2030 have a required course on personal finance, and he has gone a long way in getting there. Many states now do require it. He's not responsible for every one of them, but I will tell you what he just got. He just got a commitment from Michael Jordan for $100 million, $10 million a year to underwrite the work that he is doing. So this is, I think, a huge step in getting the youth of America educated, having to do with personal finance. So I really congratulate Tim Ranzetta for his accomplishments. But today, I am here to introduce a truly dear friend and somebody that I respect and I enjoy. And we've been friends for about 30 years. In fact, at one point, we worked together doing a podcast and radio show. I went to a dinner last night to celebrate the 40-year anniversary of my old investment management firm, Merriman Wealth Management. I was asked to speak, and I was asked to talk about some of the things that made a difference in the early years of our company. And I talked about my son, who was there by my side for most all of those years. I talked about Rich Buck, who used to be the financial writer at the Seattle Times and joined our firm. And not only did he work with the firm for many years, but he retired about the same time as I did. And Rich and I still work trying to communicate with people about investing. And I mentioned a name that you might not know, but his name is Dennis Tilley. And he was the guy that came aboard and brought us some of the most interesting and I think profitable research on investments and how to build portfolios. But the fourth member of that team of the powerhouses who made a big difference in our company and its growth was Tom Cock. He came in, he showed me how to work with, he was the expert. He came from the radio industry. He had TV experience. And so he helped us build a radio show that aired in Seattle for, I think, a decade. He brought us into the podcast community. And then after he made us a much better firm in terms of communicating with people, he left. And he left to start his own firm and has since built a remarkable firm here in the Northwest, was known as Vestory. Now he is a part of Appella Capital, a national firm with branches around the country. And Tom, I think, as I understand it, you are the managing director for basically the West Coast offices. So you can tell the rest of that story. But I'll tell you, here's a guy that has devoted his career to teaching others, not only at the Merriman Company, but in his own company. He has a radio show along with Don McDonald, Talking Real Money, and they have a daily podcast, Talking Real Money, and he has all of that commitment to helping the individual investor that I've always wanted to have myself. So I couldn't be happier than to introduce you to Tom Cock, and he is going to talk about what do you do when you're 40 to 65 years old and you're getting pointed towards retirement, and the steps and the pitfalls. And Tom, it's all yours. Thanks for coming and joining us here at this this annual affair.
Well, thank you for that terrific introduction. Although I never see myself as Ringo, so I'd rather be like George or one of John maybe, but I guess I'll go with it. But thank you for that. And I will say this about my lengthy friendship with you, Paul, and all that I've learned from Paul and all that I've stolen from Paul. In fact, it was about 10 years that my son heard Paul speak, and he came back in and he said, "Did you take everything from Paul? I mean, didn't any of this stuff yours?" So it's been a great friendship, and I'm blessed truly to have you in my life in so many ways. So thank you for that. And before I begin, and I'm going to see if I can share my screen here. I'm going to spend much of the time, not necessarily on investing per se, but on kind of a little bit about planning, because we all want to jump into making money before we really think about what we're trying to do. And before I do that, I want to tell you, investing is a fascinating thing. There are so many ways to invest your money, so many ideas, so many people telling you what to do, so many voices that are coming at you on a regular basis. And the reality is, for most of us, it's a process of elimination. There's many things you should never invest in. And when I was thinking about today, I just put together this brief list, and I'm always amazed how big the list is. For example, non-traded real estate investment trusts, variable annuities, equity index annuities. These are all things I would not suggest you put your money in. Hedge funds, options and futures, derivatives, viatical settlements. You don't hear as much about them today, but they certainly are still out there and people are still pitching them. Master limited partnerships, which made some people money, but not necessarily the people that owned them. More recently, things like cryptocurrency, I always forget, SPACs have been popular, initial public offerings, actively managed mutual funds. Paul and I share a belief in using index or index-like mutual funds. Gold and precious metals. I don't think you should put your money in commodities, currencies, art, and collectibles. And I hope I don't have to say this, but I don't think you should invest in lottery tickets and hope that that is somehow an investment. So those are things I would sort of rule out without a second thought, frankly. And because I've seen people make so many mistakes in putting their money in things like that and not having eliminated them before they even get started. I will say at the outset, and before I even show you any of this, that there are things I truly do believe in. One of them is being globally diversified, holding stocks all over the world. And I'm going to share with you what I believe about and how to do that. Another one is paying attention to your costs. Most of Wall Street really has no interest in saving you money. They're really interested in taking your money. And the people that have been smart investors, the information that Paul has shared with people for 40 years, helps you understand how you can do this at a much lower cost. I do believe in rules-based or index-style investing, and I do believe in some factors of investing, which I'll talk about here in a couple of minutes. So, but before I get into what you should do with your money, as I say, most people who call our show, and Paul kindly mentioned that we have a program called Talking Real Money. It airs here in the Northwest on what is now Northwest News Radio, Saturdays at noon for 2 hours. It's live call-in, and we take every call. We don't screen anything. We take everybody. Few people from time to time call in and argue with us. But the number one question we get, it's a fascinating thing. The number one question is, I just came into this money. What do I do with it now? And this is human nature. We just tend to put all this stuff off until something arises. Either I'm close to retirement, I received an inheritance, I'm starting a job. One of my favorite all-time calls was a young man who had recently become a physician. He said he had $500,000 in student loan debt, and he also borrowed another $500,000 to join a practice. And he said, "What should I do now?" And I unkindly said, "Get to work," because I couldn't think of anything else catchier to say. But most of the questions always seem to revolve around investing What do I do with the money? They skip this first part around planning, because unless you know what you're saving the money for, unless you have a plan about your finances, you really shouldn't be investing. You shouldn't just take this money out and say, well, I hear the hot thing today is fill in the blank. You should have, in my mind, especially in this period, 40 to 65, at least a 5-year plan. And I'll tell you about mine. I just turned 65, and my 5-year plan is to not touch any of the money I've saved until age 70. I want to keep it growing. I want to make it. I also figure that if I don't touch any of it till 70, there's a very good chance that I will not run out, even if I'm lucky enough to get 90 years. And that's kind of my personal goal. But that's my plan. But everybody should have a 5-year plan. I'm saving for a house. I want to have this much in my retirement account. I want to start a saving plan for my child. Some sort of plan before we just start rushing out and doing putting money aside, which brings me to saving. There is no correct number in terms of saving. There is no, magic bullet, if you will. There is, frankly, you read all the time about if you're 30, you should have this much saved. If you're 40, 50, the rules of thumb are rules of thumb. They're really not worthwhile. But if you had to push me, if you had to say, I got to do something, what should I do? I would say anybody in this, especially in this 40 to 65 period of time, should be saving, probably 15% of your income at the very least. And you should be doing this in either a pre-tax, like traditional IRA, and I'm going to spend more time on all these things, a post-tax Roth IRA or 401k, which, remembering that money goes into an account after you've already paid tax on it, or a brokerage account. And this is something we're going to be talking on our podcast next week. It's fascinating to me that you could actually set up a brokerage account, live off the investment income from that, and pay zero in taxes. And this is why more and more times I think you shouldn't just be putting it all in a traditional 401k or IRA or Roth, but brokerage should be carefully considered as well. And then the investing part of all this. I mentioned the things I would not like you to invest in. I wouldn't touch. Our clients certainly don't. We manage money here in the Northwest for about 800 individuals. I think it's a little over $700 million, and sort of across the country, it's a little more than 3 billion. And we would never touch an actively managed product. What am I talking about? I'm talking about a mutual fund or exchange traded fund that has someone there picking stocks or timing markets or telling you this sector is going to be better than the rest. And none of those people know any more than you do. You're not going to believe me when I say that, but that's the reality, because the future is uncertain. And we're going to share with you some numbers, and thank you, Paul, and the Merriman Foundation for providing these on a regular basis that looks at sort of how groups of stocks have performed over the last 53 years. I think you can somewhat reliably look at that and say, maybe the future looks this way. But the reality is we know nothing about the future starting tomorrow. In fact, I didn't even see what the market did today. So it was a very busy day. But investing should be using index or rules-based products, if you will, low cost, tax efficient, and any index product in and of itself should be relatively tax efficient, and then properly balanced. This is for each individual, and I'll spend a little more time on this, between stocks and bonds and a diversified portfolio. But if you're between 40 and 60, what are generally some of the things you're saving for? Well, we're going to talk about emergencies. We'll talk about retirement. We'll talk about paying for college. And then we'll talk about this other thing that I see a lot, but I question whether you really need to do, and that is other real estate. I've never been one to own a second home, but I know many of you do. Many of you want to. Maybe you want to get a place in the Southwest and get out of this weather for a time. But we'll talk about sort of how you should be saving, how you can save for that, and the best ways to do so. But first, to the emergencies part. This is one of the mistakes I see most people make. They either have way too much saved in banks or are sort of cash-like instruments, or way too much in stocks, and they don't realize which one they have. In fact, one of the things we've done with our firm since I left Paul a long time ago, for absolutely nothing, we will sit down and look at your portfolio and tell you how diversified you are, how much you're spending on that portfolio, how much risk you're taking. Every person should know that about all of their money. I had a client come in today, wonderful client, and hadn't seen her in a couple of years because she's been very busy and didn't want to come in because of COVID. And her cash has piled up to about $200,000. And it's at the Bank of America, which is paying her 0.02. This is so inefficient, right? In a day where, and I just looked this up, if you're saving for emergencies or some other short-term goal, right now, and you can learn these, I got bankrate.com up here. You can go to Bankrate and simply click on high yield savings. It's CIT Bank, and maybe they're trying to pretend to be Citibank. I don't know. CIT Bank, you can now make 4.75% in a high yield savings account, 4.75. And that is every bit as safe. It is FDIC insured. It's every bit as safe as any of the major banks, even though people have got this weird thing now. I want to have all my money in Bank of America. Every bit is safe, at least, especially up to the 250,000. Or you could get a 10-month CD at Marcos Bank for 5% now. 10 months at 5%. So the idea that you have that cash is trash is kind of gone now. And you can, in fact, a lot of suggestion about whether or not you should be balancing your portfolio between things like this and stocks rather than using bonds. And we can talk about that in a couple minutes. But for emergencies, I personally think between 6 and 10 months of what you need to spend is a great plenty. If you're worried about your job, then maybe you have a little bit more, or you have a goal within 5 years. I would have it in this sort of instrument. I don't believe in owning stocks if I'm going to need the money prior to 5 years, for example, because there are periods of time where stocks are down for that period of time. I hope we're not in one of them right now, but you never know. So you got to be ready and you got to be prepared for all those things. So that's my take on kind of emergencies. And this should be high on the list, especially if you're between 40 and 65, especially if you have a family, you have others who are relying on you. You don't want to be in a position where if something bad were to happen, you have to take money out of your retirement savings, for example. That would be a bad thing to do. And I do want to remind you again, I think Jim mentioned this, that you can at any time you can ask questions. Paul's going to be keeping track of all those, and we're happy to answer them as we get time. And we'll certainly answer them all at the end. So emergencies would be part one. Part two would then be saving for retirement. And this comes before saving for college. This comes before buying a vacation home or a boat or some other thing. Retirement between 40 and 65, you are truly in the red zone and you should be saving. I'd like to see it be more than the 15%. In fact, for old people like me over the age of 50, you can save $30,000 this year. $30,000 you can set aside, and you could split that between pre-tax and post-tax. And for those of you who oftentimes call our show and say, well, this is really unfair because I'm self-employed and I can't save, it's harder. I just looked this up. It's a fascinating thing to me. I believe with a SEP IRA, you can save up to $66,000 a year in that. So there's a lot of opportunity. But let's just talk very quickly about employer plans, because that is the main place I see people saving, right? You're working for a company, you have an employer plan. And as I said, most plans now offer either pre-tax, which reduces your current tax bill, or post-tax Roth. Which one do you do? Well, as we tell many people who call our program, it depends. It could depend on your current tax rate and what you anticipate your tax rate to be when you retire. It depends on which bucket, if you will, you saved more into. As I mentioned at the beginning of our chat, I truly believe that that you should have money in each place: pre-tax, a traditional Roth, and then a brokerage. Because when you get to the point, and if you're in your 40s or 50s or 60s, you're getting closer to the place where you're going to start drawing that money out. You're going to want to have money in each one of those buckets, if you will, again, that will allow you to pull from those and figure that out from a tax standpoint. People often forget, for example, that when you pull money out of a traditional 401k or IRA, you pay tax on that. And we oftentimes remind people that when they come in and meet with us that you may have saved $500,000 in your retirement account, but that's really only $400,000 by the time you give the government their piece of all this, right? So your savings is not as great as you may think it is. So the employer plan should be carefully thought about. And here's another thing, ran into this recently. If you have a hard time saving, you should at least save in that retirement plan up to the match that the employer provides. And there's some great matches out there. I think Boeing's at 6% now. Just talked to somebody, I can't remember, another major employer is at 5%. That's a lot of money. So you should at least save up to that and get the free, absolutely free money. There's no reason to not get that. Then there's these health savings accounts. And if you're in a plan that allows for that, there's a place you can save up to, I think, $7,500 per year. And in fact, for the tax year 2022, you can still make a contribution here in the next few days. One of the few ways you can still save on your taxes for 2022. And I think most people don't know that. And in that particular account, because that is truly designed for health emergencies, I might split that between the, like a bond or a savings type of a vehicle, cash type of vehicle, and then stocks. Mine's a little more aggressive because if I had a problem, I could write the check for the healthcare, and I'm really using this as a long-term savings vehicle. But again, I think a split between those would be a reasonable approach. And then there's the good old Roth IRA, which goes back, I think it's about 23 or 24 years. It's still way underused for my taste, because there's a couple of things to think about. Remembering that this grows tax-free. There is nothing else, frankly, around that I know where you can put the money in and you get the growth and you take it out and you don't pay any tax on it. It's a wonderful vehicle. It opens up all kinds of possibilities in retirement. And I know this talk is designed for 40 to 65-year-olds, but if you have kids and grandkids, it is an absolute gift if you can get them started saving, and you can do it in a Roth IRA. And I've just proud to say that my 15-year-old daughter, who's worked for her mother's pizza company a few summers, has actually had, W-2 income and has a Roth IRA. And, one day in 50 years, when she starts to draw that, I won't be here, but hopefully she'll remember me fondly in some ways. Say, Dad made me start with that Roth. Look how big this is. And Paul, I think, has done some wonderful work on saving for young people and getting them going. But if you're working today and you're between 40 and 65, I would advocate, if you can afford it from a tax standpoint, current tax standpoint, that you put some money away in traditional and some money away in Roth. Sometimes just splitting the baby is a good strategy over the long haul. And then for you self-employed folks, I mentioned SEP IRAs are out there. They're a wonderful tool. You can save the money there. They're available at major custodians, and it's really not that hard to set up. And the costs are pretty doggone low. And again, you can invest in low-cost index or index-style mutual funds or exchange-traded funds. And then finally, the good old brokerage account, just your regular old account at Schwab, Fidelity, Vanguard, any major custodian, where you can put that money in. It should be invested in a tax-efficient manner. I wouldn't own things like REITs in there. I wouldn't own actively managed funds there. I probably wouldn't have very many bond funds if I can there, because remember, they're paying out income that you may have to pay tax on. But all of these places are absolutely great things to do for your retirement. And again, that should be in my mind, the highest priority. Obviously, once you have the emergency set up, retirement should be next, and we'll in a couple minutes spend some time on actual portfolio development of all of that. So those would be the things to think about in terms of retirement. And then next on my list for you is paying for college. This, unfortunately, I think many people believe this is sort of a God-given right. They have to provide for their child's college. And as I regularly remind my clients, you can borrow for college, and you can't borrow for retirement. And your retirement is really something that you should do well before paying for college for anybody. It should be the priority. Got to take care of yourself. I see too many people that think, now I'm going to make sure my kid can go to a very nice school. And of course, as you know, the costs have appreciated way outside of inflation for major schools. But if you're going to do save for college, I love the 529 plan, which was set up by the government. It's a Section 529, and it allows you to put money in, and then that money grows tax-free until it's taken out and pay for educational expenses. Now, if you take it out and use it for something frivolous, you're going to pay tax on it. And by the way, they changed the rules a few years back, and now you can use it for secondary education as well. So it doesn't just have to be for college. So 529 plans are a great way to save. It comes out tax-free to pay for any of those expenses. I love the plans, and I could debate this with Paul because he probably spends more time on this than I do, but I love the plans at Utah and at West Virginia. I love them so much that my grandson's got one at one and one at another because I want to see how the performance was between the two. And here's the part that is important. I use, and I'm in the business, the age-based plan. In other words, they do all the work. So when the baby's born, Paul is a 5-month-old grandchild, that money is all in stocks, right? It's the riskiest. It's going to be volatile, but you hope for 10, 11, 12% a year if you're lucky. And then as that child gets closer to college age, they reduce the exposure to stocks. They increase the exposure to bonds, remembering that a stock is equity in a company. There's a lot of volatility to that. A bond is an IOU. So there's an aspect of you'll get paid back, hopefully, with interest. So they do all that work for you. It's a wonderful program. They do it at a very, very low cost. There's no commissions anymore. Remember when we started talking about these things, Paul, 20 plus years ago, there were all kinds of commissions, high expense plans that states had in place. But the age-based plans at Utah and West Virginia, I think, are very, very good. In addition, Secure Act 2.0, which was signed into law earlier this year, added a huge incentive, I think, for 529 plans. They're now going to allow you to take $35,000 out of that 529 and put it into the child's Roth IRA. And you, of course, the child still has to have earned income in the year that you make that contribution. And the money, I believe, still has to be in there for the 5 years before you can start taking it out and doing that. I plan on and not spending all my daughter's 529 down and throwing that into a Roth at some point. It is another huge advantage for people that have saved in a 529 plan. So it's a great, absolutely wonderful advantage for people that set money aside for that. And then this is my last on my list, really. Other real estate or boats or all those other fun things you got to save something for. I don't, I guess I had mentioned, believe in investing money in stocks if you're going to need the money sooner than 5 years. So that's why I said CDs or high yield savings here. I just think that you need the liquidity. You'd be putting it in stocks. You'd be hoping that the market went up. Don't know the market's going to go up during that 5-year period. That I think it's very important in those sort of investments, if you will, that you have it set aside in something that is extremely liquid. Further, and it comes to real estate, a lot of the questions we get around real estate are, this is an investment that's going to make me more than anything else. Well, maybe. It's the real estate market in the Northwest and certainly the greater Seattle area has been phenomenal for the last 25 plus years. It really has. It's been off the charts. If you look at the longer term rate of return on real estate coast to coast, I think going back to 1955, it's more like inflation plus 1%. It's not where we have enjoyed all these years. And when I hear those numbers, I think we're going to go back to the mean. It's not going to continue to go off the charts this way. At some point, you run out of people, tech firms or whatever are going to run out of people to keep sending people to buy these fancy homes at high prices. So I think real estate shouldn't be necessarily an investment unless you're going to turn it into a business, right? You're going to be in the business of, flipping homes or owning homes to make rental income. I truly that real estate should be a lifestyle decision. I'll give you an example. One of my goals here and before too many years go by is to spend more time at this time of year in places that are sunny and warmer, because I get tired like you do sometimes of this weather. And so I'm going to rent, like I'm doing next week down in Arizona. I'll rent a nice house, got my family coming with me, and I might do that for a month, but I really do not plan on owning any other real estate other than what I have. And let me add one more thing, because this comes up a lot in terms of real estate, and that is mortgages. People believe, and I think I heard Paul once say 25 years ago, it does not make sense to have a mortgage in retirement. I think that is more psychological than it is financial. For example, if you have a mortgage today and you've had it for more than 5 years, your mortgage shouldn't be more than 2.5% or maybe 3%. Because if you refinanced, as you should have a couple of years ago when rates are very low, the cost of that loan is very insignificant. Further, when you're in retirement, it's all about liquidity. You need cash to pay the bills, to take the trips, to do all those things. If you took a bunch of your cash and you paid off your home, now that money's locked up in that real estate and you can't get to it. In fact, one of the only ways you can would be a HELOC or a reverse mortgage, both of which can be very, very expensive. So real estate should be treated carefully. For me, and I think hopefully for you, it should be more about lifestyle than it is about getting rich per se. And I think we're about to find that out in the Northwest. Who knows what the future holds, but I don't think it can continue up to the moon the way it has here in the last 25 years. All right. So actually building the portfolio, the investing part, the fun part, right? Because everybody wants to know about having dessert before they even get to the main course in my book. And you got to have the plan first before you can sort of say, all right, how do I make a lot of money? Well, employer plans. And, you know, it was a long time ago. We set up a website. I can't remember the URL, Paul, but when I was at Merriman, we set up a website. We started analyzing company retirement plans, 401ks. And it must have been 25 years ago because we did the plan for Amazon. And we put it up on the web and we said, here's how to invest it. And here are the weaknesses in the plan. And I'll tell you what, they must have been watching the internet because they called within a couple hours and said, take that plan down and don't worry, we're fixing our plan. We know there's shortcomings, but we're going to make it better. And that brings me to kind of employer plans in a general sense. The limitations generally are they don't have all of the assets, the groups of stocks we think you should own. And we're going to walk through those in a minute. They generally have actively managed high expense funds, right? And the other part is oftentimes they still match part of the money in company stock. I'm not a believer in owning individual stocks. I should have added that to my list, in fact, because individual stocks are just too risky. Companies come and companies go. The portfolios that we use, the portfolios that I think Paul supports, own thousands of companies because some will become the next Microsoft one day and some will be Washington Mutual. We just don't generally know that ahead of time. We generally know if we've invested in what we think is a great firm that blows up in a very short period of time. You've just seen that recently in the banking industry, certainly. So in an employer plan, here's the way I look at it. First of all, how to pick the funds. I look at every employer plan and people send me tons of them every week. I go through and put a circle around the ones that are index funds. And generally they say index in them. If they don't, then generally they're an actively managed fund. And again, remembering that an index fund is just a group of stocks that's designed to look like a particular index. Could be the S&P 500, could be the Russell 2, could be the UEFA. It's an index that matches that particular group of stocks. If you own anything else, you're probably paying a high expense ratio, right? So you want to own index funds. Then part two is you got to figure out the asset classes that you have in there. In other words, one might be labeled Standard & Poor's 500, which is the 500 best companies in America, biggest and best. And interestingly enough, by the way, and we'll show you this here in a minute, to own far more than the S&P 500 has meant more money for you and has actually over time meant less volatility for you as well. And here's another interesting fact. The S&P 500 today is made up of about 13% in two stocks because Apple and Microsoft have gone up rapidly this year, where the index is sort of, I think it's still up about 7%, but nothing like those two funds. So now if you just hold the S&P 500, more than 10% of your money is in two stocks, and that's just too risky for me. So the employer plan has those options. And then the part that you have to decide on, which is hard, is how much risk to take. And if you're between 40 and 65, you probably want to have some fixed income in your portfolio. Remembering fixed income is, I use that term interchangeably with bonds because it's the same type of security and it is an IOU. And here I believe in secure fixed income. I don't believe in taking risk with things like high yield. I don't believe in emerging markets, other parts that might pay you a little bit more, but you're going to take volatility for doing so. The bonds for me should be the safe part of the portfolio. The stocks should give you the lift. So you're going to own some bonds, but how do you know how much? Well, We actually have a free risk quiz that you can go take at our website. Go to talkingrealmoney.com, click on risk quiz. You get a little, you go through, answer a series of questions about your emotions and about what you know about money, and it gives you a score. Yeah, that's something to consider. But again, between 40 and 65, you probably need to have some fixed income. For me, by the way, investing is not necessarily about being the richest guy in the room, because that's never going to happen for me. And so it doesn't matter. For me, it's about making the money I need to support my lifestyle and retirement. If anything left to my kids, that's great. But I'm not looking at home run. I'm looking for a series of singles and doubles. But that's how I look at a retirement plan. Again, finding the index funds, finding the right asset classes. We're going to show you here in a minute how to balance those, and then deciding for yourself. And remember, this is about you. Investing is not about what's going on in the world today, what might happen tomorrow, what's going to happen in the election next year. These things come at you every day. They're out there. And there's a lot of voices that are screaming at you about this and what's going to happen next. You need to tune all that out. You have a plan. Here's what you're trying to do for the long haul. You're saving, you're investing. The next crisis will be there no matter what happens. And then the second part of all this is the Roth IRA. You know, I love, as I mentioned, the Roth because it gives you this wonderful component of tax-free growth. Here's the great part about a Roth. For people that can do one, who have their income limits, and I think for a married couple today, it's, if your income exceeds, I think it's $215,000, you cannot do a Roth. But you can still do a thing called a backdoor Roth, which allows you to put money into an IRA and then immediately move it over to a Roth. The Roth gives you exposure oftentimes to other asset classes. Hate using that term because it sounds so jargony, if you will. But these are things that often are not in retirement plans. U.S. small cap value stocks, which is something Paul has led a crusade on for the last 20 years to get you to invest in this, because that has had going back 100 years, the best return for stocks. It's the most, I think, underutilized asset class. International small cap value, emerging markets, things that traditionally are not in employer plans. So what you can do is you have the employer plan that gives you the base, right? Stocks and bonds. But then in this Roth, you have the unlimited portfolio options, the riskiest asset classes. And remember, those riskiest asset classes should provide the most growth, right? Because they're going up and down, but they're going up more than the other ones. So now your growth comes a lot in the Roth, which is tax-free growth. I think it's a fantastic instrument. And again, for a young person, if you can get your kids, the minute that they have income, I mentioned my daughter, I'm proud that she has a Roth, and I'm hoping to do the same for my grandkids because I think it gives them such a huge start. But remember, the minute they have income, you can put the money in that Roth. And there's some wonderful products there now. Before we started all this, I was talking to Paul about the Avantis Global Equity Fund, AVGE. That is a globally diversified portfolio that tilts, if you will, to smaller, to more value stocks. It's very inexpensive. It's one fund. You got, no work. You just put the money in, and my hope would be you get double-digit growth there. So it's fantastic. I mentioned the SEP and the simple. Again, the same principles hold here. You want to be globally diversified, you want to be low cost, and you want to have the right mix of stocks and bonds. Now, this is the table maybe you've all been waiting for, because this is where the rubber meets the road. And this is Paul and Paul's foundation work, and it's wonderful work. Frankly, it's fantastic that they produce this every year because it gives you a real look at how things work. But I'd urge you to, I'm only going to use the top part because the bottom is even more complex. And I know this looks like a lot, but it's pretty easy to decipher, actually. I figured it out. I'm not a big numbers guy. It sounds kind of funny to be in finance, but that's not my focus. My focus truly is people. And one of the great benefits of my job is I get to meet so many of you, and I absolutely love it. I think Paul referred to it once as eating chocolate cake every day, which I probably do, and I shouldn't do that either. But anyway, I mean, it's a wonderful thing to get to know so many people. But this is truly where the rubber meets the road, because this is how stocks have acted over a long period of time. So this portfolio, and this, he named this correctly 25 years ago, is the ultimate buy and hold equity portfolio. Why is he called the ultimate? Because it's the best we can find. It's the best looking at all these numbers to put together the portfolio. And as you can see at the top there, it says 50% US, 50% international. That means half of your stock exposure is in the United States, half is outside. And some of you are going to say, that's crazy. I'm an American. I love America. Well, me too, by the way. And maybe some of you can see the planes behind me. My father's in the US Air Force. Great love of this country. But remember, almost half of the value now of firms is outside the United States and half is inside. So it's not unpatriotic to invest properly, to spread your assets over all of these places. But start with the column there on the left that says the S&P 500, because many of you know this index. It's regularly quoted by everybody as kind of this is how you invest. I wish, frankly, they'd regularly quote the Vanguard Global Fund or something else, because I think it's more accurate. But this is the S&P 500, and this is 53 years of data. So I think it's fairly reliable to go back and say, yeah, this is how things have kind of acted. But what they're showing you here is the growth of $100,000, right? Going back to 1970. And the only way we can get you this return is if you have a time machine. So I don't think we can do that, but I wish we could. But if you put that $100,000 in the S&P 500, by the end of last year, that grew to $18,900,000. Wow, that is significant growth, right? That's far more than you would have gotten in bonds or cash or other investments. It's been terrific. It's a great return, and it's to be truly admired. There's your annual growth rate, 10.4%. The standard deviation is the bounciness, the volatility. That's something to pay attention to. But the purpose behind this table is to show you, if instead of just being in the S&P 500, you add in other asset classes, other groups of stocks that many of you don't own because you don't know about them, you don't know how to own them, it's complicated. But if you did, it makes a huge difference, because look at the next column. So you have the S&P 500, and then you add in the LCV, stands for large cap value stocks. The S&P 500 is mainly growth. The difference between growth and value firms are firms that are underperforming for whatever reason. The industry may be underperforming, all those things. They're beaten down. There's a guy named Warren Buffett who made a pretty good living buying value stocks. It worked out pretty well for Warren, and still is apparently. So he owns those. And we use a mathematical equation that looks at sort of what the market says, the stock market says it's worth, versus what the accountants say it's worth. That's a value stock. So you're buying these unloved, beaten down companies, and instead of just ending up with 18 million, now you end up with 20 million. Maybe that's pretty good. You made a little bit more return. I mean, I think it's fascinating too, by the way, that you end up with a significant more amount of money with just 0.2 a year of difference of returns. This is something also many of you underrate. You think, well, if I make 8 or 9, the difference between 1 or 2% over a long period of time is huge. That's another reason to use low-cost index products, because the higher cost is simply money that's coming out of your portfolio going into someone else's. It's an expensive way to operate. I'll put it that way. Then the next, oh, pardon me, I didn't mean to do that. If I can go back here, the next column is important because it shows you adding in another asset class here, the U.S. small cap blend. These are, and when we refer to the size of a company, we're referring to the market capitalization. You know the huge companies, right? I just mentioned Apple, and I mentioned Microsoft and Tesla and all these big, huge firms that have grown so dramatically. You don't know the small ones. You don't hear about them regularly unless something goes wrong. But as an asset class, as a group of stocks, they've added significantly to your portfolio. So the next column, we're simply saying, let's add in small cap blend. But more importantly, the next column, let's add in U.S. small cap value stocks, smaller firms that are sort of undervalued, if you were. Look at your $18 million is now worth $27 million, a huge difference, if you will, right? And so adding that very important asset class added $5 million more. You didn't have to do a thing. You didn't have to be any smarter. You didn't have to read the Wall Street Journal. You don't have to listen to Talking Real Money. You have to listen to Paul, all that stuff. All you do is invest this way and you let it ride. Now you do have to annually rebalance back to the correct percentages, right? But in a general sense, your workload is pretty low. You're better off than the people on Wall Street who have to perform well every quarter or they lose their jobs. You don't have to worry about any of those things. You simply are diversifying the portfolio. The next column is REITs, real estate investment trust. I mentioned I would not recommend non-traded REITs. These are tradable REITs. These are companies that own commercial real estate, apartments. I used to say shopping malls. I don't know if there's anything that exists other than Bellevue Square anymore in terms of shopping malls. So those are an asset class that actually you can see they don't add much to the return, but they sort of counterbalance. They don't go up and down together with everything else. They have sort of different return characteristics, if you will, and that has helped. I keep doing that, and I apologize for moving this thing forward when I don't mean to. So that would be another one to have in your portfolio. Then you want to, if you can, add international, which many of you do not own. And I'm going to apologize again for clicking. I guess I'll stop clicking. International, as you can see, adds a huge amount to the portfolio, okay? It adds another, if your initial return with the S&P 500 was 10.4, international makes it 11.7. Huge difference. And then the final column here, taking it all the way up to, and I'm having trouble getting to it. That's what I was trying to do because my picture's in the way here. It takes it up to over 12% a year. And many of you will come in, by the way, when I meet with you and say, just circle that. I'll just take the 12% a year. And as I mentioned, you can't do that unless we go back to 1970. But I do really believe that those asset classes are important to own, no matter what the future may bring, no matter how all this shakes out, because diversification is truly the one thing you can do. It's the one free lunch on Wall Street. And I'll tell you what it does. It assures you exposure to all of these parts that one may be great, one may not be. And I'll go back, it wasn't that long ago, 2000 through 2009, the S&P 500, the column all there on the left, actually had a losing decade. You remember they referred to it as a lost decade, where if you had all the rest of this diversification, you made about 5.5% per year. Huge difference. Doesn't always work out. By the way, in fact, since the Great Recession of 2008, the S&P 500 has outperformed these other asset classes. But over the long haul, you can see that by being diversified, you've made more money. You've had to deal with more volatility, right? The portfolio has gone up and down. So the idea here is to show you that diversification works, that you need to own other asset classes that may be hard for you to buy, right? Because your employer plan may not have U.S. small cap value, but you could go own it in your Roth IRA. You could own it in a brokerage account. There's other places you could own it, and you need to have that in your portfolio. I'll put it that way. So, and it's underutilized. And I want to thank Paul again for being the guy that regularly touts all of this. So asset allocation, I mentioned sort of owning all these things. Here's the part that's the toughest out of all this. It's Paul and I were talking about when this ends, we get to go have dinner. It's the discipline to all this. It's sitting at the table, knowing when to push yourself away. You got to know yourself about money. You got to know yourself about how you deal with risk or ups and downs. It's a fascinating thing that we have looked at the behavioral part of all this for years. We're all built differently. And people's feelings about risk of loss. I'm okay with seeing my portfolio go down a lot because number one, I'm still working, because number two, I've seen that happen many times. And for number three, I have a belief in companies, in businesses. And that's when you're investing in the stock market, that's what your belief is in. I've owned a lot of businesses since I started the Holly Jolly Berry Company at age 11. So I've had a lot of, and some have worked, as Paul knows, and some haven't worked, not unlike a lot of other businesses. But that's when you invest in stocks, that's what you're doing. You have to trust in that. And the stock market is not a mysterious thing. It truly is a vote on capitalism, if you will, every day. So you need to know yourself. I mentioned the the risk quiz. You can go take that anytime at Talking Real Money. Number two, you've got to diversify. You really should try to own thousands of companies if you can. If you can't, then you need to find a way to do that in other parts of, as I said, in a Roth or a brokerage account. You need to watch your expenses. I think I did say that we look at people's portfolios. We do this free where we analyze them. I'm always shocked that people don't know that they're paying sometimes an advisor 1.5%. And then on top of that, they're in mutual funds. They're charging 0.8. They're paying over 2% of their money to somebody else. That's paying for some other kid's education. That's paying for somebody else's vacation, not yours. You got to know what you're paying others. Number 4 here. This becomes more important as we're in our 40s, 50s, and 60s, certainly, is knowing your time horizon. I mentioned mine is still, I hope, more than 5 years. We're negotiating a new deal for me right now with my partners. I'm hoping to keep working because I like working. I enjoy it. I think they want me too. But you need to start thinking about how soon you're going to need to draw that money, because one of the biggest mistakes I see is people get to retirement. They do not have a withdrawal plan. And by the way, you've got some wonderful Christine Benz is a fantastic speaker, truly knowledgeable. And I think Mary Beth Franklin on Social Security, she's one of the top experts in the country. So you're lucky to have Paul Merriman there at Bainbridge. Has really got some wonderful, wonderful speakers coming up. And Social Security, again, it's still like 40+% of people that wake up at age 62 and take it, which is absolutely tragic because you're locking in a low benefit. But you need to know your time horizon. You need to know how long until you're going to need that money. As I said, if you're within 5 years of needing it, you need to have something in fixed income that is going to supply the ballast when stocks go down. And by the way, yes, I know bonds had a very difficult year last year, a very unusually difficult year, and it was a strange year because you had stocks and bonds go down. I still believe in fixed income. I still believe in the debt of the United States. And by the way, if you've noticed, bond funds this year, I look at DFIGX, that is Dimensional's Intermediate Term Government Bond Fund, it's up almost 4%. Because if you go look at what it holds, it's a fascinating thing. The bonds that they have that are these 6 or 7 year bonds, those are starting to come up that we're paying 1% and 2%. Those are going away. All the new paper they're buying is 4, 3.5. So they're starting to get this new paper and that's going to start yielding the way bonds used to. So for people who are savers, I think we're going to get into a better place with fixed income. Here's some recommendations that, and this again, your portfolio design, your portfolio balance is about you. It's not about me telling you. People oftentimes come in our office and say, well, what do you think I should do? And I say, I have no idea. You need to have a plan first to know what rate of return you need, not what rate of return you want. We always want more, but then you put that in place. I say at age 40, maybe you have none in fixed income. If you can take the heat of seeing your portfolio down by half, then that's okay. If you can't, then you need to add fixed income to sort of alleviate those bumps. At age 50, 80% in stocks, 20% in bonds. I think I've publicly said I'm 65 and I still have 80% in stocks and 20% in bonds. I may have that till I die. I don't know. I'm okay with the volatility. And my wife, by the way, is more conservative than I am. We come from very different backgrounds, and she has a fear of loss much greater than I do. And so her portfolio is 60-40, just managed differently than mine because she's scared she remembers how bad it all was in 2008, 2009. So at age 60, maybe it's a 60-40. That's 60% in a globally diversified portfolio of stocks and 40% in bonds. And before we get to some of your questions real quick, I just want to tell you some of the mistakes I see as a practitioner. And as I said, I'm blessed because I get to talk to so many people. People either have way too much in stocks or way too much in bonds, and they don't know it. They have built a portfolio once, maybe when they're 25, the money keeps piling up. And remember, if the money keeps piling up, it's going to pile up way faster in stocks than it is in bonds. So they don't know that. Most of you do not hold small and value stocks. The reality is it's harder to buy. The reality is it's not in very many employer plans, so you have to go buy it on your own. Both Dimensional funds and Avantis funds have terrific portfolios of small cap value funds. You can buy them exchange traded funds. Now they're very inexpensive. Most people do not pay attention to fees. They hire somebody that they like. They have an emotional connection to that person, or their parents had one. We trust them. We're taking care of it. And then when we pull that portfolio apart, as I said, oftentimes the expense can be 1.5%, 2.5% a year, which is just in today's world, you don't have to pay that much. And here's another one that I see regularly. And because a lot of people call the show, what should I do now? the market's down. I've got to do something here. And the reality is, as John Bogle, I think famously once said, stand up and do nothing, or sit down and do nothing. Because if you have a plan, if you know what you're trying to achieve, your portfolio is about you. It is not about the market, because the market is going to do whatever the market's going to do. Hopefully, as I say, we're getting ready for turning that around here, but we never know. Even Paul doesn't know what direction the market's going to head from here. I put my email. I'm always happy to answer any questions. As I said, Talking Real Money. You can send us questions there. We're blessed because Paul sort of understates the fine work that we were able to do together in 2008. Sound Investing that we did with our friend Don McDonald was picked as the top money podcast by Money Magazine. And that was a lot of fun to do that show. And Sound Investing is still available. You do a great job with that. We've been lucky with Talking Real Money, that is now, I think, in the top 60 investing podcasts. So that's fantastic as well. I think I'm at my time here, Paul. I don't want to overstay my welcome. I've tried to be careful about that kind of thing.
I thought that was great, Tom. And yes, there are some questions. But before we take the questions, I want to make a comment about that ultimate buy and hold portfolio. Each time you added money, it was 10%. And so by the time you have the 10 different asset classes in there, you've got all those 10% pieces. Also, just to make it clear, when that international comes in there, it's 4 10% pieces, that because it's the large cap, blend, value, small, et cetera. So it is a massive diversification. And if the next 40 or 50 years could be like the last, it would be wonderful for
both of us, by the way. I'm hoping the next 40 looks the same for me as it did the last one. And by the way, I want to tell, for people that do not know, if you go to paulmerriman.com, Paul has wonderful portfolios at Schwab, Fidelity, Vanguard that you can just go use. And they're very sophisticated and frankly, they're as good as a lot of advisors give you. So they're great. The difference between doing something like that and hiring somebody like me is you got to do the work and you got to stay the course and you got to rebalance. But many people do that. They're wonderful do-it-yourself investors. But Paul, bless you, because he's made all of this absolutely free to you, so you can go there and get on with your financial life in a terrific way.
Well, I do know that more people than not need some guidance and some help. Let me shoot a couple of questions at you here. Paul asked about this 15% savings rate. Is that of your gross, of your net? And I would add, do you include the company match, or is that the bonus on top of the 15?
I'm going to say it's of your gross, and I say the company match is the bonus. The reality is, and I don't think I mentioned this, but I meant to, we all forget about taxes and expenses. I just did my spreadsheet at the beginning of the year where I only look at my money twice a year, beginning and middle. And I put my house in. Here's how much a house is worth, and here's what I owe on it. I keep paying down what I owe. But here's the thing I forgot. It's not worth that, because when I go to sell that, I'm going to pay somebody, all in with excise, et cetera, it's somewhere between 6 and 10%. So the true value, what's going to come to me is less. When you save money pre-tax in a 401k or IRA, that money is going to come out and you're going to give the government, 12, 20, whatever percent of that. So it's actually less. So yes, I'd prefer 15 of the gross plus the match would be the bonus on top of that.
That's great. And Wendy asked about the Roth limits, the difference between a Roth IRA and a Roth 401k.
So anybody can do a Roth 401k. There's two limits. There's the income limit. If you want to do a Roth IRA and you're married, I think you can't have any income above, they always change it on me. So I think it's about $215,000, something in that area. And if you're single, it's significantly less. But anybody, if you have a 401k Roth, can do that. There's no limit. Number two, I believe for you young whippersnappers under the age of 50, I think you can do $6,000 in a Roth this year, and I think us old people can do $7,500.
And certainly this discussion about, and I'll just weigh in here a little bit on the use of the Roth versus the regular IRA. I've always been afraid that life might look like it was when I went into the securities business in 1966, and the marginal tax rate at that time was about the highest was 70%. The previous year it was 90%. And when I see the problems we have in potentially funding Social Security and the debt that we are accumulating, it will not surprise me that in the future we might have higher tax rates. So even though it may not be viewed as exactly the perfect thing to do to take the Roth, but when you do that Roth, you do not get a refund. You do not blow that refund on a vacation. It stays in there and it is earning that money to be tax-free. So that's just a side comment.
No, it's a good comment. And by the way, in terms of taxes, and we're not going to debate this because I'm going to let you carry the day, but I will say I take current tax policy as tax policy, because I don't think, even though with the sunset of a bunch of stuff, I think after 2025, nobody knows what's going to happen. But you're right. Having Roth is a great advantage. Huge.
Yeah. So Michelle wants to know, you made the comment that first you do the 401k, the retirement money, and then you do the college education and other things. But that is a little bit of a challenge, because how is Michelle going to know when she has put enough away into retirement that she could start doing this other thing? Because without some sort of a table that Michelle should know that she has to have a certain amount of saved for the long term. I mean, is this a job for a financial planner to help her figure that out, or what's your advice?
Yeah, yes, I think a good planner could certainly do that, but I think there's also online calculators that could help you kind of say, if I save this much, if I make 6% a year, where do I end up? And if I have $500,000 in 20 years, what does that really mean? That's a very difficult question, because our lives change too, right? I worked for you. I made a very good living. Then I went a couple of years, started this firm, made nothing for a couple of years. So that all changed. Now I make good money again. So yeah, that's very difficult. I mean, my point, if it was close, I would put my money in the 401. I would make sure, and in today's world, you can, I think with the 401ks, you can put in for under the age of 50, $22,500 this year. So if you max that, then there's nothing more you can do there anyway. That, and then maybe a Roth, then you would be inclined to do the 529. But I don't think I have a great answer for that, other than either finding an online calculator or talking to a financial advisor.
Well, and that'd
be a great question, by the way, for Christine Benz next week.
Yeah, you're right. You're right. Yeah. And there's a question that kind of sits on the edge of what you're talking about today and what she'll talk about next week. And that is, how much do you need to retire? And from 40 to 65, that's where most of the money is going to be invested for folks. And so if they don't know what that amount is, and of course, this goes back to that plan you want them to make, then how can you know how much you have to save? How can you know how much risk to take? How can you know what you want for or need for a return? And so those are moving parts that we have to sit here and I'm not a planner, but we have to sit here and make a judgment about something 25 years from now, but we still have to try to do that. So what is your simple formula for how much money you need to have set aside?
I think there's some pretty good research that says you have to have 20 times your current salary at retirement saved, which sounds like a lot, but I think that's a number you hear from time to time. Again, that is really, it's just a very difficult judgment for me to make, even as somebody who does a lot of planning. And most of the work that we do is for people who are 50 years old and older. So they have a certain amount, and we can pretty well say, if you keep doing this for another 10 years, 15 years, whatever, here's where you could end up. We don't know what the market's going to be like for the next 10 or 15 years. But when you get younger than that, there's just a lot of moving parts. That's why I would say either max it out, do the 15, get the match, and then if there's anything left, you do the education after that.
And there are a lot of people who believe it should be 20, not 15. I mean, and there are a lot of people who believe that young people today are going to work till they're 70. And
I hope so. They keep paying my Social Security. That's what I
that's
hope.
right. Yeah, we need that. But it does also, in that planning process, I'm not sure that having that 20 times, by the way, 20 times would suggest a 5% distribution, as opposed to 25 times would represent a 4% distribution. But there are a lot of us who feel that we should be trying to save for more than enough, not because that we want to be rich or we want to have a lot of money just to have a lot of money, but because things don't work the way we expect them to. Life isn't as simple as the plan, and that things come up and then all of a sudden we didn't save enough. So I just happen to come down on the save more than you need. Let me ask, here's a question from Alan. He says, what about money market funds for cash? Right now at Vanguard, you can get 4.75%.
Yeah, I mean, I would, again, a little bit depends on whose money market fund it is, because this has all come into question since the bank meltdown. I mean, I would probably want to use I think Schwab as a government or federal money market fund is paying that. I think that's a very reasonable approach. I see no issue with that. Those are all, that's what I'm saying. With all of those sort of cash instruments, now you can make something. I'm pretty comfortable with the high yield savings. I've used that for a long time. And I can move the money back and forth very quickly, but you can do the same thing in the money market. I think that's a perfectly legitimate method of doing it.
Yeah, can I answer a question, Tom, here?
Yeah.
Oh, well, no, it's addressed to me. I see. Where can I find the best funds to invest for each category for portfolio 7 in the table, the ultimate buy and hold table? And we actually have on our website, paulmerriman.com, go to portfolios, and then you go to you'll see ETFs, click on ETFs, then you go to best in class ETFs. And Chris Pedersen, our director of research, has spent many, many hours going through every asset class and finding one that he considers to be the best. And he's been doing this for years now and doing a great job. Now, here is a question. Does the evidence from Ricky, does the evidence support the same expected premium of it for international small cap value versus US small cap value, or is the evidence more shoddy?
You know what? I'm going to just say I don't know. I'm going to let you answer that. I don't know.
I will. I'm happy to.
Yeah, please do.
Ricky is right. The evidence is more shoddy, and it's not because it's shoddy in a bad way. It's because we have small cap value returns that the academics have pulled out of all of the returns going back to 1928 in the US. We do not have that in the international. But I will tell you, if you look at, we have a piece coming out just in fact, it's out today, I think, on YouTube about the different portfolios that we recommend. And it shows that going back to 1970, the international small cap value with the US small cap value had a 1/10% better return. But, it's who knows how that's going to be. But what we do know, and we do know from the academic research, that small cap value pays a premium in international markets as it does in the US. So
I'm going to stand up for the international markets here just for a moment for a couple of reasons. First of all, as I mentioned, the US market has been far better, especially large companies, since the Great Recession of 2008, 2009. So would you rather buy something that's been great or buy something that's been out of favor? Number two, This great country that we live in was an emerging market 150 years ago. You were lucky to get your money back from bonds. You could buy railroad stocks that would go bankrupt. This was a wild place financially, and look where we are today. So you tell me, where's better opportunity in places like that could come along and do great? You move your money out to all those places. I still think there's more opportunity there. We'll see what the future, what it does. But I would want to sprinkle some of that everywhere because I don't know what's going to be best.
Well, and Tom, I might mention that because that is a 50-50 split, the table that you shared. We also have done that same study for 70% US, 30% international. So,
and that's come up, as you know, Paul. I mean, the US and international was about 50-50 in terms of market cap about 10 or 11 years ago. Today, it's closer to 60% US market cap in the US 40. So we manage privately to about 60-40 now.
So Ricky asks, when de-risking in retirement and adding more bonds, should you also lower risk by lowering your small cap value allocation? And I guess just to ask it a little more about that, Tom, this idea of changing fixed income as you get older, do you also recommend changing the equity asset allocation to a more conservative?
Now, there are people that do that. Our friend Larry Swedroe, I believe, recommends that. He sort of de-risks the stocks. I do not. But I think it's a reasonable approach. I think going on a glide path from more stocks to less stocks will do it enough for you. But I have all the respect in the world for Larry's work, and I think that's a reasonable. I think you're splitting hairs a bit there, and I don't think it's anything really to be that excited or worried about. But I know he does, and there are others that say, yeah, you should lower the risk of the stocks as well. I'm going to keep trying to make as much money in stocks, and if I want to, sort of reduce the volatility in my portfolio, I'll just own more fixed income.
And that's what my wife and I have done, Tom, is to remain committed to the balance of small and large, and value and blend, and U.S. and international, but we're 50% fixed income. So, and by the way, that raises the question about the fixed income that one has in their portfolio. How does that relate to the emergency money that you have? If I have 50% in fixed income, and some of that is short-term fixed income, do I need to have an additional emergency pool?
I'd say no, but it's a psychological thing. If you looked at my life, I have almost none in cash. I have a little bit in high yield savings, but I could at any time go to my brokerage account and get fixed income that really has very little capital gains in it, and use that for an emergency. If I need to get a new roof or something like that, I could go get that money pretty easily. So it depends a little bit on your situation, but it also, I think, depends on your psychology. People oftentimes think money when they have it in a brokerage account, I can't touch that, which you definitely can, but it gets in your head a little bit. So I think having something in an emergency fund makes sense. What you don't want to do is have it all in retirement accounts and have no emergency savings and have to pull from those retirement accounts. We see that on a regular basis, and that makes me sad because you not only pay the tax, you pay the penalty as well if it's before 59 and a half. So
that's great. And Dan asks, he says, if one expects a pension that will cover annual projected expenses in retirement, is that justification for holding little to no bonds, or can bonds still be used for rebalancing purposes to take advantage of stock market underperformance from time to time?
the short answer is yes. And I'll give you a great example. The spring of 2020, the bond portfolio we managed was up about 10% in those 3 months. We can all remember spring of 2020. And the stock portfolio was down like 30% in a very short period of time. So we were selling those bonds and buying stocks. We looked like geniuses, had nothing to do with us being smart, simply a disciplined approach. So in that case, it pays off. Here's my only caution to people that say, and they say this about Social Security, the same way I get a regular check. If you're okay with seeing your portfolio do this, then yes. If you're not, then do not go ahead and put it all in stocks because I get this regular income that's a fixed income. Most of the reason people should own bonds is because they can't take the volatility out. And I just mentioned the spring of 2020. That was a time we were getting a lot of calls from people saying, this is the end of the world. This has never happened before. We've never had a pandemic, forgetting that we had one 100 years ago, et cetera, et cetera. I got to do something. And that's when people make bad decisions that cost them thousands of dollars, could cost your retirement. So, but if you're okay with volatility, Paul owns bonds because he doesn't like to see his portfolio go up and down. That's why.
Well, and there's the other aspect about having a pension and then Social Security, and that covers your cost of living. Then you really have to ask yourself, who is this other money for? And if that other money is for young people, younger people, that there are some people who would say invest for their risk tolerance, not yours, if it truly is going to be for them.
I
So
think that's exactly right. Yeah. And I think people, we regularly urge people that have been great savers to put that all in stocks or put that even in a riskiest asset class. I think you had didn't you used to have the trust that you talked about where you put it all in US small cap value and hope that that gets the 12 or 13% a year for a long period. Think of what that means to a young person. Absolutely.
yeah. There are a whole bunch of questions here, Tom. I'm going to let's zip through them. In my 401k, there's a small cap value fund, but it has an expense ratio of 0.85%. Is it too expensive relative to the bump in return over S&P 500 alone?
You know, I'm going to say yes, but the only reason, if you're not willing to go open a Roth or brokerage account and buy a dimensional product or an Avantis product there, or even Paul's got some Schwab products on his website or Fidelity. If you're not willing to do that and you're only going to own the small cap value in your 401k, then you're going to have to swallow hard and buy that for 85.85. Otherwise, you're going somewhere else.
Yeah, and the problem is that 0.85 does suggest active management, number one, and number two, probably not a whole lot of diversification. And that's an asset class where you do want a whole lot of diversification in an index-like way. So now, Tom, somebody has asked whether that list that you read at the beginning, will you post that list somewhere, all the things we shouldn't do?
Yeah.
And where could they go get that that
No,
list?
I'll send it to you and you can decide what flagpole to run it up. So
Oh, yeah, put me to work. Okay, that's a deal.
you're retired. You got lots of time.
Yeah, right. What additional advice can you share for a 403b target funds for educators? Let's just talk target date funds, period. How do you feel about it?
You know, I for people that don't want to spend any time on all of this and just want a product that's going to take care of it, I'm okay with that. I love the work that you've done that says target date fund plus 20% US small cap value or small cap value of some type.
Mm-hmm.
Target date funds, I think, get a bad name. I was just reading a piece that they didn't perform very well in 2022. Well, no kidding. Stocks and bonds lost money. Oh, they didn't do exactly what but in a general sense, they give you balance. You know, the thing that you and I don't like about them is they mainly own large US large cap growth kind of stocks. They assume because you're 60 years old, your portfolio should be 60% in stocks and 40% in bonds. And maybe it shouldn't. I mean, you and I had very different portfolios at 65, just different feelings about the future, right? And our risk makeup is different. But other than that, I think that they're okay. Again, and if you don't want to spend any time on this and you just want to own a fund and you put it in there, I think that's fine. I would, however, still use your approach, which I love, is the target date fund plus the 20% in a small cap value fund.
Yeah, and if people want to, we offer a free copy of a book called, two books actually. One is called We're Talking Millions, 12 Simple Ways to Supercharge Your Retirement. The second book is called Two Funds for Life. Both of those books have a major part focus on combining a target date fund and a second fund to make up for the target date shortfalls. And I'm sure, and this person who wrote the question is out of California, and I'm sure you are probably got a BlackRock or a Vanguard target date fund, and they should serve you well. Studies. I love this study out of Wharton. It was a combination study between Vanguard and Wharton. They looked at 1.2 million
401k accounts. Some of them had all target date funds. Some of them were do-it-yourself investors, no target date funds. And the expected additional return of those that used the target date funds was 2.3% a year more return. And when we know that every 0.5% that we can make more on our investments can lead to potentially another $1 million, 2% is a big, big deal. So I am a fan, even though they do have weaknesses. Here's a question. I'm currently running an ultimate buy and hold at Schwab. My question is about rebalancing. I've been rebalancing by selling to cash if a fund share of the portfolio exceeds 11% and buying when the fund is below 9%. Would appreciate your comments. You know something? That's fine. I mean, that's one of many ways you could do it. And by the way, Tom, didn't have time to get to it, but now you can use 4 funds. We've got the research and show you how to do what the 10 did. Any tip, Michelle here, any tips for understanding asset classes for your whole portfolio? If you have parts for your spouse and your brokerage and your Roth, or into asset class location, what do you got to say?
Yeah, I mean, I mentioned this briefly, you know, that the riskier things would hopefully be in a Roth, that the tax efficient things would be in a brokerage account, and then the other stuff would be in the pre-tax, because you don't care what happens there from a tax standpoint. But other than that, no, other than to say that you do need to look at your portfolio as a whole, and because make sure everything's sort of pulling the right direction. So yes, you need to look at your spouses, all those assets you have, to make sure you're properly diversified, make sure it fits your risk return sort of ratios, all that stuff. So, but yeah, the pre-tax, again, pre-tax can often be bonds and those sort of things. The Roth could be, as we talked about, the riskier things. The brokerage should probably be mostly stocks as well.
Question here about real estate. Is your recommendation not to manage rentals as part of your portfolio because they don't perform as well as investing using the ultimate buy and hold strategy? You know, I would just say, one, I don't want to be in the real estate business. And that is a business to be in, and a very profitable business to be in if you know how to do it and want to do it. We're talking passive investing here, where you don't have to do anything, but you own these parts of these companies all over the world. People go to work for those companies. They're complaining about how hard they're working. They're asking for more money. It's the pitch. The boss hates it. You don't have to do anything about it. You just sit there and you collect the dividends, or you hopefully watch them go up. It's passive.
Yeah, I mean, this is the reason that I really stress the real estate part is, if you go look at the top investing podcasts, out of the 30, the last time I counted, like 27 of them are about real estate, about how you get rich doing this. It's passive income. It's nonsense. You know, my business is not passive. I get up every morning and I go to work. My wife's pizza business, it's not passive. She goes, I mean, so we're operators. And I think to be in the real estate business is a business, as you said. So don't think it's going to be easy. You're going to plunk something down. You're going to start getting these checks. That's my point about all that. So I think you're spot on.
So, Michelle, opening an account for a child, is there a way to prevent them from taking over the account and taking the money out? Well, if it is a Uniform Gift to Minors Act or an IRA, either way, taxable or an IRA, yes, they probably at age 18 are going to have access to it. What you do is you explain what you have done for them. You have the statements come to your home, your address, not to theirs, and you tell them, I told my kids this, if you touch this money for anything else, I mean, you leave it in these IRAs to grow. If you touch it, that's the last money you ever get from us. I mean, that was the deal. And I spoke to my 58-year-old son recently, and he agreed. He believed me. So yes, you can't legally do it. It's theirs.
And by the way, I mean, here's another suggestion, you know, and I use this sometimes with my 15-year-old. Just ignore them until they're about 18 or 19. And then you don't have to get no discussion. No, that's kidding. But you're right. I love the fact you tell them, if you take any of that out, then that's it. You're sort of cut off. But other than that, no, there's no legal way to prevent that. You know, some people, I don't think, tell them about it. So
Right. Right. I mean, and the problem is that's okay, I think, with the Roth.
Yeah.
But I think Uncle Sam wants to know if you've got a deductible IRA out there, so you got to tell the kid at some point. What's the best strategy for transitioning to what I have now to what I want to move to? Okay, first take it in an IRA, 401.
Yeah, I mean, in an IRA, you're going to sell the securities and buy new securities. That's easy. It's when you start getting into the brokerage type, or money that's not protected, that you got to be careful. For example, looked at a portfolio today that's 72% and it's millions of dollars in Microsoft stock. So you don't want to just run out and sell all that, because the basis is here. That's this much. You're going to pay tax on all that. So it's just done carefully. It can be done over time. There's other strategies, and not to get too far in this, but there's separate account management. There's ways you can own other securities and you tax loss harvest that stuff. But so there's ways to do it. I mean, but there's no trick to it all. I wouldn't say that.
Michelle asks, are these recommendations 20 times or 25 times the formula for what you're going to take out? Does that apply to retiring early? I want to suggest anybody who wants to see the impact of taking money out of investments over a very long period of time, go to paulmerriman.com, click on best advice, and look at the distribution tables. We have tables taken out 3%, 4%, 5%, 6% over a 50+ year period. For you folks wanting to retire when you're 40, please look at what the risk might be.
Yeah, the FIRE movement. I know you've talked to those folks. I mean, that is so hard because so much in your life could change in that period of time. So it feels incredibly risky to me, but sure, there's ways to make that work.
Yeah, and I think we're probably, Jim's going to take a noose, but no, what do they call it? The hook. Yeah. Hey, this is a good one. Any advice regarding U.S. government thrift savings plans, the TSP? Should I move a Schwab Roth IRA to TSP? And let me ask it the other way around. Should I move a TSP to a Schwab IRA account?
Well, it's like a lot of the answers I give on the show. It depends. But here's the thing. The TSP has some advantages and some disadvantages. The advantages it has is very low cost. The advantages it has a bond fund that issues bonds that I can't buy. The disadvantages, it does not have the diversification I think you should have. It does not have much of a value component. The small isn't particularly small. The international is mainly large cap. So it doesn't, where you look at Paul's ultimate, buy and hold strategy, it doesn't have those things. And I want to reiterate that, because this is another thing people think. Well, I kind of do what you're telling me and it's going to work out. No, it won't. You need, if you're going to do this right, and we run into this all the time where people say, I've listened to your show for 20 years. And then you bring the portfolio. Which part were you listening to? I didn't say to do that. So the TSP does have some very good things. I would personally build, and we have recommendations at our website, 401-411. I don't know if you have the same, Paul, but we have TSP portfolio recommendations. And then I would take other money and build around that so that you do have a value component. You do have more international. So but when you look at the whole thing, it's got this sort of globally diversified portfolio with some of those tilts in it that have added return.
And one last question here, Tom. I'd like us both to answer it. You can go first. The investing philosophy presented tonight has much in common with the Boglehead philosophy. By the way, I am speaking at the Boglehead conference in Maryland in October. But they embrace simplicity as well. In light of that, is there a single ETF or mutual fund that represents portfolio 7? And if not, why not? So
okay, but mine is, I'll go first. I think AVGE does it pretty doggone well. It's one exchange traded fund. It's operated by Avantis. It is a globally diversified equity portfolio that has tilts to small and to value. So yeah, I think it does. I think it's, again, if I had a young person's Roth IRA, that'd be the one stop I'd make.
So simplicity is an interesting question
Mhm.
because my wife and I have 3 dogs. And some people think we're crazy. We think it's simple. But so let me tell you what I would do. And by the way, you just mentioned for a young person,
Mhm.
I love, it only takes 2 funds. The S&P 500, that gives you growth and it gives you large. 2 really big asset classes. The other 50% you would put in small cap value. That gives you access to small, and that gives you access to value. With those 2 funds, you will get a portfolio that is more profitable than the 11 or the 10 fund strategy going back to 1970. And you will see in our latest YouTube that we've done on these portfolios that the risk is about the same. So yes, you can do it with 2 funds. We're not able to really get that pure balance that we want with 1 fund. Tom, you are a jewel, you're a dear friend, and I really appreciate all that you do to educate investors. The world is changed by the work that you and Don do. Your daily podcast that you, in fact, I think one comes out on Saturday and Sunday, if I'm not mistaken, as well.
It's a week-to-week kind of thing on the weekends because we do 5 a week, and we try and add them in, but it's a lot of work. So
Well, then I think you have a number where people can call and ask a question. Do
Yep.
you? I mean, they can record the question
Yep.
at that number.
Yep, 855-935-TALK, I believe it is.
Okay.
That's 24/7, 855-935-TALK.
And you don't want them to talk dirty or anything. I mean, you have.
Oh, no, I do want it. At my age, I do want them to talk. So you're wrong there. Very much so. So.
Oh, you're great. All right. Well, Jim, I think we're going to give it back to you. We really appreciate Bainbridge Community Foundation. And Tom is right. Christine Benz is a jewel.
Absolutely.
And I'm excited to see her presentation next week. So I hope you all will join us. Thanks, Tom. And
Pleasure.
hi to the family.
Thank
Yeah.
you, Tom. Thank you, Paul. Tom's email is there on the screen right now. Paul's email is paul@paulmerriman.com if you have any further questions. And we do hope you'll join us next week when Paul will be sitting down and talking with Christine Benz. And then the following week, I will be talking with Mary Beth Franklin. So thanks all for joining us and have a great night.
I'm ready to open it up for questions, and I thank you very much for your attention.
Okay, I guess you've explained things pretty well, Chris. Right now, we don't have any questions, but I'm sure there are some. So I'd ask the folks to go ahead and enter them in the Q&A bubbles down there. And meanwhile, let me ask you a question that I understand that you're looking at the long run. A lot of the statistics are based on fairly long run performance of these various portfolios under different conditions. And, part of the point is to show you which ones perform best in a variety of conditions that were experienced during that term. But if we look at someone, it's likely that most of our audience is in or near retirement, as they like to say. And what I'm wondering is, for those folks who have retired in the last 5 years or 10 years, what would have been their experience? It looked like from one of your last charts there that their underperformance of the S&P. I guess what I'm really asking is, when you have a set of a sequence of is about sequence of return risk, ultimately, that when you have a sequence of years, not just 1 year that you have to get through, but multiple years, where for the most part your approach is not performing quite as well, and you're withdrawing.
Right.
That's a key element of it. And if you're not withdrawing, it doesn't make any difference. But if you're withdrawing, it makes a difference. So, how do you work through that, I guess?
Yeah, I actually have. Can you see this slide? I think I've.
Yes, we can see it.
Yeah, so this is a slide that speaks to this question. Um, when we do try to scare people to some extent, just let them know that there are these long periods of time when investing in small in value can underperform. And we do that because we don't want people performance chasing, switching in and out of investments. But there's a website called ifa.com that has a series of charts and tools that I find very valuable for some of these teaching questions. And one of the questions is how often, over what period, over different periods of time, does small cap value outperform large cap blend? And even at 1 year, the odds of small cap value outperforming are about 55.5%. At 3 years, it's 58%. At 5 years, it's 62%. I'm rounding here. 10 years, 74%. At 20 years, it's 99.5%. So what that says is, as a retiree, if I were to invest a part of my portfolio in small cap value, that part of my portfolio is expected over time to outperform. It may underperform. It's kind of a coin toss within a year. But other than the fact that it is a little more volatile, so I'm going to experience more ups and downs in it than I do the S&P 500, I'm not really doing anything imprudent because I have increased my expected return and I have increased my diversification. Now, I certainly wouldn't go all in on small cap value because now you've taken on a lot of volatility. You've gotten rid of a different kind of diversification. But yeah, I think for retirees, it comes down to, for most retirees, I think the best hedge against this kind of volatility and the way you're going to ensure that your portfolio lasts is to take on a fair amount of bonds or fixed income. And that's reflected up here in these charts where we looked at the safe withdrawal rates. If you look at the safe withdrawal rates, the one with the best safe withdrawal rates right here, a lot of these high bond allocations over on the right-hand side are very high in safe withdrawal rates when mixed with, and you can see a variety of them here through the middle, but taking on bonds is going to reduce the volatility of the portfolio, but it's also going to provide you from some sequence of returns risk. And as a retiree myself, I really value this this metric, the safe withdrawal metric, because it's the best proxy on this chart for, am I going to run out of money? What's the probability I'm going to run out of money? If I have a safe withdrawal rate that is much higher than what I need to live on every year, I have a very low probability of running out of money. If I have a safe withdrawal rate, a historical safe withdrawal rate that's close to what I need to live on every year, then I have a higher probability of running out of money. And if the safe withdrawal rate of my portfolio is significantly less than what I have to take out every year, then I have a nervously high level of risk that I will run out of money. Yeah.
Yeah. Okay. Oh, that was good. Okay. We have now, folks have entered questions. We have a number of questions. So let's start working on them. Ricky asks, if using two fund for life strategy, what would your asset location strategy, especially with Vanguard TDF, especially with the Vanguard TDF debacle a few years ago, when the TDF was in a taxable account?
Yeah, that was a really unfortunate moment for Vanguard, and I think it was uncharacteristic of them. They're usually really good about trying to be good stewards for their shareholders and investors, which are the same, they're owners and investors. What happened was they changed the way the funds were structured in a way that made it so a lot of investors realized a capital gain without having traded anything. And that created a taxable event for people holding the target date fund in their taxable accounts. I don't anticipate that that would happen again. They did it to get the expense ratio down lower. It's at about, it's 0.08%, I believe, and to have that low expense ratio across all of their funds. So I think that was an uncharacteristic thing for them to have done, and something unusual to have happened to a target date fund. But I would encourage people, where possible, obviously, to hold the target date fund in a tax deferred account, because it is where the bonds are, and it's where they're going to have a lot of income, especially over time into the future. It's one of the drawbacks of the two fund for life strategy. You don't have as much control over asset location. And that's one reason somebody might, for example, want to look at the allocations that I put up on that chart and implement it not with target date funds, but with other index funds. Because if you implemented it with index funds, then you regain this control over your asset allocation. You could put all of the bonds in your tax deferred accounts, and you could put the equities in the tax deferred accounts too. Maybe not. Maybe you have limits that restrict that. Maybe you have to get the small cap value in a different brokerage account. In any event, it gives you more control, and that might be useful. Yeah.
Okay. Someone is asking us, should the market rates of interest impact equity versus fixed income allocations? And he reminds us that for decades, rates were much lower versus the interest rates were much lower than they are today.
Yeah, this is a market timing question, and I do everything I can to avoid any market timing in my own behavior or my own advice, because my fundamental belief about market timing is that the market can remain irrational longer than I can remain liquid. That's was a JP Morgan quote, I think. I'd have to go back and figure out who it was, but it's hard, even when you know that you're at a moment where things are overvalued, or that interest rates might trend in a different direction, to know that they will do that tomorrow. They can continue in the direction they're going in and not change, or change faster than you expect. It's like trying to predict when a branch is going to break. You can hear it cracking, but you don't know when it's going to break. And so I really avoid as much as I can market timing, and I don't really think anybody else has shown that they're extremely skilled at it. And so that's kind of my starting point on that. We have gone through a period of time from 1970 until just recently that was very, very good for bonds. And now we've gone through a period of time that was historically bad for bonds. Does that pretend that the future now is going to be very good for bonds? I don't know. I don't know how fast interest rates will change. It's these market timing questions are so unpredictable and so hard to act on with any conviction that we do everything we can to avoid them.
Okay, that's great. I think it was Keynes who sometimes is credited with the business about the market being irrational.
Thanks for that.
Okay, another question is, thank you, Chris. Any drawbacks with small cap value investing? How about using the total stock market only instead of the S&P and SCB?
So the drawbacks of investing in small cap value are essentially that you need to invest like Rip Van Winkle. You need to invest with conviction and hold for a long period of time. And so it's important that you develop confidence in the history. And for a lot of people, they're going to look at it and say, I have 10% confidence in the history. I'll put a 10% allocation in my portfolio, or 20% confidence. That's fine. Some is better than none. The total market, as I pointed out earlier, doesn't have any tilt to small in value, nor does large cap blend the S&P 500. Both of them only give you market risk exposure. The difference between them historically in terms of performance and volatility is very small. So you can pick whichever one you like. I like the I like the S&P 500 because there's no tracking error. I like the total market because there's no, I'll call it cocktail. I don't go to cocktail parties, but cocktail party discussion anxiety around not owning the latest hot thing. If you own the total market and somebody comes up and says, hey, what about company XYZ? Have you heard about it? I'm going to make all my money on it. And you can go, I own that, right? You know, that's the great thing about the total market. And combining either one of them with small cap value is a great idea, because small cap value gives you additional market risk exposure, but it also gives you exposure to the small and the value parts of the market, which are not going to move in lockstep with the total market. And so that's going to give you this chance to have a higher return per unit of risk, like we saw in the charts we looked at. Yeah.
Okay. And so even though total market has all those small caps in it, their total cap, so to speak, really doesn't offset the large ones.
The small ones offset the large ones, and the blend and the growth ones offset the value ones. So although those stocks are in there, you don't get any of the premium or the diversification, because the way those parts of the market are defined is really as the small minus the large, or the value minus the growth. And if you own them both, you got zero, you got nothing.
Yeah.
The only way you get the tilt is to own a disproportionate amount from what exists in a cap weighted index. And the easiest way to do that is to add a fund that is concentrated in those parts of the market. Yep.
Okay. Sunil is asking us, thank you for your great presentation. The slides brilliantly compiled what the Merriman Foundation advocates. What strategies can we adopt to manage the behavioral aspects of tracking errors, especially when most of the financial press talks about two indices in the US and are enamored with the latest tech stock?
This is a tricky one. This is a really tricky one. I don't think I could give you, I can't give you a well-researched answer. I'll just give you my answer. So every single time I'm tempted to trade, I force myself to stop and go do analysis and talk to my wife, and to prove to myself that it's going to put me in a better position for the future. And 9 times out of 10, somewhere in that process, I get derailed and I don't. So as a buy and hold investor, I think it's good to build habitual roadblocks to trading too much. I avoid all of the financial media that is full of energy. I actually do this in news media. Well, if there's a lot of emotion in it, I avoid it. Because I figure it's a self-serving behavior on the part of the media to try and get me riled up and excited, so I'll keep tuning in. The bad part in personal finance is that a lot of times that leads to bad investor behavior. So I think look away as much as you can, not to the point of being ignorant, but if the media and the news that you're getting is overly titillating or overly exciting, it's probably not the part that's informing you. The part that's going to be more informative and educational is going to feel a little bit drier and less emotional. And so I try to steer my education in that direction. And then I also try not to look too often at my accounts, because they're there for the long term, not the short term.
Right. Okay. Sunil has a second question that's in a different area, so go ahead and ask it. Do you have any opinions on a strategy of liability matching portfolio with tips and having a rising equity portfolio as one ages? I guess there are two questions there. Yeah.
Yeah. So I think tips are, a lot of people got enamored with tips in the last couple of years because we have been through this period of time with inflation, and you can build a tips ladder in retirement that is, you can be very confident it's going to provide you what you need if you have, a specific level of income need, and it's it's protected against inflation by the U.S. government. So I can understand why that is interesting. It doesn't interest me that much because I know enough about a broadly diversified equity and bond portfolio to feel like I can get to the same place. Equities historically have been a good hedge against inflation in the long term, not necessarily the short term, but in the long term. And so I don't feel I need to add that additional inflation insurance, if you will. The rising equity allocation in retirement, I think, is very rational. And a good way to explain it is if you follow Christine Benz's work on the bucket strategy in retirement, she says you should have a certain number of years of spending available in short-term to medium-term bonds, then medium-term bonds, and then the money you're going to spend in later years in equities. Well, if you figure out how much money you're going to need to spend and you put a certain percentage into your short-term bucket in bonds, and then another bigger, the rest in long-term, that's effectively an asset allocation. So if you are an oversaver, that's going to be a very aggressive allocation. If you're an undersaver, it's going to be a very conservative allocation. But what's going to happen, hopefully over time, is that the equities are going to outgrow the bonds. And if you are just keeping those buckets the same size based on your living expense requirements, and they're not expanding with the market, then you're going to see a smaller and smaller allocation to bonds as you age. Now, the footnote to all of this is that you're going to see, if that happens, an increasing volatility in your portfolio as you age. And what I've noticed among my friends is that a lot of people become more risk averse as they get older, even if they have oversaved. And so you want to make sure at all of the points along the way that the risk that you've taken in your portfolio doesn't exceed what I'll call your panic stop. So for example, if you're somebody who's going to panic sell at a 50% drawdown, you should not be in a portfolio that historically has had a 60% drawdown. That would be a bad thing because there's a chance you're going to panic sell, a higher chance that you're going to panic sell when you shouldn't. But as long as you stay within your own risk tolerance, I think there's a lot of rationality to that increasing equity allocation because in many respects, especially if you're underspending that growing portfolio, it's not for you, it's for charities and the next generation, and they might as well see it grow. Yeah.
Okay. Just out of curiosity, I know a lot of folks in the meeting today are probably AAI members and are probably seeing Christine Ben's presentations on bucket portfolios. Have y'all done any explicit studies or articles on combining your strategies with the bucket portfolio?
Well, her bucket strategy effectively results in a portfolio that is pretty close to an S&P 500 and bonds portfolio or total market and bonds portfolio, and we have portfolios like that that we have back tested on the website, and the actual allocation you end up with is using the bucket strategy going to depend on how you have saved. So the fact that we cover a wide range of allocations, I think would let you find a point on those charts that would tell you something about how they have performed in the past. Yeah.
Okay, good. The next one is someone is asking, what small cap value funds or ETFs do you recommend?
We have a set of best-in-class recommended funds that are listed on our website. I had those in my slide presentation, so I'll pull those back up. And you can go find them on the website, and let's see, they're up here in ingredients, I think, right? Nope, not there, right here. Can you see those?
Yes.
Okay. Yeah. So for the U.S. small cap value, the fund we recommend is Avantis U.S. small cap value AVUV. But in addition to the best in class recommendations, we also have alternative recommendations over here for people whose 401ks might restrict them to a particular fund family that doesn't include our best-in-class recommendation. And these will be updated at the beginning of next year.
Okay. I guess in a somewhat similar vein, Jim's asking, are there any other investment companies to consider for the target date funds? And for example, Fidelity, Schwab, BlackRock, that sort of thing.
Yes, and in fact, Paul recently mentioned BlackRock in his podcast because he looked at a 401k that had BlackRock instead of Vanguard, and he spoke well of it because it has a higher equity allocation in the earlier years and a higher equity allocation in retirement. The reason I don't put a lot of time into analyzing a best-in-class recommendation of target date funds is that most people are going to have a very limited selection in their retirement savings tool. And rather than letting perfect be the enemy of good enough, I would rather have them focus on getting their savings rate up and taking advantage of that default and adding some diversification into small cap value rather than enviously looking over the fence at a slightly better target date fund that's available somewhere else that they can't get to. So, but if you do, like if you're investing in a target date fund through a brokerage account and you have multiple ones available to you, then I would point you at Morningstar's annual target date fund analysis. They do a very good analysis of the families of funds and how they compare. And if I was in fact, I was trying to decide on a target date fund for a 2-fund for life portfolio at Schwab. And so I went and looked at what Morningstar had to say about that target date fund because I didn't have Vanguard available to me commission free. Yeah.
Okay, good. Another question is, if I am 60 and adopt one of the buy and hold strategies, should I expect the results to be within a 20-year or a 40-year time frame according to my life expectancy?
Well, you should expect that the results are going to fluctuate and you should expect that over time, the compound rate of return number that you see will be closer and closer to what it historically has been. But that in your first year, it'll be very volatile and then when you average over 2 years or 3 years or 4 years or 5 years, it's going to fluctuate over a narrower range. We showed the annual standard deviation of returns. The 5-year standard deviation is narrower. The 10-year standard deviation is narrower. But, it's going to be uncertain. There's a lot of risk in any portfolio, whatever you choose. There's no guarantee. In fact, Larry Swedroe recently did an article where he pointed out that there's no guarantee that equities will outperform bonds over a 20-year period of time. You can go 20 and 40 years and make a simple choice like that I think equities are going to be better than bonds and have it not play out in your favor. So that's one of the reasons diversification is so important, is that you don't know which of these is actually going to win. And so even though small cap value is the best performing asset historically over the history that I look at and the asset classes I look at, I don't put all of my investments in small cap value. I own a portion of my portfolio in small cap value and then a portion in these other asset classes in hopes that together they all deliver me a good return per unit of risk. And probably, again, the most important thing for a retiree considering that ultimate buy and hold portfolio is how much bonds, how much fixed income do you need with it to give you some meaningful diversification and risk reduction, so that will narrow the range of results. It will increase your confidence that you're going to get a return. It may be a lower return, but it'll be a less uncertain return.
Okay. And which actually, I think kind of, because again, part of the issue in a retirement account is that you are withdrawing from it. You
Yes.
can't ignore it and let it grow the way you can in the accumulation phase. So, which leads us to Bill's question. You described the nudge rebalancing approach. what rebalancing approach is most effective long term, assuming that you're withdrawing along the way?
I have done various modeling and analyses over the years of different withdrawal approaches, rebalancing approaches, both of them. And I've never come up with anything that was what I would call numerically significant or profound. Whether you rebalance and withdraw yearly, whether you don't rebalance and use nudge withdrawals. I did compare the nudge withdrawals to the rebalance and withdrawal, or withdraw and rebalance, and it just didn't change things very much. So that's why I did the nudge withdrawals, is that I knew that for some people it was going to be this math problem, right? If you tell somebody you have to go into the account and figure out what percentage this fund is greater than it's supposed to be, and then take your withdrawal in a way that it turns it into something a lot of people I didn't think would do. And in our own retirement, what we have found is that we do nudge withdrawals. There's almost always an asset that is bigger than it's supposed to be by more than the 4%. And so we just take our whole withdrawal from that. And I thought, well, if it's going to be that simple in practice, why make it more complicated in the advice and the recipe we give to people? Now, if you have 10 funds and no one of them has dramatically outperformed, then the difference of nudge withdrawals starts to matter, because now you're talking about individual allocations that are 10% and you're talking about taking out 4%. You can basically overshoot by a greater amount. So I think as you get into a portfolio with more funds, it makes more sense to take from the whole portfolio or use your withdrawal to rebalance the portfolio. And I'm sure a lot of the people on this call will know how to do that. Yeah.
Right. Yeah. Okay. Okay. Well, someone's asking, what is the best way to invest in small cap values?
Patiently.
Well, yeah.
I think that the ETFs are really, if you could invest in the best in class ETFs that we recommend, they are very tax efficient. So I like the ETF because the wrapper makes the investment more tax efficient. You don't get these unexpected capital gains that you see out of mutual funds. If you can do it in a tax deferred account and reinvest the dividends, then you don't even have to pay taxes on the dividends that are coming in, and you're more of a total return kind of investment, and that's even better. So those would be the two top of mind things that come. If you're a young investor, dollar cost average in and celebrate it when the market's down, because you're buying it extra cheap.
Absolutely. Yeah. Okay. We're actually pretty much at 12. So let's just see what remaining questions we have. Here's Ricky asking, why would the quality profitability factors have a premium? It seems those companies are less risky, so why would you be compensated more to hold them?
I'd encourage you to go read Larry Swedrow's book. I think it's his Ultimate Guide to Multi-Factor Investing, and he'll give you bigger definitive answers on that. I think that my quick answer would be that the market is mostly efficient to a point, and then human behavior kicks in on top of that. And we tend to overestimate the impact of bad news and underestimate the impact of good news. And I think it's the behavioral attributes that probably help explain that. But Larry's book is a really good source for a deeper understanding of all of these factors and attributes.
Okay. I think you've touched on this, but I'll just ask it. What do you think about simplifying and using VT, the Vanguard World Fund allocation to global composition?
I think it's great. And in fact, the charts that I showed at the end, you could use VT in place of the US and international fund allocations and just do that all with VT. It's a really cost-effective fund, and then all you're doing across that chart is mixing three funds. You've got VT, a small cap value fund, and an intermediate term bond fund. And with those three funds, you can move anywhere on that chart. And I think that's a great idea. Yeah.
Okay, I'll ask this one. It's a little bit different. Paul's asking, "Hi, Chris. I acknowledge that everyone's comfort level is different, but if you're willing to share, Paul is curious about how much of a small cap value allocation you personally use."
That's tricky to answer because I'm going to answer it in the context of the portfolios that are not distorted by one investment that we have that is bigger than it should be because of tax reasons. So if you take that one out of the mix, we tilt to small in value, kind of in that 30 to 40% range. That was our design point when we created our portfolios. We have some we have some equity holdings that were there long before I started becoming a student of personal finance, that for tax reasons, even though we've tried to make them smaller, have gotten bigger. So that's why I take that out of the mix, and we're dollar cost averaging out of those, but at least so far they've remained a problem. But I know from past experience that they can quickly become a non-problem.
Okay, I maybe just two more questions here. One, I don't think you've exactly touched on. Do the same Merriman asset allocation principles apply for Roth accounts, as no taxes due on withdrawals and no RMDs?
Yes, they would.
Okay, okay. And then, Ben has a question, and it's probably something that at least occurs to all of us as we look at all this, and perhaps listen a little bit to the financial press. Do you have a fund portfolio you use for speculative plays? Could you use the talking heads, high energy picks as a contrarian indicator?
I do not. All of our money is invested as prudently as we know how, and I have successfully resisted any temptation to buy Bitcoin or individual stocks for the last 10 or 20 years, probably. Yeah, except for my employer stock purchase plan,
Right.
which always had so much tilted in its favor that I would have been silly not to take advantage of it. So
Right. Okay, well that's very admirable, Chris. I don't know how many of us just don't have a little bit off somewhere that we think may really do pretty well.
yeah, just
Okay.
not. It's just not in my DNA, I guess.
Okay. We do have a question about your website. I'll just point out that everyone can go to our website, the AAIHouston.org, and find a copy of your whole presentation, including your website. But Chris, if you'd like to tell us your website again.
Oh yeah. It's paulmerriman.com. And Paul is the founder of the Paul Merriman Financial Education Foundation. And Paul is the salt of the earth. He did this in retirement out of his own funds. There is no conflict of interest. It only exists to help people find a more profitable future by learning how to invest prudently and wisely. And I love that I get to work with Paul. He's a really wonderful guy. And hopefully you find stuff there that is useful and helpful. And yeah, it's just paulmerriman.com.
Okay. And Shri has posted that in the chat, so you can go there and find it.
Oh, good.
So thank you, Shri. And I think that pretty much covers all the questions. I appreciate your working. You're going ahead and doing that. I think the fact that in these kind of meetings, one of the real values is that our audience gets to ask speakers like yourself questions, whereas if they heard you in a larger venue or with a larger webinar, they wouldn't be able to ask those questions. So I appreciate
It's
your
my favorite part of the meeting too, because I learn a lot in the questions. I learn more about the audience. In an ideal scenario, we'd do this face to face. I would enjoy that much more, but I appreciate the questions and answer part. This is really fun.
Chris. You wrote about contributions about from the standpoint of monthly, quarterly, or one-time quote unquote lump sum intervals in terms of investing the cash at those different intervals. But it ties in, and I know you looked at it from the standpoint of saving for retirement. But a question I get, you've probably had it too, is from someone who's sat on the sidelines. I have this cash and I want to get back in. What's the best way to do it? And could you say what you found out when you looked about as spreading over monthly, quarterly, or yearly, or doing it once, what you found out in terms of the impact on portfolio growth and returns?
Sure. The expected return that you'll get is highest if you invest it all right away. The risk that you enable is highest if you will invest it all right away. That's the gist of what you learn when you do these back tests and analysis. So from a behavioral standpoint, if you're really concerned that you're going to have this deep regret that you've invested it all and the market drops the following day, dollar cost averaging or investing slowly over time is a great way to address that concern. And you can decide whether you're going to invest it daily for a month to get it all in, or monthly for a year, or quarterly for 3 years. The longer it takes you to get it in, the lower your expected return, but also the lower your risk. It's a form of diversification. It's time diversification is what you're doing, and that's why it lowers the risk. This shows up in a really meaningful way for young investors who are for the most part, young investors can't do the lump sum investment. But if they could, if their whole life savings came to them all at once, the next day they would be exposed to the full potential downturn of the market. If we had a crash like in 1987, they would see a huge loss in their portfolio, and it would probably rack their emotions, and it might ruin them as an investor for life. If, on the other hand, though, like most investors, they're getting the money on a monthly basis and they're investing it, they may not even notice a lot of market downturns because the cash flow is going to smooth the ride, and they're going to see much, much smaller downturns for the first 10 years, 10, 15 years that they're investing. In fact, most young investors starting with zero and doing regular investments will see smaller downturns or smaller drawdowns in their account, declines in the balance of their account, than they will see with a conservative target date fund at retirement. So that smoothing is a really powerful tool to help avoid what might be an intolerable risk for a lot of people.
Interesting. And then in terms of target date funds, obviously, as you know, they're the default option in many retirement plans. Any suggestions about how someone might go about choosing one, particularly their retirement date's not certain, or they're falling in between those 5 or 10 year windows? Some of those funds are actually dated.
Yeah. So usually the default and the fund family aren't going to be things somebody has a lot of choice about. The default will probably be the fund year that's closest to the year in which somebody turns 65 years old, because that's generally perceived to be when they're likely to retire. And there's nothing wrong with that. In fact, if it nudges people to get investing earlier, all the better. And most of the evidence is that it does. And not only does it get them investing earlier, but it also gets them investing more in equities earlier. which are just fantastic benefits to a young investor. If somebody wants to second guess the choice within fund years, if they invest in a fund that's a little bit farther out in time, say they're like right in the middle between 2-year choices, if they invest in one that's farther out in time, their portfolio will be managed a little bit more aggressively. If they choose the one that's a little bit nearer in time, their portfolio will be managed a little less aggressively, but not until they're within 20 years, 25 years of retirement. So for a young investor, it doesn't matter. It will make zero difference. As somebody's getting closer to retirement, that choice starts to make a small difference, but it's a small difference. Yeah.
And you use a lot of back testing in your book to test strategies. Could you give us, and I know it's probably a lengthy answer, but perhaps condense it a little bit, the argument why back testing is actually really helpful, and then some of the pitfalls of relying on it.
Sure. All we have in terms of understanding the future is the past. It's true in investing. It's true in life. We assume the sun will come up tomorrow because it came up yesterday, and we know a little bit about the physics, and we assume that they're going to continue and the rules won't change. All we know about the future in investing comes from studying the past. And so if we look back and we see patterns that happened in the past over many, many different time periods, that suggests that they'll probably happen in the future. And if we see patterns that happen rarely, then that suggests they probably won't happen in the future. So when we do our back testing, we're not looking for very tiny differences that only happened 50% of the time. We're looking for things that happened over 90% of 600 different time periods. And how do you get 600 different time periods? You take 50 years and you use every month as a different start date, and then you loop at the end. And so that means you go from, in our case with our back testing, from 2021 or 2020 to 1970. And everybody goes, whoa, wait a minute. Nobody says that 2021 is going to look like 1970, and it didn't. And that's true. But if you don't do that, if you don't make at least one small assumption like that, you end up overweighting the years that are in the middle, because you can start in, at the beginning, and then when you start running out of years, you've sampled the middle twice. So no back testing is going to be perfect. The same thing is true of Monte Carlo, though. It's not perfect either. Monte Carlo simulations make a bunch of assumptions. They assume that either any year can be followed by any other year, or that you'll always bootstrap by 0 to 20 years. And so Monte Carlo simulations end up having less reversion to the mean than we actually see in the historical data. So all of these are like fuzzy, imperfect crystal balls. But when you're trying to figure out what to do, you need something. And this is the best data that we have. So I think the fact that most of the strategies that if not all of the strategies that we recommend are backed up by a preponderance of historical behavior that says it will benefit you, should give people comfort in following it.
Great. And finally, in your book, and I'll let our listeners know, we'll have a link to it in the show notes. You highlighted a lot of long-lived animals and plants, from trees to reptiles. Is there a particular reason why you chose to include those in a book about investing for retirement?
Very much so. The title of the book is Two Funds for Life. And I really wanted to step out of investing at the beginning of every chapter and have people remember that the reason we invest is to live. We don't live to invest. The reason we're doing all of this, the reason we study it all, is to improve our lives, to make us financially secure for a longer period of time. And I think it's kind of a mental break when you're reading the book to step out and think about a different topic or a different subject. And I love that it was a chance to highlight my daughter's artwork too. She did the artwork, and I think she's an amazing artist, and she has a love of life, and it really shows through in her work. And it helped elevate my writing because it made me remember why I was doing it. It's not just to make money, it's to help people live better lives and have more time to enjoy the life they live.
Well, welcome back to the second of, we're not quite sure how many sessions responding to the questions that came from the presentation on September 23rd for AAII. And I will encourage you, if you have not seen that presentation, it's focused on what is the best 1, 2, 3, and 4 fund portfolio. And so I'm not going to review that session, but I do encourage you, if you didn't see it, to take a look. But we are going to address the questions that came out of that session. I don't think you have to see it to get the idea, because these are questions that pop up every day. Now, I asked these other 2 gentlemen who are here with me, those gentlemen, at least on the bottom of my screen, is Chris Pedersen. Chris, you want to raise a hand so that, yeah, there we go. Our Director of Research, and Daryl Balls, our Director of Analytics. I asked them, and also answered the question myself the last time we were together, whether they carried any particular accreditation, could they be called a CPA? And we got no takers. Could you be a chartered financial analyst, CFA? No takers. We didn't even raise a hand when asked, are any of us CFPs, certified financial planners? And after we finished and we were discussing the Q&A session that we went through, Chris said, what we are CFFs. That's a conflict-free friend. And I thought the other might be a CFA, conflict-free advisor. But wait a minute, we are not advisors. We are actually teachers. So maybe we're a conflict-free teacher. So welcome to another session of teaching. We hope something will come out of this that will maybe make an impact on how you approach your portfolio. Now, what we did last week, we talked all about how Daryl put together the tables for us. And if you haven't heard that, I hope you go back and watch or listen to that as well. Now, today we're going to take up, we were talking last time as we closed about equity asset class selection and how that is done. And that is a lot of the work that Chris has done for the organization. So Chris, I'm going to aim a couple of questions here at you. The first one here is, why don't you include small and large growth in the analysis or in your recommendations?
The reason we don't is that your portfolio is built on the work of Fama and French and the academic work that says that small and value deliver better returns over the long haul. And so if we included growth, small or large growth, it would shift the portfolio away from small and value. So if you think about what we're trying to do, we're trying to get a portfolio that has a little bit of growth in there just because we have blend, right? It's going to pick up some by having, for example, the S&P 500 or a total market fund in there. That's going to pick up some growth and a lot of large. But if that's all we had, we would have zero tilt towards small and value if it was the total market. The only way you get that tilt towards small and value is by having more of it in there. And so that's why there's a small value fund, why there's a value fund, a small fund. And so it would just basically take the portfolio in the wrong direction. It would take it back in the direction of being more like the total market, and it would reduce the chance to get those premiums that the portfolio was built around.
And so the outcome of that is going to be in markets that small and value are underperforming. It's going to look a lot different than the S&P 500. I mean, that's the part, as we know from last week, and all of the questions we get about why isn't value or why isn't all doing better. That's the challenge, is that it can look a lot different.
Right. Yeah. It's a chance to have some regret when
Yes.
when growth is doing really, really well. When you've invested this way, it's easy to feel like you're missing out. But that is another reason for holding the total market or the S&P 500. They tend to have those high visibility winners, right? And if you hold the total market, I like that because it gives you the ability to always say yes when somebody says, you know, what about investing in ABC? It's like, I got some of that, right?
Yeah.
Yeah,
Google or Alpha. Yeah, absolutely.
Yeah, it's
Okay,
just nice to know that you've got some of it. Yeah.
Here's another one. How about gold and commodities? Why not?
So gold is gold's an interesting one. If you look at the history, it didn't trade like most asset classes for most of the last century. It was fixed to currencies for a long time. But if you look at the recent history, where it trades like an asset class, where you can trade it daily and its price fluctuates, it's got the volatility of a stock, but the return of a bond. Kind of, it's not a very productive asset. So we don't include it. People who do include it in portfolios usually include it primarily because it can reduce volatility at key points in history. And so it doesn't fit with the philosophy that the ultimate buy and hold portfolio was built around, of maximizing your return per unit of risk. It doesn't have a great return, and it's got a lot of risk. So that's why gold isn't in there. Commodities are largely the same story. It's a little bit different because they did fluctuate more during the last century. So there's more of a history there, but yeah, they're not that productive. And I do model them and analyze them occasionally. I haven't yet figured out a way to incorporate them that I think would improve the return per unit of risk and fit with the rest of the philosophy of how we've built the portfolios.
And from what I've seen, when you look back at the real points of distress in the market, your long-term U.S. Treasury bonds are much more productive on the short term in those distress situations. So when you look at the 50-year return of the Treasuries, they're higher than the 50-year return of gold. And as you mentioned, Chris, the volatility of gold is much, much higher. Now, we talked last time about internationals. We did not talk about emerging markets specifically, but just revisit for a minute, if you will, Chris, the addition of internationals or not.
I'm not sure I understand which question or
well, the question of, should we? A lot of these portfolios we're showing people do not have internationals, and what's the cost? What are you leaving on the table if you don't have international? I will just mention briefly that if I look at the last 50 years of a portfolio that we call the ultimate buy and hold portfolio, that's half international, half US, that the returns for an all equity portfolio are about, I think, 0.2 better than the all US portfolio. So the increase in return is not significant, but you got some currency diversification. Take it from there, if you will, if I didn't just cover everything.
I think it's, it's relatively inexpensive diversification, right? You can very inexpensively buy the total world market right now in a fund that's very affordable, under 10 basis points probably per year. You can buy international funds that are only slightly more expensive than the US. And what do you get for that? Do you get a higher return? Maybe. Nobody knows, right? Nobody really knows whether the US is going to outperform international or the other way around. A lot of people would say emerging markets have a better shot because they're small and they're coming up, and that they've got a chance to outperform. But what you really get is you get insurance that if something absolutely horrible happens in your home country, and we all pray and hope that it doesn't, but if it does, that you're protected against that. So it's very cheap insurance. And there are many examples in the last century of entire markets that went away. Russia, China, Germany, maybe 95%. I can't remember exactly what, but huge crushing blows to economies that nobody would have anticipated or predicted 5 to 10 years ahead. And people who were diversified survived that. People who weren't diversified endured a life reset, right? So I think that is the number one reason for diversifying internationally, is just cheap insurance.
I'm 50% international. Daryl, how much international do you have in the equity part of your portfolio?
We're about 30%.
Chris?
We're about 30%. Yeah.
Okay. Another one here. Are the various funds that are being recommended, and I'm going to say certainly with ours, but also with the other portfolios at Boglehead or Rick Ferry or the Buffett recommendation, which was an index fund, are they all index funds? And Daryl, you could weigh in here. Do you remember whether they are all index funds? I know that ours basically are. Is that true, Chris, in the case of the ETFs as well? Would you call them all index funds?
I would.
Okay. And Daryl, you got the same answer?
Yeah.
Okay.
I believe so.
And does it matter whether it's Vanguard or Fidelity? That's another question here.
I think it's probably more important to invest in an asset class than, after you've chosen to invest in an asset class, where you do that investing. I would call it a second order effect. It's more important that you have it than where you have it. Chris, what do you think about that?
I would totally agree with that. Yeah, it's a lot of times when I run the updates for the best in class ETF selection, I'll back test the old set and the new set, and I'll compare it to Vanguard and to DFA. And over, even a few years period of time, the differences are usually very small, like on the order of less than 1% CAGR, compound annual growth rate. It's what's far more important is which asset classes you're going to invest in than which fund you use it. Now, the one footnote to that is that I'm always looking at low cost funds. Yeah. If you invest in very low, high cost load funds, it's going to crush your returns, right? So don't do that. But once you've gotten into some low cost funds, I think, the differences tend to be minor.
See, I, of course, am struggling with that question because now you have Fidelity with their zero cost funds. And in looking just at recent history, it appears that zero cost is picking up that difference in return compared to Vanguard. And would we choose to be with a supplier who would give you 1/10 better expenses, 0.05% how important is it to us to try to catch that last 0.1%? Maybe it has to do with the service you think you're going to get from one vendor or another, but is it worth the fight to pick up that last 1/10 of 1%?
Well, when I make my recommendations, I always try and get it. So I do my best at it. Right.
Good. That's
But
good.
yeah, it's how much would
Okay.
I do it just for myself? I might actually try a little less hard. I work harder for the foundation than I do my own investments.
I see. Okay. Okay.
I also think that if you decide to make that change for just a few basis points, that may be the situation now, but are you going to make that change again then in 5 years when the person who just
Absolutely
left
Yep.
decides to change their business model and now they're cheaper? You know,
Yes.
there's a little bit of
And that's part of
turn
why
that
we
could
only
go on there.
update the best in class recommendations every couple of years, is I don't want to whipsaw investors. I don't want them trading every year unnecessarily. Yeah.
Yeah. Okay. Next question here is, I think we've gone, oh, I know one back here on this page, Chris. Somebody asked the question, do you guys use Portfolio Visualizer to understand the factor weighting of your portfolio? So maybe not everybody knows what the Portfolio Visualizer is. How about a quick rundown?
I do. It's a great tool. It's free, and you can get it at www.portfoliovisualizer.com. And it's pretty easy to use, especially if you're an interested student like I am. But even when I first started, I started using their tools. I found them pretty easy to use. The question about factors is, it uses something at the website called factor regression. So if you click on factor regression, you can type in any of the funds that are mutual funds, ETFs, the ones out of our best in class recommendations, our Vanguard recommendations, and it will tell you, for as much history as it can, how much that fund's behavior was associated with a given factor. Right. So for example, you take a small in value fund, it's going to come back and it's going to say a lot of the fund's results are due to just the market, right? There's a lot of market risk in a small in value fund. And then it's going to say there's some exposure to the small factor and some exposure to the value factor. And that amount of exposure is going to tell you how much of the premium you get. So let's say that, I'm just going to make up a couple of numbers. Let's say the small factor is worth 2% and the value factor is worth 2%. And the fund has a 0.3 exposure to each of those factors. Well, that means you should get a premium of 0.6% for small and 0.6% for value. And that would be about 1.2% total on top of the market, right? So you can use that tool then and say, okay, well, this fund costs 0.5% in expense ratio more than another fund. And that other fund, maybe it only has 0.1 exposure to each of those factors. Well, you can run the numbers and you can figure out whether it's worth it, right? It basically helps you figure out, is this weak sauce or is this hot sauce, right? And you might pay more for the hot sauce if you like spicy stuff, right? So it's a great tool. I love it. Yeah.
And Daryl, when we look at the latest table going back to 1928, and showing the 4 funds, and then each of those funds, large blend, large value, small blend, small value, and you show the annual results and how they rated against each other. Have you ever looked at how often, 1 year at a time, that you don't get the premium? I mean, we know that you can go 10 years or 20 years and not get the premium that you expected, but does it give you a better idea of how often you should be disappointed if you looked at each individual year and said, I don't like that, I don't like that, and I better be very patient if I'm going to try to pick up that extra return from those factors?
Sure. If you look at that quilt, I love the term performance quilt that one of the questioners used. If you look at that, you can see how the the battle for number one or number five, if you will, between the four asset classes and the four fund combo plays out year after year after year after year, and it's chaotic. Maybe not mathematically chaotic in terms of chaos theory, but it's pretty jumbled. Let's see, should I show that chart again just for grins? Here's the chart Paul is referring to, I think. And, you know, here's a stretch where the small cap value was pretty good. Here's another stretch. Here's a stretch where S&P 500 was good, you know, and
It's hard to see your pointer, Daryl, just at least.
Okay. Maybe I'll move it slower. But if you look at the colors, you can sort of see how things bounce around.
Yeah.
And sometimes from 1940 to 45, for example, the S&P 500 was the poorest performing class. Same thing from 64 to 68.
6 years in a row, yeah.
Yeah, same thing from 2000 to 2006. So it can happen. On the other hand, there are other periods. There's a period here, for example, of 5 years where the S&P 500 was better than the four fund portfolio. It was 3 out of 5 here, or 4 out of 5 for the whole period from 28 to 32.
But if anybody told you in 1928, as they told us in 1999, that the S&P 500 is very difficult to beat, and then they started to, in fact, in the earlier years of 28 through about 33, it looks like, that the S&P 500, you would have actually agreed with whoever told you. But then you find out over time, the S&P 500 is easy to beat, almost, we could say, most of the time, particularly because it's competing against all the other asset classes that it might be in the pool with. So I just think that table is a winner, Daryl, and I look forward to sharing that with the Market Watch readers. I think they'll enjoy it.
You know, you mentioned how in 1999, everybody was saying the S&P 500 is hard to beat. Well, if you go back and you look at the previous decade, it got beat 8 out of 10 years.
Yeah, so you're right.
I remember the 90s where you thought, boy, that's a hot place to be, but it wasn't really. And then in the 2000s, of course, it really wasn't. So
and part of the problem is not a problem, but the reality is the S&P 500 represents something like 80 or 85% of corporate America. And so we'd understand why it represents what most of us would have some sense about if we were interested in investing. What we didn't know for a very long time, in fact, until the 90s or the 80s, were these other kinds of asset classes. We didn't have the history. No, the academics had not tracked all that history that we have today, which has created a different view of how investing maybe should be done. All right, well, I'm going to move on to another topic here, if you are ready. Comparing the returns. We've already talked about how do returns change if you add international funds to the portfolio. But in the case of what we show in those 30 years, and we talked about this last time, so briefly, if we go back the previous 20 years to that 30 years, the internationals walloped the US. And what we don't know is how long it will be before that happens again. In fact, if we track what happened in Japan, it peaked out in 1990, I believe, and is still way below where.
We just lost Paul. Are you still there, Daryl? Hey, Paul?
I'm here.
Dropped out.
Where did you lose me? Am I back?
Yeah. So start with it peaked in the 90s.
So Japan peaked in the 90s, and still today it is way below where it was at the peak back then. So whether we're talking about the US market or the international markets, strange things happen. And of course, that's the reason we believe in diversification. Question for us: do you think Vanguard funds will do as well as DFA funds in building the 4-fund portfolio? And Chris, I've got to ask you, because you put together those ETFs, and when we built that ETF strategy, the best in class ETFs, our goal was to try to emulate basically what DFA was doing in the way that they managed their funds. So what do you think? Do you think that we can compete? Now, by the way, this was, will Vanguard funds do as well? Let me answer that before I pass the baton. The Vanguard funds probably won't, because the Vanguard funds aren't built to be like DFA funds being smaller and more deeply discounted value. Vanguard will do better than DFA in a market where large beats value and where beats small and where growth beats value. That's where Vanguard will look super. But DFA, in those years that small and value are winning that race, they should look better than Vanguard. Now, over to you on your attempt to pick those that will do as well as DFA or better in terms of how they manage the asset classes.
Well, as you point out, it depends on what regime we're going through, right? Whether large is in favor versus small, and whether growth is in favor versus value, and so on. And it's the thing about investing in these factors of small and value that is particularly hard is that the academics can tell you over the long haul they have delivered a premium. They can't tell you when they will deliver a premium. Mm-hmm. They can't even guarantee you that they will deliver a premium, right? So a lot of it is it's not entirely on faith, but it's because there is a lot of evidence. There's a lot of years there. But you could go a while before we find out. I totally agree with you that we try to duplicate the DFA tilts towards small in value. And in fact, I think with the last go around on best in class, we did a pretty good job of coming up with a whole portfolio that compared very favorably with DFAs. And we'll continue to try and do that. The other thing, though, that plays into this is expenses, right? So DFA customers have to pay a management fee. And in exchange for that management fee, they get coaching. For some investors, that's going to be a very high return, a very high ROI choice, right? If it keeps them from bailing at the wrong time, that management fee may be very, very well spent. For a customer who doesn't need that coaching, the expense that they would save even being in Vanguard with less of a tilt might well pay off, right? I mean, you're saving a lot in expense per year. So exactly which one's going to win and which one's going to win for which investor depends a lot on their behavior, the value that they would get from an advisor, and their ability to stick with whatever investment they chose, right? So for somebody who chooses Vanguard and sticks with it, they'll probably do great.
I might add something about Vanguard and Fidelity. Those ETFs that you've selected in the best in class list, they're all available at Fidelity and Vanguard without paying commissions. You still got to pay the spread, but they're commission-free trades. And so in that regard, Vanguard is a good competitor with DFA, as long as they're using the best in class ETFs, is what we would certainly like to believe. And I thank you for all the hard work you put into that. I have read that the annualized return of the S&P 500 is 7%. It seems that the telltale chart does not show the S&P 500 in comparison. I'm going to try to answer this, and Daryl, if I don't get it, you weigh in. This 7% is basically what the S&P 500 has made after inflation. That's one. The other is it is about the return of what the S&P 500 has made without the dividends. And so those are two separate items. Remember, when you see the return of the Vanguard S&P 500 fund, it is going to have a higher return than the index itself because it does include the dividends, and the index does not. Also, I have to throw another controversy within our industry about the S&P 500 return. There are people who claim that the S&P 500, that the return is 12%. Now, I would not want anybody to plan their retirement savings on the S&P 500 making 12%. It's not a lie. It's improperly stated, because here is where that comes from. If you average the return of the S&P 500 over the last 90 years, yes, it is about a 12% return, but you don't get the average return. You get the compounded return. And the thing that we need to remember is that if you put $100 to work, and the first year it goes up 50%, and the second year it goes down 50%, the average return is zero. On the other hand, let's put that money to work. The $100 grows to $150 because it's up 50%. Then the decline of 50% takes it back down to 75% or $75. So that is not a break even. That is a loss of 25%, or about compounded over 12% a year. So the return of the S&P 500 can be used in a lot of different ways. And Daryl, would you add anything to that?
Well, I would address the part of that question that referred to the telltale chart, and that why wasn't the S&P 500 on the telltale chart? Well, the S&P 500 is on the telltale chart. It's actually the benchmark that the US 4 fund, in the particular case we showed, is compared to. So that's when you build a telltale chart, there are two components. One is the benchmark, or one is the fund you're interested in how it performed over time. The other one is the benchmark that you're measuring it against. In other words, the divisor. And so the US 4, the S&P 500 is in there. And so if you wanted to put the S&P 500 on a telltale chart, measuring it against the S&P 500 benchmark, it would be a line that would go straight across at 1 because the return was exactly the same as the benchmark. The fact that the US 4 fund goes up is because measured relative to the benchmark of the S&P 500, it outperformed over time.
Okay, that's great. Thank you. Here's a question. It seems small cap value is driving the excess returns over the S&P 500. That excess value, I don't know if we made it clear or not, but at least over that period of time that Daryl went back to 1928, the S&P 500 compounded at 9.9%, large cap value at 11.1, small cap blend at 12, and small cap value at 13.2. And by the way, long-term government bonds at 5.7. And so, yes, if you have small cap value, by the way, and large value and small blend, they are all going to drive that return. But small cap value has the combination of small premium and value premium. So it has two things going for it that large value does not. By the way, here's the problem for all of us. What does the future look like? Would it look like any of those numbers? Well, let me just give you the last 20 years, because maybe the last 20 years will tell us about the future. I'm sure those are years that many of us have lived through and invested through. Okay, how did the S&P 500 do? 6.1%, large cap value 8, small cap blend 10, small cap value 11.8, and the government bond 7.5. If the last 20 years is indicative of anything, really, that would suggest that you're better off in long-term government bonds than the S&P 500, which is why 20 years simply is not enough. Anybody want to add anything to that tirade?
I think you covered it.
Okay, all right. Okay. Here's a question. I think we touched on it yesterday, but Daryl, has there been any work to include dollar cost averaging for people? You want to just touch on that briefly?
Well, yesterday we showed a table that had it was called an accumulation table, where you put $1,000 a year in, adjusted for inflation, over a 50-year horizon. I think it was. So that one will be referred to in the notes. So we should have a link to that chart. So yeah, work has been done on that. I know Chris has also done work on averaging and accumulation phase of a person's life or an investor's life. So yeah,
excuse me, Daryl. I'm sorry.
Sure, go ahead.
Chris, you were going to have, hopefully at your fingertips there, the access to some of these pages of tables that people could visit. Do you happen to have that page on the accumulation accessible right there?
Sure, Paul. Yeah, let me share that on the website. Let's show listeners how they can get there. So if we go to the website, y'all seeing that now?
Yes.
Great. So up here under best advice, if you just scroll over that, it will pull down most of the resources that we're talking about. We were just talking about contribution tables, and so we can go in there and look at that. Just click on contribution tables, and you can see down here, we've got the fixed contribution tables for the S&P 500, the 50-50 worldwide, 70-30 worldwide. We were just talking about the 4-fund combo, so I'll click on that. And there you go. You've got a series, and you can see how different combinations of fixed income and equities would have played out from 1970 to 2019 with those contributions. So it's a good way to check and see what that ride would have been like. You can look at the other combinations as well. If you go back to best advice, it's easy to get to the distribution tables, to the to fund for life. Everything's under here, so pretty easy to get to, right, Paul?
Yeah, this is really the meat of our work. These are the tables that, for do-it-yourself investors who are trying to make important choices, how much in equity, how much in fixed income, and whether you want variable distributions or fixed distributions, you want to take out 3, 4, 5, 6%. What are the implications over the long term? And kind of the base of all of that are the fine-tuning tables, because those fine-tuning tables show the annual returns that Daryl has used as the information that he builds the rest of these tables with. So you can also see the risk and the annual returns. The whole thing is there, in a sense, to follow you through your life. The having the right choice of how much in equities and how much in fixed income. accumulation, putting that money away, $1,000 a year, $83 a month, and adjusting it upwards for inflation, and then moving into retirement and deciding what kind of a strategy, how aggressive, how conservative, whether you do it as far as distributions aggressively or conservatively in terms of how much you take out, or aggressive or conservatively depending on how much risk you're going to take. So this is the culmination for me of a lifetime of work. And Daryl, bless him, really, it's amazing what he's done to give us this information so people can take it and put it to work in their lives. Unfortunately, and this is the weakness with this trio here, we can't come sit with you at your kitchen table, and which we'd love to do that, but we don't have time. Anyway, thank you. I hope people now will have a better sense of how to get there. One of the questions that has come up in a number of ways has to do with this sequence of returns and the implications on whether you're accumulating or you're taking distributions. And of course, this becomes really important when you're taking distributions. But a lot of questions about that, and it has a lot to do with which of these strategies would be really appropriate for somebody who is in retirement and trying to live off of the money. And Daryl, would you take a few minutes and dig a little deeper with us into this question about understanding the sequence of returns and how impactful that can be on the investor?
Sure. We did have a question that asked about, whether the isn't the four fund more risky than the S&P 500 from a sequence risk perspective? So I think we can answer that in a couple of different ways. One of them is kind of taking a qualitative look at things, and the other one is maybe a little more quantitative look. So let me see if I can share my screen here. And we'll look at some qualitative measures. You seeing it there, guys?
Yep.
We'll look at some qualitative measures first here. This is the same quilt chart, which you may have seen earlier in the first podcast, I think. It basically has the four fund portfolio and the S&P 500 portfolio only showing. All the other asset classes have been removed, so it's easier to see the comparison. The blue boxes here are periods of time, years where the S&P outperformed the four fund portfolio. The red boxes are where the S&P underperformed the portfolio boxes, or underperformed the four fund portfolio. So when you look at this chart, what do you see? I see a lot of red. Okay, often the S&P did outperform the four fund portfolio for stretches of many years. I should point out that these are stretches of more than a year or two, or maybe three. So these are 4 or more years in a row where one portfolio outperformed the other. And in the last 92 years, that only happened twice. The S&P 500, it underperformed 5 times for 4 or more years, sometimes as long as 7 years in a row. So from a qualitative perspective, the S&P 500 underperforms the four fund portfolio more often than it outperforms the four fund portfolio for longer stretches of time. So this is kind of a qualitative look here. If we go ahead and look at a retirement, this is just strictly returns. If we look at a retirement withdrawal scenario where you start out with a certain amount of money, you start out 4%, let's say you take out 4% of your initial balance and adjust it for inflation for 30 years. So it's a standard retirement distribution scenario. So, and this is just 100% equity portfolio, not realistic necessarily, but it'll give you an idea of what the sequence risk between these two are. So how often do you run out of money? Four fund portfolio runs out of money 4 times in the 63 scenarios. So these are scenarios that started in 1928 through 1990. We don't have, 1990 would be the last 30-year scenario. Four fund portfolio ran out once. of all of the other portfolios that didn't run out of money, how much did you have left at the end? In the worst case, the S&P 500 had 600,000. You started out with $1 million. S&P 500 had 600,000. Four fund portfolio had 1.2 million, more than you started out with. So in nominal dollars. So the four fund portfolio, you end up with more money. What about the minimum sustainable withdrawal rate? So here, the S&P 500 had a minimum sustainable withdrawal rate of 3.77%. That's what it took to survive those 4 periods where it ran out of money. You would have had to start out with a reduced withdrawal rate of 3.77%. For the four fund portfolio, to survive the one time it missed, you would have had to have a 3.35% withdrawal rate. So those are the ultimate minimums. Those are the rock bottom minimums. Okay. On the other hand, if you're actually doing this in real life, when you look at it, you sort of see how things are going, and you can get a feel for whether or not you may need to cut back a little bit. So if you're in a really disastrous scenario, you can do that. So to me, a more meaningful measure maybe is not the absolute minimum, but what's the 95th percentile? 95% of the time, these withdrawal rates will get you through the 30-year period over the last 63 scenarios. In that case, the four fund portfolio allows you to take a 4.4% withdrawal rate. And the S&P 500 is about 4%, 3.96. So the the four fund would allow you to take out a little more. The mean sustainable withdrawal rate over those 63 30-year scenarios for the four fund is 9.4%. S&P 500 is 7.6, 7.7%, in that range. So, and that's from that perspective, from a sustainable withdrawal rates perspective, which is what keeps you from running out of money. The four fund portfolio looks like it might be a little better as long as you pay attention to what you're doing. Volatility is kind of an up and down thing. It doesn't really affect the survivability of your portfolio necessarily. It may affect how well you can stay with your portfolio, but so from the standpoint of which one has more sequence risk, does the four fund have more sequence risk than the S&P? I don't think it does. And in fact, in some respects, I think it has less risk. But to answer the questioner's question, does it have more risk? No, I don't believe so. Not when I look at this data.
Carol, can you go back to the
less risk? Sorry, Paul, go ahead.
Can you go back to the table before the quilt?
Mm-hmm.
I think where this is confusing to people, I'm guessing here, is that our intuition, when we hear that something is more risky, we think in terms of something not being as productive, and not as dependable. But the reality is, and I've talked about this before, the way this table should look, or let's put it this way, the way this table would look at the end of the 90 years or so that are here, it should show the S&P 500 as the least profitable because it's the least risky. And the four fund strategy should do better in terms of total return, compound rate of return, because it's more risky. And so this is simply highlighting that higher risk of the four fund strategy was to your advantage. And in particular, when we talk about the sequence of returns, when we look at that period of 2000 through 2002, or 2000 through 2009, boy, that's a killer period for people who retired in 2000 and were taking money out. And so this is the way it should be. It's not like it's saying something bad about the S&P 500. It's simply saying that it is not as productive as these four funds together, and therefore going to do as long if the future like the past. And so I don't know if that's helpful, but that's how I look at it. And would you add anything to that, Daryl or Chris?
Well, I think what you say is right in some sense, that the four fund is riskier than the S&P 500 when you look at it from a return perspective. But I think when you look at it from the perspective of sequence risk, and you look at it in terms of how often do you run out of money, and what is your sustainable withdrawal rate over a given period with a given portfolio. I think that from those two metrics, running out of money and sustainable withdrawal rate, I don't think it's any riskier. It's more volatile. And if you measure risk by volatility, then it is riskier. But if you measure risk by surviving and being able to take out of your portfolio what you need, I think it's not any riskier, and it may be less risky. Part of the reason why it's more volatile is because it includes some more volatile asset classes. Every asset class more risky than the S&P 500 is probably going to be more volatile, and the four fund has three of those, so it's going to be more volatile. But when you put all those things, I think this is one of the benefits of diversification. When you put all four of those things together and you look at it from a sequence risk over a retirement time span with withdrawals, I don't think it's any riskier than the S&P 500.
Yeah, if it was me characterizing it, I'd say you're taking more risk in one way and you're taking less risk in another. So you're taking more risk in that you're investing in small and value asset classes, which have a history of having higher volatility in their returns. You're taking less risk though, because you've diversified across things that don't move at the same time. They're less correlated assets, right? So you have one thing that's more risk, one thing that's less risk. And the goal of the ultimate buy and hold, as well as the four fund solution, in both cases, it's to get a higher return at close to the same unit, same amount of risk, right? So you have these two things that I think offset one another. And so it's not surprising to me that the sequence of return risk is lower, because I think you have a higher chance of better return, or a higher expected return. And you have that diversification that's reducing the likelihood that everything goes south all at once, right? Where with the S&P 500, you're not nearly as diversified. You're invested in only one market, only one factor, really, one factor premium, and that's the market. You're not invested in the small premium. You're not invested in the value premium. And so when the market is out of favor, you can spend a long time in the bottom, and that's what this chart shows.
Yeah, Chris mentioned return for risk, and that gets back to the Sharpe and Sortino ratios that we talked about on the other chart earlier in the week. And the four fund portfolio has a better Sharpe and Sortino ratio than the S&P 500. So you get, or at least it's about the same. And so you get the same or more bang for the buck than you do with the S&P 500. Plus you do get a better return.
So I'm 50-50 stocks and bonds.
Better return.
And in retirement and taking money out of, I don't have a pension, I have Social Security, and taking money out of our investments. Is there anything about this relationship you see here that changes a lot if we looked at this kind of an analysis of a 50-50 strategy? Would we expect there to be still this advantage in terms of sequence of return risk? Will it still be an advantage having the 4 funds or the 10 funds versus the S&P 500?
I'm going to talk about examples that are like that in my talk on the 21st. And the answer is yes, it should still help you out. because this is basically the engine side of your portfolio, right? The other half of your portfolio is not there to generate high returns. You know, you may have at times gotten a higher return out of the fixed income side, but not often, right? It's primarily there as safety, security, you know, you can call it brakes or safety belt, whatever you want. So everything that we just went through here is going to apply to the engine side of your portfolio and still help you out. Yeah.
If you have bonds in your portfolio, the effects will be muted somewhat or reduced a little bit because the engine has a governor on it, if you want to think of it
Yes.
in terms of
Yeah.
the bonds. But the effect is still there as long as the bonds that are in the two portfolios are the same and the allocation to those bonds are the same. The effect should be the same, maybe just a little muted.
And so if you add internationals, it could give a small bump in terms of the risk of the sequence of returns. But it's not a very big bump. Is it, Daryl, from what you've seen?
Most of the analysis, this shows 92 years here. Most of the analysis we've done for the best portfolios, 1, 2, 3, 4 portfolios, was only over the last 30 years, and that was a bad period for international. So it did not perform well then. I think having international diversification in your portfolio is a good thing. Whether you should have 50-50 or 30-70 is kind of individual choice. But I think to have zero is you're giving up another source of diversification. What do you think, Chris?
Well, I'm going to go back to 1970 in the analysis that I present on the 21st, and it is consistent with what Paul just said. It's a small bump in volatility. I think it's within the uncertainty of the process, though. That's the way I would describe it, because the differences across international markets tend to move over long periods of time, right? These are historical changes. And so, you know, what I show going back to 1970 would be very different than going back to 1928 or, you know, if we had the data going back to the 1800s. So I think there's just a huge amount of uncertainty in terms of what you can expect there. And the primary reason for investing internationally isn't that slightly higher return, lower return, slightly higher risk, slightly lower risk. It's to avoid the giant potential concentrated risk, right? Where something, God forbid, happens in your country, right? You really hope that you don't have to endure one of those historically awful periods of time. But if they happen and you're internationally diversified, that's when it really pays dividends and was worthwhile.
And by the way, we did get a number of questions about the 4 fund versus the 10 fund, and because I have advocated for the 10 fund strategy for decades, am I still doing that? And yes, my own portfolio is still using the international, the emerging markets, the REITs. The more the merrier as far as I'm concerned, but I just have to protect against the catastrophic, and so my view is going to be a lot different than a 21-year-old in terms of concern for short-term protection. Thank you, Daryl. I like that. Thank you both. Which strategies are better when you take tax implications of rebalancing into consideration? First of all, and we had other questions that had to do with asset class location. And I really have to recommend, rather than us spend 20 minutes talking about that, is that this book, Your Complete Guide to a Successful and Secure Retirement, written by Larry Swedroe and Kevin Grogan, it has got a whole chapter on asset class location. I will share with you ever so quickly kind of the bottom line. And Larry, from number 1 to number 8, what would be the things that you would want to have in your tax deferred versus taxable? And so if I might just share those quickly, and it will answer a lot of the questions that we got. And that is the tax efficient investments that you would want in your taxable account would start with US core. That would be the S&P 500 and international core. The next level, getting a little less efficient, emerging markets core, US large value, and US small value. I was surprised that the small value was that high in the taxable area. The next level of going down, international large value. The next level, going down again, international small value, then bonds, then REITs, then long, short, alternative style risk strategies and commodities. And finally, he lists reinsurance and the alternative lending securities that a lot of people have in their portfolios. We don't get into the alternative strategies in the work that we do. I don't think they're appropriate for do-it-yourselfers, particularly young do-it-yourselfers. Now, this is a relatively long chapter, so there's a lot of meat in this book. And for the few bucks it's going to cost you, I will just tell you right now. And as I said on a Choose FI Facebook presentation, I actually bought 100 of these books to give to friends. I know you guys are shocked I have 100 friends, aren't you?
Actually, I'm shocked you haven't given me a book.
Oh,
Yeah,
well, I would have had to pay to ship it to you, Chris. You know me, Mr.
Now
Cheap.
we know who the real friends are.
Oh, I knew I was going to step on that one. Well, anyway, I really encourage you because he has a wonderful chapter in here. This is another question that came up. It's not a page. It's about 4 or 5 pages about using dividend producing stocks as a way to build a portfolio. You may not agree with him, but you can certainly, when you read his work, you'll know he's looked at it carefully. So, you have anything you want to add? I got to pick up my papers I just dropped here.
I think that was great. We're almost out of time for this one, I think.
Oh, you're right. Yes, you know what? Are we going to be able to get the rest of this in one more? We're going to have to, I think. I think we will have done it with one more of these. But I want to thank everybody for listening and for those who watched. We really enjoy doing these as a group. And we'd certainly like feedback on how difficult it is from those of you who are listening to the podcast and not seeing, for example, Daryl's tables and whatnot. Let us know and we'll continue to kind of figure out how to make those work better. We will have a link to the charts and tables that Daryl produced and that Chris shared. So we will see you next week. All the best. Thank you, guys. Well, I want to welcome you all to what I think is going to be a very special podcast, or it could be a series of podcasts, because on September 23rd, I made a presentation with the help of Chris Pedersen, who is our director of research, and Chris, there he is, and Daryl Balls, director of analytics. He's the only guy left. And we made an hour-and-a-half presentation about selecting the best 1, 2, 3, or 4 fund strategy. The whole idea of that presentation was to focus in on some simple, what we call no nonsense portfolios that virtually anybody can do if those particular kind of funds are available in your 401k. So the idea is to simplify, simplify, simplify. And Daryl and Chris have just done, I think, an amazing job of helping us pare this down to give you what we consider to be one of the finest likely returns for the unit of risk, and to be able to do it easily. So what we're doing now is, during that presentation, we were bombarded with questions, and we had about 75 to 100 questions that didn't get answered. Now, I'm not guaranteeing that we're going to get to everyone specifically, but we're going to try our best to focus in some major areas and to be able to give you a sense of some of those broad questions that you asked. So let's start with what I think is the basic reason for having even done that particular presentation. And that is that we wanted people, one, to understand you don't have to have 12 funds in your portfolio to get a good return. And that the asset classes you actually select for your portfolio is going to make a huge difference in what you're likely to have at the end of your career of investing. And you'll see some specific returns. Now, we are only looking back 30 years, and we'll be very careful to make sure you understand that there are some limitations only looking back at those particular 30 years. We also want to focus on risk and make sure that you'll have a good feeling for what the different risks are for these different portfolios. And what made me feel particularly good when I saw all the numbers is it truly looks like we ought to be able to squeeze a better return out of a lot of these no-nonsense portfolios without having to do anything very fancy. And one last thing, and it is the big surprise that I got out of putting this whole presentation together. And it was with the help of Daryl Ball's research on creating what you'll learn about, if you don't know about it, in a few minutes, the telltale chart. And what the telltale chart, the bottom line that it taught me, is that when we leave the safety of the most common, most popular mutual fund or asset class, the S&P 500, when we leave that and we try to get a better rate of return, it is really in some ways unsettling how long sometimes we have to wait in order to break even. And I don't mean break even in return, but there are long periods of time that the S&P 500 will outperform these different kinds of strategies that we'll be showing you. But with patience, from everything we know about the past, there should be that premium. So Daryl is the one who did all the legwork here in the tables that we used when we made the presentation. And Daryl, I want to turn to you now and talk, if you will, about the tables that you developed and how you put those together. We had a lot of questions about those tables. So would you take a few minutes and go through them?
Yeah, I'll do that, Paul. What we've got here is table 1 of Paul's presentation, and it kind of lays the groundwork or gives an overview of all the different portfolios that he covered during the presentation. There were 3 one-fund portfolios, the S&P, the total U.S. market, and the total world market. And there were 4 two-fund portfolios, the total international and total US, which is the equity side of the Bogleheads 3-fund portfolio.
Could I
Total
interrupt one
US.
sec there, Daryl? Just one sec. That could be confusing to people because I probably didn't set it up right. We're talking about 2-fund portfolios, but it says 3-fund equity only Bogleheads portfolio. What we did in these portfolios is we threw out any of the fixed income that somebody might have recommended, because we felt the only way to truly get a comparison between these different portfolios was to look only at the equity portion. And then of course you as an investor could decide how much fixed income you ought to have. So that's why it says 3-fund, but it's 2-fund. Sorry, Daryl.
That's okay. And it's actually 70% US and 30% international. The total US and 30% small cap value tilt, and the total world with a 30% small cap value tilt are sort of modeled after some of Fama and French's work. And then Paul has talked about a US all value portfolio also that's 50% large value, 50% small value. The 3-fund portfolio is actually the equity side of Rick Ferry's 4-fund or Core 4 portfolio. So it's like the Bogleheads again, it's -1 minus the fixed income component. It's got 60% US market, 10% REITs, and 30% international. And then there are the 4-fund portfolios. We looked at 3 of those, and they're all equally weighted in terms of their asset class allocations. The first one is the US 4-fund, which is 25% in a large cap blend, the S&P 500 index, 25% in the large cap value index, 25% in the small cap value index, or small cap index, and 25% in the small cap value index. Then there's the world or the international 4-fund, which is also called the Trev H, after the name of the Bogleheads user who sort of popularized it on the Bogleheads website. And it's 25% large US large cap blend, 25% US small cap blend, 25% international large value, and 25% international small cap index. These are all indexes.
And I think it's worth mentioning that basically it is accessing the same 4 asset classes as the 4-fund Merriman strategy. It's just that it's picking up 2 of them internationally, and rather than having them all be in the US, but they're all there.
Yes, that's true. And then there's the all value worldwide portfolio, which is large and small value in both international and US. And these are all indexes. We didn't use any particular real existing funds, specific funds. And that was in part because we wanted to look at just what the results were as a result of the asset classes involved. We didn't want to have to deal too much with whether their management costs were different, whether the tax environments might be different depending on where they were located or anything like that. It was just to assess how the different asset classes performed relative to each other. The one difference to that was that we did take out a representative expense ratio, because some of these asset classes are more expensive to actually create than others, regardless of how the fund is managed. And so we used expense ratios over here that were analogous to the expense ratios that are actually from Chris's work on the best-in-class funds. All the portfolios, when we looked at annual performance, were rebalanced annually. Again, all of the data is from Dimension, and it includes international and US.
Let's stop there for 1 sec if we can,
Yes.
Daryl, because you brought up dimensional. Maybe not everybody knows dimensional, but they're a particular family of mutual funds, and they're basically driven by academic research. And so they've developed these indexes. Can you give our viewers and listeners an idea of the difference between a dimensional small cap value or one of those asset classes and using Russell or some other index that represents a similar asset class, but not exactly the same?
Yeah, we had a question on how the indexes were formed. And if we go back here, here's how the indexes were formed. This is right off the Dimensional site. And it talks about how they compose their large cap value index. We have them for small cap value and also the small cap. Those were the particular ones that were asked for. But it talks about how they developed the index, what is in it, what's not in it, and where they got the data, and then how they went through and calculated their returns down here. This is, for those who are listening to the podcast, you'll have to come to the site, paulmerriman.com, and look at these. We'll have to put these up, Paul.
Yep.
And even if you're looking at it on the video, it's hard to read, but they will be there. And the difference is that they constructed these indexes based on their academic understanding of what they were trying to accomplish with these different factors or asset classes. So they're very, very value-y or very small relative to some of the other ones. And Chris can maybe talk about factors at some point later on, maybe, and how that might work.
And in a sense, it seems fair as long as everybody's portfolio was using the same underlying asset classes. While it might not be exactly the way that an individual investor will access those for the purposes of trying to see relative risk and return, it seemed like it was a fair way to go. And didn't that also have to do with how far back we could go with indexes?
Right, because we were using, what I wanted to do was have data from a consistent source of returns, and that returns were from the dimensional database. And the dimensional database only went back to 1990 for a couple of the asset classes. My phone's going on over here, sorry. And let's see, where was it?
Oh, just
Yeah,
about.
and the ones in particular were the international large cap value and a global market from dimensional that only went back to 1990. Now it's possible that in the future we can go back further to 1970 or even further than that, possibly in some cases, and we could expand the work done then by looking at further back into history.
Okay.
I think we talked about this, how the indexes are they have no implementation expenses other than some expense ratios that I've added, but the normal funds have all kinds of expenses and also other costs associated with them. So that
and to be fair, when people think that they get the index return less a small expense, someday you ought to go look at Morningstar and look up the Vanguard index funds. Right. And see the past result, how different, sometimes over 1% a year, how different the returns of the funds are compared to the index itself. So it's trickier when you have to manage the money than just simply saying I own an index, because money flows in and out, and that all has to be managed, and sometimes it doesn't exactly match that particular index.
Right. So those are kind of the portfolios, how they were constructed, why they were constructed the way they were, and which ones we looked at. One of the things that we did when doing this analysis was to try to get a feel for risk, and in order to do that, we looked at that risk landscape in several different ways. In terms of parameters that we could calculate or analyze. In terms of portfolio performance, return performance, we looked at standard deviations, both up and down, the normal standard deviation definition, and then also the downside standard deviation. Standard deviation measures volatility. Most people, I don't think, care about volatility too much when you're up. They do care when you're down. And so those are two different measures that are good to look at. We also looked at maximum drawdowns over different periods of time, and then risk-adjusted returns, a Sharpe ratio, which looks at total volatility, takes into account return with using total volatility, and the Sortino ratio, which also takes into account return volatility, but only on the downside. And when we're looking at withdrawal sequences or withdrawal scenarios, we look at the so-called sustainable or safe withdrawal rates over a 30-year, typically is what we use here, time horizon, and whether the portfolio failed for a given withdrawal rate, say 4%. The other thing we looked at this time was the telltale chart. And that did generate a lot of questions. What's a telltale chart? Well, a telltale chart is I don't know if John Bogle invented it, but he certainly popularized it. And what it does is it compares one security with another security. It's also known as a price relative or a relative strength chart. And it does this by dividing the return of the benchmark into the return of the security that you're looking at or that is under consideration. And so it takes the aggregate growth of one asset, the benchmark, divides it into the aggregate growth of the other asset that you're looking at. I think that's what that's what this is. It's stated the other way around here, but that's really what it's doing. And so it normalizes the performance really. And it gives you some insight about what happens, like Paul mentioned, in terms of how does the performance of the two vary over time relative to each other, and how long sometimes does it take for this performance to resolve itself or regress to the mean, if you want to think of it that way, or whatever. This is also, this definition here came basically from the Bogleheads wiki, where they discuss the telltale chart. So here is an example of the telltale chart and the growth chart. On the left is the traditional growth chart. You start out with $1 down here on January 1, 1930, and at the end of 90 years, you're up here at, what is that? That's about almost $30,000 with the US 4-fund portfolio. And you're down here, I'm not sure what that is. 10, 20, 30, 40, 50, 50, 60, somewhere in there, $1,000 here. The important point here is that as you look at how
Actually,
these...
that's not 60,000. You were, the second one's 6,000, right?
Yeah, that looks right.
Yeah, so the
Well-
S&P 500 grew to like 30,000 and, or I mean, the S&P 500 grew to 3,000, 4,000, something like that. And the 4-fund grew to 30,000-ish, right?
Yeah, it looks like it's in the mid-20s. Yeah. Yeah. But see, this is actually part of the problem with the growth chart, unless you have the numbers on it. It's on a log scale, which shows changes in a relative sense. From one main line to another is a factor of 10, no matter where it occurs on this chart. The other thing is that it's also hard to tell when one is doing better than the other. What you're really looking at is the gap between these two lines. It's hard to tell what it is. So when you divide the two, when you divide the small cap or the US 4-fund by the S&P 500, and you get the ratio of how well the 4-fund did relative to the S&P 500, that's what the chart on the right shows. It shows the relative strength. And over the 90 years, here, this is 1, 2, 3, 4, almost 5. Yeah. It's grown almost 5 times as much over the 92 years as the S&P 500. Was not a smooth ride, as you can see. Here, for example, things didn't go, nothing really happened very much in here. And then all of a sudden here, you shot up. Here, you shot up. Here, you didn't shoot up. You went down. Here's another great one here, and here's another down and a down. And you can really see those differences. And it's important to understand where those occur and how they occur when you're trying to understand how long you have to wait or how big the benefits, how long you had to wait, I should say, in the past.
And let's make sure that we understand that this is all about the outperformance of one asset over the other, because the primary asset, the S&P 500, could have a great 50 years, and the other one could be small cap value, and it produces exactly the same amount. Well, it had a great 50 years as well, but we paid it to give us more, and we didn't get it. And that's where people, I think, get antsy, is when they go through these long periods of waiting to get that extra return. And of course, as we know right now, there are also times when you're underperforming whatever that major asset class is, which of course is reflected here on every time that the value went down.
Right.
Didn't mean you were losing money. You were just not making as much.
Right. That's a good point. This let's take, for example, I have no idea if this is true, but let's take this example right here of this upsweep here. This means that the gap between the two is getting larger because the ratio of the top to the bottom is getting larger. So what it means is the 4 fund is outperforming the S&P 500. That doesn't mean they're both going up. They both could be going down. The S&P could just be going down more faster.
Exactly.
But you would still be happier to be in the 4 fund than the S&P if that were the case.
Yeah.
And vice versa over here when you have a downtrend like this. So there was one question that said when they looked at the telltale chart, they didn't see the S&P on there. Well, the S&P is implicit in this chart because it's the benchmark that the 4 fund is measured against here.
Or
And
put
so-
another way, Daryl, if the S&P was on the chart, it would be a line straight across at the number 1, right?
Sure. If you took the S&P 500 and divided it by the benchmark, which is the S&P 500,
Yep.
it would be right here, straight along the bottom here.
Right.
Good point, Chris. Let's see. I think, oh, yeah, somebody had a question about the quilts charts. I think that's an interesting name for this, the quilt chart. They were wondering what the lessons were on the quilt chart. And I think when you look at this here, this is in decades, performance by decades. You can see that they sort of bounce all over the place. Sometimes you're good, sometimes you're not good. Sometimes you're good, sometimes you're not good. And so one of the lessons from this quilt chart, even by decade,
what were you pointing at there when you said sometimes you're good? And
well, sometimes small cap value is good here. Can you see my arrow here?
I can now, yeah.
Okay. Sometimes small cap value is good. Sometimes it's not so good. It wasn't so good in the 30s. Sometimes the S&P is good, like the 2010 through the 2019 decade. Sometimes it's not, like the 20 through the 2010 decade. And that happens a lot. If you look at this and study it, you can see things bounce around a lot. The one that doesn't really bounce around too much is the 4 fund, which sort of makes sense because it's an average of these 4 things. So it's always going to be in the middle somewhere. But this looks at by decades, and it bounces around by decade. But if you look at it by year, and we're just looking at the 4 equity classes now, it's even crazier, okay? And so to try to, one of the lessons I get out of this, a quilt chart like this, is that, 1, 2, 3, 5, 10 years here, this is a 10-year chart, is not really long-term. And so that's an important lesson that came out of the quilt charts.
Now, I got really excited when I saw this because it looks at every year going back to 1928. It shows the 4 major asset classes, and it shows the combination of the 4. And I thought it was fascinating as an investor to see periods where the S&P 500 is the best for 4 or 5 years, and then shortly thereafter it's the worst for 7 years, and then it's up at the and so you're all over the place, any of these individual asset classes. But the 4 fund strategy, and to me this is such a powerful lesson, the 4 fund strategy, it isn't in the middle all the time, but it is in the middle most of the time. And the reason that that's important is because the other three assets beside the S&P 500 are all historically more profitable long-term than the S&P 500. So in fact, we had this question about what strategy, what asset class would you take if you wanted to count on this money in the equity part of your portfolio, in terms of what's the term? You know what I'm looking for, Chris? The series of returns.
Oh, the sequence of returns.
Sequence of returns.
Yeah,
Thank you.
We'll talk about that later. I have a whole thing on.
Okay, I'll shut up.
Well, no, it's fine. But you're making my point. Yeah, or we'll see your. Well, let me put it a different way. We'll see your point again later.
And I think people, you may have a hard time seeing it right now, but we're going to be sure to have this available through our site. You're going to have fun looking at this. There are a million lessons on that page.
Yeah, these two so-called quilt charts here are hard to talk about when you're not actually looking at it. So you'll have to come to the site to take a look at it. Oh, and then here's what Paul was just talking about. And we'll talk more about this when we get to the sequence of returns. This is a chart that just shows the 4-fund and the S&P 500. Let's see. So some of the key lessons that we looked at and that came out of this was risk and reward, about which portfolio had the best returns. How about risk and reward, or reward for risk? If you look at the S&P 500 here, the portfolio, it had a compound average growth rate over the 30-year period of 10. Two of the 3-fund portfolios did significantly better, 1.5% or almost 2.5% better, and that was the total U.S. plus 30% small cap value, and the all U.S. value, the small cap value and large cap value U.S. had a 12.3% return. If you look at the 3-fund and the 4-fund, you can see that the 4-funds, the U.S. only 4-fund and the all world, all value 4-fund, both did 1% to almost 2% better than the S&P. So that over this 30-year period, those funds, those portfolios would have done better than the S&P. If we go back and look at reward for risk, okay, either in terms of the Sharpe ratio, which looks at your reward as a function of total volatility, or the Sortino, which looks at your reward as a function of downside volatility, those same differences held. The portfolios that had the higher returns gave you more return for unit risk. The Sharpe ratio for the S&P was about 0.49. For the total US 30% tilt and the all value, they were about 0.55, which is more. Is it significantly more? Maybe yes, maybe no. But when you look at Sortino, which only considers downside volatility, the S&P was 1.08, and the 30% US with the all value, with a 30% total US with a 30% small cap value tilt was 1.36, and the all value is 1.438, almost 1.4. That's 30-40% better. So that's probably a significant difference to me.
So people wrote to us and they wanted to know whether we thought this was going to happen again. I mean, that is what investors would like to know, because who wouldn't want to pick up that extra return and unless the risk is just out of the question. And I did not see anywhere, just looking at the risk intuitively, that I would have said, no, I'm not going there because the risk is obviously too high. Did either one of you see any risk that you thought would scare you away from any of these no nonsense portfolios?
Well, there's one here that really did not do well at all, and that was the total world. Okay, it had a 7.3 return versus 10. Its Sharpe ratio was almost a third less than the S&P, 0.34 versus 0.49, and its Sortino was 30% less than the S&P 500. Now you got to remember what the total world is. It's it's cap weighted, but it's essentially almost half international. International did not do well over these last 30 years. And so that hinges on whether or not you think you should have international in your portfolio. And we'll talk a lot about that later on. But to get back to the reward for the risk, if we go and look at the 4-fund portfolios here, again, the Sharpe ratio of the US 4-fund is a little better than the Sharpe ratio of the S&P, 0.56 versus 0.49. The all value, all world portfolio is essentially the same, 0.51 versus 0.49. But if you look at the downside risk, the Sortino ratio, the reward for your downside volatility, again, the S&P was 1.08 and the US 4-fund is 1.37. To me, that's significantly higher. That's about 30% higher. The all world, all value was about 1.17. So it's a little better. Is it significantly better? Yeah. It's hard to say where significance starts to arise. But so to me, those are the 3 or 4 portfolios that come out of it.
So Chris, before we leave these tables, would you want to add anything that?
Yeah, the biggest thing I would say, and Daryl mentioned it as well, is that over these 30 years, international didn't perform particularly well. And next month in the AAII webinar I'm going to go back to 1970. And I think that'll give us a chance to see a different period of time where the difference between worldwide or international and US was much closer. So I think that the analysis that you covered in this last webinar really did a good job of showing that investors have historically been rewarded for using small and value in their portfolio. And I think that's something that is going to be consistent when I go back to 1970 as well. Those are observations that have stood the test of time. I think the observation, though, that the U.S. outperformed worldwide, I'm not as comfortable with. I think that that's just a quirk of the timeline that we had. And so I'd encourage people who are grappling with it, well, how much international diversification should I have? And is it going to improve or hurt my performance? I'd encourage them to look at the webinar I do next month, because that'll give them another data point that covers a little bit wider range of time. And I think will help reinforce the idea that international diversification is a good thing.
And I think that date that you present is October 21st, right?
Yeah, I said next month, but you're right. It's this month. It's October 21st.
And by the way, you have a brand new article that came out today in the AAII journal.
Yeah,
there.
it talks about it talks about how we have to pay a price to be different and what that price is. So when we invest in something like the 4-fund strategy instead of the S&P 500, there are a number of things we as investors have to do to earn that premium. And we're going to talk about some of them in the rest of this podcast, but
Great.
they're also covered to some extent in that article.
Okay, it's great.
If you invest to be different, you shouldn't be surprised when you are.
That's right.
That's a hard thing for people to get.
Yeah.
Because when we buy something, we buy it because it's been good. And then this difference between the courtship, the honeymoon, and reality, those can be 3 very different views of life. And a lot of investors just don't get that. I love this one.
Yeah, I wanted to clarify something. This is a lesson about patience here, right? And so when we briefed this chart, or Paul briefed this chart during his presentation, we talked about these long flat lines here, and we said those are periods of relative underperformance.
And we've got
Well,
some people who can't see that chart. Could you just give an idea of how long those
Sure.
were?
Well, the first thing is with the periods of time we're talking about, they run anywhere from 8 years up to 20 years. But the point I wanted to make about this is on the chart, we called them duration of relative underperformance. And it wasn't really relative underperformance. It's duration until you break even, until you get back to where you were. And so if you think about that, what that means is you had a period of underperformance, but then you had to have a period of outperformance to get back. So every one of these sections, for example, that's 8 years long, there's one of them here that's 8 years long. Well, it actually went down for 6 years, but then it went up for I don't know how many years after that. It looks like almost 10. But the first 3 or 4 of those were getting back to even. So it's a subtlety, but there's the difference between breaking even and underperforming. And I think if you have a chance to take a look, we'll see if we can put this up on the site. If you have a chance to take a look at this back up on the site, I think it'll help clarify some things. It's the lesson is still the same. You have to be patient. And it depends kind of where you hop on this roller coaster as to how long you have to be patient. And whether you consider break even a period, waiting to break even a period of relative underperformance or not. It depends kind of on where you choose to get on or get off the roller coaster.
I recently talked with a fellow who dumped Warren Buffett stock. He'd held it for 10 years. He'd had enough. He dumped the Buffett stock, Berkshire Hathaway, and put all the money into Tesla. There you go.
Well, he probably did well for a while. Maybe
That was
Yeah,
his
well,
I
I
can't
mean,
stand it anymore trade, right?
Pardon?
That was his I can't stand it anymore trade.
That's exactly right. Exactly. Yeah.
So I think, unless you guys have anything else you want me to address, I think I'm kind of done with the background
Okay.
here.
There was there were questions about these percentages in these different portfolios, and all we did was use the percentages that the creator of those strategies had determined was the way to use them. We did not manipulate or change their strategies. What you see is what they would want you to see, except with the exception, of course, of the fixed income portion. So, and I think it's as I look up my list of things that we need to cover. Oh, I know, rebalancing. That came up quite a few times. Did you mention how often you rebalanced, Daryl?
Yes, we rebalanced annually.
Okay.
On January 1. We used annual returns for in terms of the return sequence.
And do you, either one of you, have any sense of how much less return we should have if we rebalance more often than if we balance less often? Just a kind of a general statement about that difference.
In the analysis I've done in the past, it's usually on the order of 10 basis points. So, like 0.1%. It's not whether you rebalance monthly, quarterly, yearly. Yeah, it's a very small difference. Not very big. Now, if you go multiple years, you start to see more substantial differences you'll see an increase in return because you're letting your winners run and you're basically letting your portfolio get tilted more towards the asset classes that outperform, but then you're also seeing your volatility grow, right? You're getting out of whack with what you decided your own risk tolerance was. Yeah.
Right. And I think that's the primary reason why you rebalance is because your asset allocation, your risk, you're outside your risk tolerance. Presumably you picked your allocation because you thought it was right for your risk tolerance. So when you choose to that's why I use the 5-25 Larry Swedroe approach for rebalancing. I don't rebalance on a time schedule. I rebalance when it gets out of whack.
Yeah.
And sometimes that can be years. A lot of times it's years. The market bounces around a lot, but remember the asset allocation is a ratio of your equity to your fixed income. And so, you know, if everything is going down, your asset allocation is staying the same all the way down. So it's when things change that it's important. So anyway.
And it's also, I think, important to understand that those tables were, in terms of the return money-wise, it assumed a $10,000 lump sum investment. It did not assume that you built the portfolio over a number of years. And so you'd have some very different kinds of returns based on dollar cost averaging. Do you think the tables that you've built, Daryl, on accumulation, because we do have one of those on the 4-fund strategy, and we do have one of those on S&P 500, and I think we have it with the all value, a slightly different all value portfolio, but very close to what you have there. You think those are a good place to go get a sense of what a regular monthly investor could have seen as opposed to starting with just $10,000?
I got to be smarter than my technology here, and it's not working. So I had, here we go. Here's a fixed contribution schedule. It's one of a number of examples that we have. This one happens to be for the 4-fund combo. It's $1,000 a year, and the contributions are adjusted for inflation. So this is kind of a dollar cost averaging approach. Contributions are actually made monthly and rebalanced. I think it might have been rebalanced monthly in this example. But this is an example of how your contributions can vary as a function of your asset allocation over this 50-year time frame. It's hard to read.
It is, yeah, it is, but it does look at the bottom line is this is 50 years that the 4-fund ends up with 4.1 million, and the S&P 500, I think, is that 2.5 million.
Yeah,
so
that's for 100% stock in the 4-fund, right?
And I think the way you do these, Daryl, where you have also, what would you have if you were 50% fixed income over that period of time? You would have had about a little under. Yeah. So people can go to our website and look at a number of these kind of tables. So let's talk. If we could, if you guys don't have any other topics under the structure of these tables, which we had a lot of questions about, I would love to discuss or respond to the questions about equity asset class selection, because one of the big differences between those columns on those tables is what equity asset class you selected, and already it's been brought up. But Chris, could you talk a little more about the international, about how much a person might have in international, and again, what's the payoff for international as it's been underperforming for some time now?
Well, first of all, I think it's really important people do a gut check on how comfortable they are investing internationally, right? So that, I think for a lot of people, that's going to frame the discussion. And for some people, they'll just start with a, a high comfort level and be willing to say, oh, I get diversification and that's good. And they'll be done. And they'll probably follow an academic recommendation of something like a 50-50 split between US and international. There's going to be other people, though, for whom, they're worried about currency exchanges, going up and down and losing money just because the US dollar is out of favor, and have a home country bias, and be persuaded by a whole bunch of other things that they shouldn't diversify internationally. And for that second group, I think it's really important for them to appreciate some lessons from history, right? So one of those lessons from history would be that if you went back and looked at the stock market in the late 1800s, early 1900s, the US was not the superpower that it is today. Nobody would have predicted that from 1900 to 1999, that the US would dominate that century in terms of its stock market returns. So, to look back and say, oh, it's just obvious, the US is the market that you should be in because it's going to outperform, is to neglect that nobody saw that coming before it happened. And nobody saw, Japan's crash before it happened. Nobody saw Germany's crash before it happened, or Russia's crash before it happened. So to the extent that you invest very heavily in any one country, you're taking a risk that the academics say you're not compensated for. Now, does that mean that if you invest in the worldwide stock market today, that you're going to get a return as good as the US? I can't tell you that, right? Nobody really knows. It's possible the US will outperform. But does it mean that you're taking less risk you're not compensated for if you invest more internationally? Absolutely. So I think it behooves most people to try and take a diversification as close to that recommended by the academics, as close to the 50-50 as they can get. Now, if they stop at a 70-30, that's 70% US, and 30% international, they'll probably still get a lot of the benefit. And when I do the next AAII webinar and we go back to 1970, I think what you'll see is that over that period of time, that 50-year period of time, there's very little difference between being 50-50 US and international and being more heavily tilted towards the US. And I think if you go back to 1928, it tilts a little bit more back towards the US, because the US had a great century, right? But I think the truth is nobody knows moving forward. So when I choose for myself, my wife and I sit down and we talk about, well, how international can we get before it becomes uncomfortable for you? Because I know that she starts with a home country bias. And so that, we try and nudge it in the direction of the academics, but we don't get all the way there, and most people won't.
Well, and John Bogle, he put a cap of 20% on international, and that was his comfort level, I think.
And as you pointed out, he did really well with a U.S. asset class, the S&P 500. That's the horse he rode into town on.
That's right.
Right? As you've described it that way. So why wouldn't he stay U.S. focused? Yeah.
Daryl, you started to say something?
No, I just happened to have his book handy here where he said that.
Oh, I see. Okay, great.
It's
That's
highlighted.
great.
So that's his little book of common sense investing.
Yes, I have that. Mine had, I've got it right behind me. It is so worn. It really is a must for a young investor or somebody just getting started to read. So on the asset class selection, value, of course, is the thing that's been underperforming recently, has outperformed, whether it's small value or large value. So Chris, you're building your two funds for life, and you're going to be talking about that on October 21st, I assume.
Yeah.
What's your belief about the future of small cap value, or value in general?
Well, I think I like to buy things that are on sale. I like to buy things that are cheaper and get value for my money. When I'm investing in the stock market, I'm not just buying some, random kind of bucket in hopes that it goes up in value. I'm not speculating. I'm buying earnings. I'm buying future earnings, and I can buy more of them per dollar in the value category than I can in the growth category. And so my belief is that over time, that's going to pay off. It's going to be a better deal. And so I think there's just a good underlying financial reason for it to have a better return in the long run. But I also believe from the work that Daryl just did that I'm going to have to wait for that. I'm going to have to recognize that I'm contrarian. And I think all investors are going to have to do that. They're going to have to understand that because you're investing in the thing that's not popular, you shouldn't expect it just to go up tomorrow, right? It may take a little while for the rest of the world to appreciate it. And some of the things in that category are going to do poorly, right? Some of those companies will go out of business. They're cheap for a reason. Yeah. But on average, history says that that's a way to get a premium, a way to get a little better return. And if I can combine it with another premium that has good historical results, the size premium, then that even increases my chances of success more. So I think if investors can understand the reasons for it and then provide the behavior that helps them earn the return, they'll do well investing in value. But it may not be tomorrow. It may take 5 or 10 years before that premium comes back. And that's what Daryl's charts show, is that sometimes you have to wait a long time.
And in fact, looking at the 4-fund strategy, not just small cap value, but with the 4-fund strategy over that 90 years in that telltale chart, 70 and a half years, you were in essence behind the premium you expected.
Yeah.
You were waiting to break even out of 90 years. And so that difference between the 4-fund strategy is impacted a lot by that small cap value, that 25% position. It happened in very short spurts that maybe just went for a few years. In fact, Daryl, do you have any actual number of years that those, well, it must have been the difference between the 70 and a half that you were behind and the 90. So about 20 years out of the 70 really produced that premium as I see it. So what about, Chris, maybe one of you has done something with this, the growth. A lot of people wrote in, where is the growth? Where is the beef? What do you say to people who do not see growth in these portfolios?
There was a question about how small cap value had underperformed large cap growth.
48%.
Yeah, and they were concerned that how long would they, let me see if I can find it here actually. Yeah, the gap between large cap growth and small cap value for the last 1 year has been just horrible. 46.5% according to Morningstar. Won't it take a long, long time to recover? Could be 10 plus years. Well, there's a couple of things there. I went and I found the Morningstar article, and the number that was quoted, 46.3% actually is the number that I see in the article, is the underperformance of small cap value relative to small cap growth. Because they were comparing value and growth in the different size categories. Having said that, I went back and looked at what was it relative to large cap value or large cap growth rather. And let me see if I can find it here. So here are the rolling 3-year cumulative returns, which is what the Morningstar article looked at. Small cap growth or small cap value minus large cap growth. And here's your minus 41.4%. So it's
this goes back to 1975.
This goes back to 1975. Yeah.
Okay.
And here's the 40 plus percent underperformance that the questioner was concerned about.
Yeah.
So you can see that these kinds of numbers have happened before in the past. And so how long did it take the rolling 3-year return to get back to zero? About 2 years, not 10 years.
Yeah, in all three cases where
in
there
all
were
3 cases that have happened since 1920. The flip side was kind of interesting too. I looked at how did large cap growth outperform small cap value, large cap growth minus small cap value. And so in 1977 here, the 3-year rolling return of large cap growth minus small cap value was a minus 72%. Growth was down 72% compared to small cap value. Large cap growth was down 72%. And it took more than 8 years to get even. In 1996, large cap growth was down 48% relative to small cap value. It took 2 years to get even. In 2003, it was down almost 72% again. It took more than 3 years, almost 4 years to get even with small cap value. Same thing in 2010, it was down 30% and it took a little over 3 years to get back. So what's the message here? I think the message to me that I get out of this is, yeah, these asset classes can outperform each other by large amounts over rolling 3-year periods, and it happens regularly. And so it's not a surprise. The thing that I find interesting is that when small cap value is down by a lot in the past, what is this, 45 years? When that has happened, it has come back quickly. Mm-hmm. Large cap growth, when it's down by a lot relative to small cap value, takes longer to come back.
I think the other thing
let me phrase that differently. Has taken longer to come back in the past.
Yeah,
Nobody
the other thing
Sorry,
the
Chris.
other thing that I see that's different on the chart here is the peaks. How much did it outperform? So small cap values peaks in terms of outperformance are up around 75%, 125%,
Right.
50%, and large cap growth's outperformance is 25%, 50%. It's quite a bit lower, which is what we would expect, right? We would expect that over the long haul, if you look at the cumulative effect of the gain of large cap growth versus small cap value, it would be smaller. That small cap value should outperform over the long haul and has. These charts make it hard to see that, but it's kind of hidden in there, right?
Yeah. The other thing is these charts are essentially mirror images of each other. They don't look quite like it because you're talking about ratios, right?
Right.
But they are. This peak here that Chris pointed out where small cap value was up over 125, it's the same peak here or trough where large cap growth was down.
Yeah.
The numbers aren't
they're mirror images. That's right.
But yeah. But so this is interesting to me because what this tells me is that one is it probably won't take 10 years. It has not taken 10 years in the past. So if that's a guide, and also that when this inevitably flips and goes the other way, growth takes a lot longer to come back to even than value did when it was down.
And while we're on value, particularly small cap value, we had a question about if I'm young, should I be putting all of my money in small cap value? Chris, why don't you take that since you have become an expert on small cap value?
Well, and I've modeled it a lot of different ways, right? I've modeled putting somebody in all small cap value and staying there. I've modeled putting somebody in small cap value as part of the 2 Fund for Life strategy where they're 100% small cap value up until age 25 and then ramp it down towards retirement. Or they do the 1.5 times age, which means that, at 20, you've got 30% in a target date fund and 70% in small cap value, and you ramp it down. So I've looked at all those different approaches, and two things stand out. First of all, the more you tilt towards small in value, the more you put at risk in the short term, right? The more, so the deeper the drawdown could be. So let's say you're a young investor and you put everything in small cap value, and then 2 years later you decide you need to buy a house. And now you don't have as much money as you had the day you put it in, because small cap value is out of favor right now in the marketplace. Well, you took more risk, you have less money, you may not be in as good a position to buy a house. And that disadvantage lasts for 5 to 10 years. You have more money at risk for at least 5 to 10 years. So for a young investor who's thinking about tilting towards small in value, they should probably also be thinking, well, do I have a down payment for a house that I'm going to have to be putting up? Do I have a debt, a school debt that I need to be paying down? Do I have other short-term needs, an emergency fund that I need to save, right? There are other things that I would not put small cap value in because they're not a long-term investment. So let's say that those are taken care of. Now you're just talking about saving for retirement. In general, if you can tolerate the volatility, that's the next big choice. If you can stick with it through thick and thin, the more you put into small cap value, the higher your expected median end return will be, right? But you're going to have to maybe go through 10 or 15 years where you underperform the S&P 500. Do you believe in it enough to do that, right? Now, I think somebody who takes the 1.5 times their salary into target date fund and the rest into small cap value and ramps it down over time, or somebody who takes 10% of their savings and puts it in small cap value, I think they're going to weather that storm just fine because they're diversified. And the fact that small cap value is out of favor is a small part of their whole portfolio. But for somebody who's got a big chunk in that one asset class and runs through a period of bad returns, I think they're putting themselves at risk for second guessing and getting out of it at the wrong time and then not earning the premium. So you have to know yourself. You have to know how much of that downside are you going to be able to tolerate, and how confident are you in the returns? Because when it gets really, really hard, you're going to be tested and you're going to have to stick with it to get those premiums, right? So as much as I've studied it and as much as I believe in it, I don't have everything in small cap value. I have a small part of our portfolio in small cap value because I want that extra premium, but I also don't want to lose sleep at night if I go through 10 years without it.
Yes. And somebody asked about how I invest personally, and I'm in the equity portion of the buy and hold portion. My wife and I have half of our equities in small, half in large. We have half of our small in value and half in blend. And we have to remember that part of the blend is value. Yep. So we have more than half of that small in value. We have half in US and half in international. And then we really irritate people when we tell them that we have half in buy and hold and half in market timing. For me, I've tried to invest with every kind of diversification that I can that implies that I should get a decent return. I'm at the point in my life where big returns are not my concern. Not losing a lot of money is what I'm more concerned about. And so this is why the three of us can talk and talk and talk. And at the end of the day, it's hard to solve problems for people because we don't know the specifics. As a matter of fact, I was just checking today because I know the answer for myself, but I wasn't sure for Daryl and Chris. But I asked, do either one of you have a designation as a certified financial planner? I don't. Is anybody here a chartered financial analyst? No way.
Some guy on the internet.
Is that, is anybody here qualified about like a CPA? Anybody got a CPA? No. And so this is one of the genuinely interesting things about investing. Anybody can step up and place a bet, and the market will do what it's going to do. And but it does beg the question for those of us who are do-it-yourself investors, which I'm actually not, but I'm trying to help do-it-yourself investors, is how much do we need to know in order to make the right decision? And I think, Chris, what you just said is we need to know ourselves. We need to understand if we're young
Yes.
and small cap value is in decline, that's good. That's not bad, because it means that your dollar cost averaging is buying more shares. But boy, when it's happening to you, it doesn't feel that way. And that's why investing, I think, is difficult. You know what I think? I think we've been talking for about an hour. Does anybody have an idea if that's about right? I think
That's about
so.
right.
Sounds about right.
And when we started this, we said, okay, we don't want to wear them out. Let's go 45 minutes to an hour and then come back to fight another day. Now, are you up to it? Come back and do this another day and continue these questions?
Absolutely.
Yes, absolutely.
All right.
Yeah.
I mean, we could go 8 hours right now. No.
No, we couldn't.
But I do. I really do appreciate you guys taking the time to do this. And you know, my hope, I don't know how you feel about it, but if we talk here for an hour and some young investor or somebody who's getting close to retirement is trying to solve some problem, and out of our conversation comes a potential answer, I hope we're helping somebody make some important decisions. So thank you both, and thank all of the viewers and the listeners. We'll be back for more in answering those AAII questions. And go to your calendar, please, and put down Chris Pedersen, AAII, October 21. I know it's 5:30 on the Pacific Coast, and you can go to AAII and sign up for that. But what, it's an hour and a half or so, including questions, Chris?
I'll probably try and do my presentation in 45 minutes and
Okay.
leave time for questions, but we'll see how it goes. Yeah, I
Good.
think we have about an hour and a half window. Yeah.
That's great. Well, these, just for what it's worth, these two people volunteer to help other investors hundreds and hundreds of hours a year. And I can't even start to tell you how much I appreciate it. And I hope you do too. We will see you hopefully next week. Thank you for joining us.